As 2025 comes to a close, CNBC's Alex Sherman spoke with 16 top executives across media, sports, and entertainment who made some pretty bold industry predictions for 2026. Joining us right now with some of those calls is Alex Sherman, CNBC's media and sports reporter. I always love when you do this. So what would you say is the most provocative, outrageous, over-the-top thing that could actually come true?
Yeah, so look, these people that I speak to, these are top of the food chain executives. So it's always interesting to me to hear what they say anonymously, what they would never say publicly. I would say the one that comes to mind is Apple buying our parent company for 2 more weeks, NBC Universal. The Apple buys Disney thing has been out there for many years. I feel like that has been a prediction in the past. This is the 5th year that I'm doing this. Maybe, I don't know, 2 or 3 of those years, Apple buys Disney. That one has fallen off for whatever reason, and it has been replaced by NBC Universal, I think because the current thinking is that it's clear Brian Roberts was in the market to do something with Warner Brothers Discovery. That looks like it's not going to happen. Netflix and Paramount's bidding war for Warner Brothers Discovery has set a new multiple, potentially, for traditional media assets, and maybe now would be the time if Brian Roberts decided, you know, there's just not really a deal out there for me where I can control the asset. Maybe it's time for me to take advantage of the heightened multiple and actually sell.
Right at the Apple.
Would Apple want it?
Well, look, I think this executive told me that Apple wants in to the TV industry. He's a well plugged in executive. Apple hasn't really said we're looking for bulking up in terms of an acquisition. They've always been similar to Netflix, a builder, not a buyer. It is that long thing where, you know, the largest traditional acquisition to date, I think, is still the Beats acquisition for Apple, which was $3 billion for a multi-trillion-dollar company. So these answers, however, are always no, no, no until they're yes, just like Netflix finally did a deal. Maybe it's Apple's turn. Maybe, look, strategically, if Apple wants to be in the TV business, it would behoove them to gain a lot of assets, particularly they've shown an interest in sports. Apple has had trouble advancing in this industry because their streaming service is sort of the low man on the totem pole, and whenever you have a prized media asset, you always want to go to who's going to give me the biggest reach, who's going to give me the most viewers. And Apple has the least amount of viewers right now. That's not the Apple way. So maybe they take the leap and they actually buy a bigger library of programming and a lot of sports rights.
By the way, Comcast was the biggest gainer in the S&P 500, I think, 2 days ago. It was up by 5.8% or something. What happened? What was that?
Well, I think there's probably several different things going on. One may be this multiple leap that I'm talking about of NBC, where suddenly the media assets within Comcast are now valued at a higher level. It's also possible that investors are like, thank God you're not in a giant bidding war with Paramount and Netflix over the Warner Brothers Discovery assets. The interesting thing there, though, is I do attribute that leap probably to the media side of the business, where Comcast has long traded actually on the broadband internet side of the business. Maybe we will see a flip a little bit in 2026 where the media assets are actually valued high enough that it actually affects the stock price positively.
Okay, you have another prediction that has to do with the show The View.
Yes. One executive predicted that Marjorie Taylor Greene will join The View. She's, of course, already said she's leaving Congress in January of 2026. And she will need a new job at that point.
Right.
Maybe she'll run for president, but maybe in the interim she'll join The View.
You think she'll get along with Whoopi? How would that?
I would imagine they won't get along, but you know, isn't that part of the joy of joining The View? So I don't have too much to say on that one in terms of reporting, but I did think it was an interesting prediction, and you know.
Okay,
we'll see.
we got another prediction. There's going to be a whole bunch of lockouts taking place. Both, I think, in Major League Baseball is one of the predictions,
and the WNBA.
And the WNBA.
Yeah. So I actually just spoke to the Players Association Executive Director Terry Jackson this week about the WNBA one, and she told me she's pretty frustrated right now. There's a January 9th deadline. Of course, things could be extended because the season doesn't start until May, but it doesn't sound to me like we are on the cusp of a deal yet for the WNBA. And of course, Major League Baseball's big issue is, will we finally have a salary cap in Major League Baseball? And will the owners take a stand and say, after this coming year, no mas. We are sitting out until we finally get one. So both of those sports this person predicted will have a work stoppage, which would be, that is not the direction that any player or owner wants this thing to go. So I would put that in the bold category.
And then finally, what is Alex Sherman's prediction on who ends up owning Warner Brothers Discovery?
Oh, wow. I mean, I have no idea on that one, but I will give a prediction, which is that I don't understand why the Ellison family at this point wouldn't put out another sweetened bid after publicly saying and repeating that their $30 per share offer was not a best and final offer. To just never raise the bid at that point seems to me to be a bizarre ball fake. So I guess I could say, logically speaking, I would at least predict that there's going to be one more bid from the Paramount side, and it'll probably be an aggressive bid to be like, well, if $30 wasn't the best and final, here's our best and final, shareholders, and then you guys decide at that point. So that is a prediction that I don't know if it's true or not. I'll leave it at that. I have no idea if Netflix would match that bid. Who knows?
We will see, and we will see whether these other predictions come true. I'm going to start DVRing The View so I can wait for Marjorie Taylor Greene.
Alex, stay with us for just a moment because we've got some news about a new media merger, and it's a pretty unusual one. The Trump Media and Technology Group is announcing plans to merge with TAE Technologies. That is a fusion power company. This is an all-stock merger of equals that's valued at more than $6 billion, and upon closing, Trump Media will be a holding company for its current portfolio of media brands, including Truth Social, also the power brands that are owned by TAE. If you read this release, which I'm just doing right now, it says that this transaction is designed to create one of the world's first publicly traded fusion companies. Basically, going through with this, Nunes is saying that this is a situation where Trump Media and Technology Group built what he calls an uncancelable infrastructure to secure free expression for online for Americans, and now we're taking a big step towards a revolutionary technology that will cement America's global energy dominance for generations. I mean, a completely unusual combination between a media company and a fusion company, a power fusion
Sounds
company.
like the old GE days where NBC used to be owned by GE in terms of a
Right.
conglomerate. I mean,
new and different. I guess these are all areas that they see being very important. I guess you could say with energy, it's such a big need for the data centers, and the idea that this country needs more data and more ways of producing energy. I guess they're playing off of that. The stock immediately is up by about 31% on this news. But that's the news. It's a deal that's just out, and apparently each side of the shareholders will get 50% of this new company with this merger.
This is fascinating. I'm trying to figure out who runs TAE,
Yeah.
what the backstory is
Not familiar
about this whole company, who used to, there was some venture money behind this for a long time, big names. We're going to dig into all of this, and we're going to come back and try to break this down. Maybe we should go make some phone calls to figure out the backstory on a deal that I think a lot of folks are going to be interested in this morning.
Yeah. We'll continue with that. When we come back, though, Evercore's Roger Altman will join us. That's coming up in the next hour. He is representing Warner Brothers Discovery and its merger deal negotiations, and he will give us his take on the bids by both Netflix and Paramount. First, though, the AccuWeather forecast with meteorologist Bernie Rayno.
All right, some travel delays across the southeast and north central U.S. as a cold front comes on through. Your AccuWeather exclusive forecast showing rain in Chicago, in Detroit, in Nashville, Atlanta. Watch out for some thunderstorms from New Orleans toward Houston. Another wet day in the Northwest. Your AccuWeather travel forecast delays in Atlanta and Chicago today. And watch some rain in Dallas this morning and gusty winds this afternoon. To help you make the best decisions and be more in the know, make sure to download the AccuWeather app today.
A new leisure market airline has come up with an innovative pitch to try and win over consumers who are looking to visit the Caribbean. Phil LeBeau joins us right now with more. What's the pitch, Phil?
Well, the pitch is that if you're going to be flying on Anguilla Air, which is a subsidiary of Bermuda Air, which is just launching service, you might be able to have a little more elbow room when you're flying on one of the Embraer jets down to the island of Anguilla. Some people might be listening to this report or watching this report and saying, Anguilla, where is Anguilla? It is a British territory. It's an island that is just to the east of Puerto Rico, and Bermuda Air is starting Anguilla Air. And Anguilla Air, which begins service this week, today actually out of Newark, direct from Boston, Baltimore, and Newark, will be flying Embraer planes with no middle seat. So you get a little more elbow room for a flight, and while that may not sound like a big deal, believe me, there are a number of people I talk with who have said, yeah, I would prefer if I didn't have to sit in a middle seat or next to somebody in a middle seat. And as I mentioned, flights from Newark start today. Is there a market for Anguilla? Here's the CEO of Bermuda Air.
They're different islands. They offer something that is unique and special. And so I think that very frankly, we're confident that we can get people on board and that we can show them what we're about as an airline, but also, of course, the islands they sell themselves.
It also helps offset the seasonality that Bermuda Air is primarily attracting travelers in the summer and in the fall. Winter, not so much. That'll flip here with Anguilla Air. By the way, flights to Caribbean from the U.S., flat this year versus last year, but compared to 2019, up almost 20%, and Anguilla has become one of these little gems that people are starting to discover. The number of people going there, up 198% since 2019. Bottom line is this, guys. The Caribbean has quietly but steadily become a bigger and bigger destination for Americans looking to travel internationally. It's always been a hot spot to a certain extent. Now you're starting to see it span a little bit further with new destinations, smaller islands within the Caribbean.
Do you associate that with COVID, with the idea that first people couldn't go anywhere, and then when they did travel, they wanted to maybe go a little closer? Or
I
are they
think there's
better
some
at
of
marketing
that.
it?
Definitely there's some of that. I think there's some of that. I also think that there are people who are looking to go internationally who want to try someplace new. And maybe going transatlantic is just a bridge too far. People are like, well, it's crowded in Europe. Are there places we haven't explored in Europe? You go to the Caribbean, you've got a lot more options.
I like it. Phil, they're telling me to wrap up very quickly. International air travel, have they raised prices drastically, especially if you're traveling business class? I'm only asking because our tickets to Davos, I think, are twice what they were a year ago.
Depends. Certain destinations, look, Davos is always going to get you. And I understand you might well sit there and say, well, it's double what it was a couple of years ago. I think some of that depends on timing in terms of the flights that are there. But
No,
there's been so much
dates. I fly the same dates all the
within.
time, and it's literally twice the price.
That one I cannot explain to you, Becky. But I can tell you this, that as you've seen more flights added transatlantically, or transatlantic flights that have been added, the fares have gone up a little bit, but not a ton. There's just a lot more supply there, and obviously supply and demand, you're going to see that price to a certain extent hold, or maybe even in some markets drop a little bit.
Yeah, this could just be a Davos thing. Phil, thank you very much, and we'll see you later.
Okay, coming up on the other side of this, all the latest moves in the energy market, including what President Trump's pressure on Venezuela could mean for crude prices. We're coming right back after this.
welcome back, everybody. Take a look at crude oil prices, $55.95, steady at this hour after hitting their lowest levels since 2021 earlier in the week. Late Tuesday, President Trump ordered a blockade of sanctioned oil tankers linked to Venezuela. Joining us right now is Rebecca Babin, CIBC Private Wealth Senior Energy Trader. And Rebecca, these prices this year have been kind of phenomenal in how low the prices have been given all of the conflict we continue to see around the globe, things that you would anticipate could disrupt oil markets. But you say that crude oil is kind of in a war with itself. Can you explain what that means?
Yeah, so I think you really hit on the key point, Becky. We've had a lot of geopolitical risk escalate this year, whether it's been Israel and Iran, Russia, Ukraine, and now with Venezuela. And that has at times seemed to indicate that we would see supply reductions in the market, right? We've got millions of barrels coming out of Russia and Iran specifically, but none of these actual escalations have resulted in barrels being off the market. In fact, we've really seen all of the sanctioned barrels finding their ways to buyers one way or another. And so that has been the kind of reason that the market has experienced these short covering rallies. There's supply risk. The other side of the coin and where we're doing the battle is on the fundamental side. We're looking at a market that is significantly oversupplied. Demand is growing for 2025 at 1 million barrels a day, where supply, non-OPEC supply, is growing at 1.6 million barrels a day. So this is a market that has a natural buffer built in terms of excess supply. Then you add OPEC, which came in and started unwinding their production cuts, and you have a significantly oversupplied market. So all of these geopolitical risks kind of bump up against that supply, and it kind of becomes this narrative battle. Which narrative are we focusing on today? Is it supply risk, or is it the fundamental oversupply that's impacting prices? At the end of the day, the winner of the battle for 2025 has clearly been fundamentals. Crude's down over 20%, and fundamentals have really won the day. I think that battle will continue into 2026, where we continue to see fundamental weakness and potential increased geopolitical risks.
Yeah, it feels a little different to me than what we've seen in the past, and that's basically because normally on a supply-demand situation, it is the demand side that is the bigger driver. If you have a down market like this, it's usually because there's economic turmoil somewhere in the world. What would happen to prices if we weren't dealing with all these geopolitical issues, whether it be Russia and Ukraine or Venezuela? What would happen if those somehow got miraculously solved, if the geopolitical tensions came down?
Really good point on that, and I agree, this is different. Demand has actually outperformed this year. Even though we were worrying about it in April, it's going to be around 1 million barrels a day this year, and maybe potentially 1.2 million barrels a day demand growth next year. If we start to see demand get shaky due to geopolitical or due to global growth risks, and we see the geopolitical risks fade, we will absolutely see crude test 50 WTI, maybe the 40s. But the key here is when we test those levels, that's when we start to see a supply response from U.S. producers. So the market naturally resets itself back into balance. It's not going to just continue to trade lower. Producers are not going to produce at a loss. So that's where you see that mechanism step in.
I mean, we already heard, there was some reporting yesterday that suggested the Trump administration has been looking to the U.S. majors to find out who is interested in going into Venezuela to potentially pump more. And the answer was nobody at this point, because there are more fertile fields elsewhere, and because oil prices just aren't high enough to kind of incentivize them to get into this. Are we already at the point where some fields would be shut down or some exploration would not happen because you can't get crude above $60?
So for most of the U.S. shale producers, 55 is where you start to see some barrels start to be uneconomical. It accelerates drastically as you get to 50 and below. The supply impacts at this price point and where the curve is actually not extreme. We might see 50 to 100,000 barrels a day of production start to come off. But the key here, and I think this is a really important point, is U.S. producers continue to get more efficient and be able to drive down their break evens. We've expected crude to start to come off. We've seen rig counts come down this year pretty dramatically, but production hasn't responded. They're drilling longer laterals. They're getting more efficient. So as we think about those break even points, just continue to remember that we thought they were going to respond in the past, and they've been very resilient. So we are at that tipping point, but I would say maybe we need to shade that tipping point a couple bucks lower due to the efficiencies. So it's something to watch, but I don't bet against U.S. producers cutting back dramatically at this crude strip. I think that takes place $5 lower from here.
Rebecca, thank you for joining us this morning. We appreciate it.
Thank you.
Time. It is now 7 a.m. on the East Coast. You're watching Squawk Box on CNBC. I'm Andrew Ross Sorkin along with Becky Quick. Mike Santoli is joining us as well. Joe is off today. We got some breaking news in just the last few minutes. The Bank of England announcing a quarter-point rate cut. That was expected. We should say the European Central Bank's latest rate decision due at 8:15 Eastern Time this morning. And then there's this. President Trump addressing the nation from the White House last night. He said the economy is stronger than people think. He also criticized Democrats for inflation, the border, and crime. He also addressed health insurance.
I'm also taking on the gigantic health insurance companies that have gotten rich on billions of dollars of money that should go directly to the people. The money should go to the people. That's you. So they can buy their own health insurance, which will give far better benefits at much lower cost.
And then later this hour, we're going to talk healthcare with Republican Senator James Lankford. And then the 8 o'clock hour, we got House Minority Leader Hakeem Jeffries. Then we'll get the latest read on inflation. November Consumer Price Index numbers. They're due at 8:30 Eastern Time this morning. And we also have this Trump media deal with a fusion company. And I'm still trying to make sense of what that is really all about. It seems like a very complicated,
not intuitive,
Trojan horse effort to take a fusion to turn yourself into, from a media company, into maybe a speculative fusion company.
I don't know. It sounds like they're trying to take all of the kind of Trump talking points and agenda points and kind of wrap them into one. It does not sound like they're trying to shut down Trump media in any way, shape, or form. We want that. This is more of a conglomerate type of issue where you roll all these things
right,
up.
But you're taking what is arguably an overpriced stock to buy a private company. There's a question, by the way, about the value of the actual company, because why would you do this deal? Why would this be the way you would approach it if you were, if you were killing it and thought, okay, I'm going to go public one day? Why is this deal better?
The fusion company, you mean?
The fusion company than going public on your own or doing some other kind of transaction. This is effectively a Trojan horse way, effectively, to go from being private to being public. In large part. In fact, the fusion company could ultimately have more value than the media company probably does. So,
and for Trump Media, you're kind of accessing a different kind of investor enthusiasm stream, which would be for these alternative energy type plays.
Right.
So the whole
by the way, the stock is up 20%. It was up 35%
before.
First announced. It's up 20% now. For the 1 week, it's up by about 15%.
And then I wonder, which I'm just speaking out loud, I don't know. Is there some bet here that on the fusion side, you're going to need some kind of regulatory approvals or something else that somehow being involved with this company somehow helps you with? I don't think we know enough about the personalities involved behind this whole transaction in terms of who's on what side politically, donations. I mean, I think this is one of those things where you got to say to yourself, there's something that, because it's so, let's just call it. Let's call it what it is. It looks weird.
Well, we'll dig into this and hopefully get more answers on all of those questions. In the meantime, though, take a look at the futures this morning. We are still in the green. It looks like the Dow futures are up by about 116 points. NASDAQ futures up by 215. The S&P futures up by 30. I want to get over to Frank Holland. He's got a look at this morning's pre-market movers. And Frank, what's on your radar screen this morning?
Hey, good morning, Becky. Good morning, Andrew. Good morning, Mike. We're going to start things off with Micron. You can see right here, surging up just about 12.5% after providing full-year guidance that beat estimates in its Q1 report. Micron's full-year profit guidance just about doubled estimates, and its revenue guidance that came in $5 billion above expectations. The chipmaker also raised its full-year CapEx guidance. If this pre-market move holds, again, up just about 12.5%. This would be Micron's best day since all the way back in April. Year-to-date, shares up over 200%. We're also looking at Lululemon this morning. Shares are popping after a journal report that activist investor Elliott Management has built a more than $1 billion stake in the struggling athleisure maker. You can see shares are up almost 7% right now. That report, citing people familiar with the matter, say Elliott is pushing for former Ralph Lauren CFO Jay Nielsen to take over as CEO. Just last week, Lulu announced CEO Calvin McDonald will step down in January. The stock's off its year lows, but you can still see here it's still down year to date, more than 40%. And a quick check on yesterday's IPO, that's Medline. Shares are pulling back this morning a bit after they surged more than 40% in their debut on the NASDAQ. You can see they're down just about 4.5%, almost 5%. The medical supply company originally priced at $29 per share and an upsize offering that raised more than $6 billion, making it the largest listing since Rivian, all the way back in 2021. Again, shares pulling back just about 5.25%, but big pop yesterday after it went public. Becky, back over to you.
Frank, thank you very much. We will check in with you in just a little bit.
Our next guest says he expects to see the S&P 500 rally back to new highs before the year is over. For some insights and stats on the markets, let's bring in Ryan Dietrich, Chief Market Strategist at Carson Group. Ryan, good to see you.
Good to be here. Always enjoy your fine cities.
Yes, and glad to have you, along with the masses that come this time of year.
It's crowded out there.
So if we were to get to a new high in the S&P by the end of the year, we're talking about 8.5 trading sessions until we're done.
We're close.
It's like a 3% move. So I mean, what gives you confidence, if not that we get all the way there, that things still get a lift?
Yeah, you know, I want to talk about yesterday for a second.
Sure.
So you see the headlines, down a lot, tech down a lot. There were more 52-week highs on the NYSE yesterday than there were the day before. The number of stocks of the S&P 500 above their 50-day and 200-day actually increased yesterday. You know, we can go through more of them. I mean, the reality is we all complain only 7 stocks going up. You know, Mike, we are seeing more of this broadening out, and I get it. Tech is such a big part of it. Last comment, you know, you look at advanced decline lines, they're still pretty solid. And one more for yesterday. I think there's a mantra under the bed with Oracle and tech and AI. We see it in the high-yield corporate bonds. High-yield corporate bonds are barely down yesterday. They're less than 1% of all-time highs. This volatility is legit, but I don't think it's like the first domino to fall before everything fall apart here.
Yeah, I mean, you're seeing it, I guess, with specific credits like Oracle's, but not maybe bleeding over into the broader credit picture. I take your point that there has been, this is what a broadening might look like, which is a stalled index. And by I say stalled, the S&P 500 closed yesterday at levels of 2 months ago, basically, from before last third quarter earnings season started. And yet you have seen traction in parts of the market like banks and some cyclical stocks, transports, even energy gets a bounce. Is that the formula we're looking for next year, or do you think it can be a different story, or can kind of tech reassert leadership?
No, we think it's probably more that's broadening out. You know, you mentioned tech. If I were along with you a week ago, we'd be saying tech's up 13 days in a row, longest win streak ever, and now it's having one of its largest 5-day losing streaks, since April, I guess. So really, tech is where it was 3 months ago. So we're not minimizing it, but I think it is just broadening out. And I know I've come on with you guys for a while saying, I'm sure other guests have too. Look around the globe. I mean, there is a lot of strength around the globe. Yes, we like the U.S., we're U.S., but we still like developed international. Big question a lot of portfolio managers have, is developed international going to keep outperforming next year, or just a one-year blip like we've seen for the past 20 years, one-year blips? We think, hate to say this time is different, 4 most dangerous words. We do think this broadening out global theme, Mike, it is legit as we reaccelerate the global economy next year.
We've had, it's interesting, sometimes you get the consensus for the year ahead, like last year, where it was like, hey, this is the year for equal weight over the market cap weight. I'm not sure you have people confident about the global trade, but it's really worked this year. And so maybe a year later, that starts to come together, right? I mean, do you actually think that that we can get positive returns if the Mag 7 is not really outperforming?
Well, we think we can, and I think one of the big things that everyone's going to be talking about midterm year. Midterm year is the worst year of the 4-year cycle, down 17.5% peak to trough. All that stuff is out there, but if you don't have a recession, that's our base case. The S&P 500 is up 10% or more for the year, 70% of the time. Yes, we're going to have 3 strong years going into next year, but one of the things we've talked about is still a young bull market. It's just entered its 4th year. Last 50 years, when you've had a bull market, at this point, been 5 of them. The average has been 8 years. The shortest has been 5. So those are just some numbers, but to think this bull market's old is not true. And then you look at something like Germany. Germany just earlier this year broke out above levels from 2007. So there are some parts of this market, and transports. I mean, my goodness, transports just broke out last week for the first time, in several years. So there's some parts that are probably going to keep taking this baton, and we like that.
All right, yeah, maybe we can add smaller stocks into that. Ryan, great to see you. Thanks very much.
Appreciate it.
Okay, coming up, we are closing out a strong year for IPOs on Wall Street. NASDAQ President Nelson Griggs is going to join us in just a little bit. And later this hour, the latest on tariffs and trade from U.S. Trade Rep Jameson Greer. He's going to join us live on the broadcast from the White House at 7:50 a.m. Eastern Time. Don't go anywhere. Squawk Box returning in just a moment. Welcome back to Squawk Box. 2025 marking a very strong year for public market listings. This year, the NASDAQ raising a total of nearly $47 billion. That's the highest capital volume since 2021. And just yesterday, Medline made its public debut, the largest IPO of the year, right here on the NASDAQ. Joining us now to discuss the year of IPOs and his outlook for 2026 is NASDAQ President Nelson Griggs. Good morning to you. Congratulations on what was a pretty great 2025.
Yeah.
When you think about 2026, people are already speculating about names like OpenAI and Anthropic and SpaceX. I mean, we could be in a whole new realm. So where are we really? And is that pie in the sky or is that reality?
I think there's a lot of reality there. I think this year we went in probably with higher expectations, but dealt with the tariff situation. We dealt with the government shutdown. And we still had a doubling of last year. So there's a bit of a backlog in the pipeline. It's the most diverse pipeline I've seen in years across multiple sectors. We have a low VIX. We have a volatility index. We have an interest rate environment that's more constructive. You have the markets doing pretty well. And I think there's just a backdrop of good M&A activity, putting a floor on some prices, and we've seen in the private market valuations getting a lot closer to where previous rounds were. So the setup is very strong. Obviously things can happen, but across a large, small, medium, we see a lot of activity coming in 26.
Those names.
Yeah.
I don't know if you can speak to those names. I don't know how this works.
I think we've done this before. I cannot speak to those names, but no, I think there's tremendous excitement about what could be some of the largest IPOs of all time. Probably more of a back half consideration, but I think you look at companies that are in that 1 billion, 10 billion, there's going to be potentially a bit of a rush to get out in the first half of the year if you do think about some larger names, maybe thinking about the back half of the year to make sure they're not going to be there's enough capital.
Policy question.
Yeah.
Which is, and I think you had a session here with the head of the SEC and Adina together in terms of trying to make IPOs great again. There's still this issue of so many private companies that have stayed private for so much longer. And it's true that some of the companies we're even talking about, that you're not mentioning by name, but I am, have been private for quite some time. And whether it would have been better to make those companies public earlier so that the investor class, the public, could actually participate. And what you think is really happening at this point.
Well, we definitely have with the leadership of the administration and Chair Atkins, there's a strong push, the strongest. I've been here for 25 years, and we've always tried to think about ways that we can make the public markets more attractive to companies. And I think there's more momentum now than ever, looking at some big structural changes, scale disclosure, the consideration around mandatory arbitration as an opportunity for companies, and then proxy reform. So I think it's building, Andrew.
It seems like at the same time, there's an effort afoot to allow, for example, like the tokenization of a private company so that public shareholders can effectively access private companies without the same types of disclosure, frankly. Or, for example, these semi-liquid instruments of creating effectively what looks like a venture capital fund or private equity fund, putting those right here in the public markets, so that people so that those companies actually stay private for longer.
Yeah, there's a lot in that question, but we're believers that we need to have a robust private market and a robust public market, and anything that we can do at NASDAQ to help make the public markets more attractive, we're all in on. We have been for years, but I think we have an administration and SEC who's willing to really take that leap now and make some things effective. But with the private market, that is a very viable asset class, and you need to make sure that has the right guardrails on as well too. So I think the blend is a good thing.
You mentioned that maybe some smaller and mid-sized companies will want to get their deals out because maybe we got the jumbo ones coming later. In aggregate, are we going to be worrying about how much capital is going to be demanded of this market at a time when we're actually talking about stock buyback flows maybe going down because everyone's spending on CapEx?
I think it's a good question. I think the market's going to determine what that looks like. There's, if you look at this year being a good year on NASDAQ, raising almost $47 billion, that still is not a very large amount, right? So let's say you get a doubling of that, what have you.
The S&P is like 55 trillion.
Exactly. So I think there is plenty of capital. You do start looking at some of what could be the largest IPOs of all time. That's going to be something for the bankers, the whole ecosystem to work out. But yeah.
Okay, Nelson, it's always good to see you. Wish you happy holidays.
It's great to be here. Thanks so much.
Well, I mean, this is just great to be here. Of course, it's great for you to be here. It's like you walk downstairs.
I'm here most days, but it was the 30th anniversary of Squawk Box this year. Had a lot of fun with you guys, and you have a big year coming up as well too with Versant. So
we do. Thank you.
All right, when we come back, a last-minute push by lawmakers to pass a health care bill before the new year appears unlikely to succeed. We'll talk to Republican Senator James Lankford next. And later, don't miss our exclusive conversation with Blackstone Chairman and CEO Steve Schwarzman. Squawk Box will be right back.
Time now for today's Aflac Trivia question. What numbers are represented by dots on the Domino's Pizza logo? The answer when Squawk Box returns. Now the answer to today's Aflac trivia question. What numbers are represented by dots on the Domino's pizza logo? The answer, 2 and 1. They represent the first 3 locations opened when the pizza maker was launched.
That's what you call actual trivia. None of us have ever heard of that before. Learn something every day. President Trump touting his accomplishments last night in his address to the nation, one touching on the ongoing battle over extending Obamacare subsidies happening on Capitol Hill. Joining us right now to talk about this and much more is Republican Senator James Lankford. And Senator, thank you for being with us. Yesterday, 4 moderate Republicans joined the Democrats in kind of pushing to make sure that there's going to be a vote that comes in early January, at least on the floor of the House, to extend the ACA subsidies. What chance does that have of making it through the Senate?
It actually doesn't, because it's the same vote we've already had in the Senate. This is a Democrat proposal to say, let's just take the current policies now and just extend them out for 3 years. Remembering that what this really is not the Obamacare subsidies. These are subsidies on top of the subsidies that were done during COVID, during that time, for an emergency basis on it. So they're looking to be able to just say, let's pretend the COVID pandemic is still happening. Let's continue these subsidies out. No changes, no reforms, no caps, unlimited amount of money income that you could have personally, that you could still get these subsidies. So there are a lot of issues that in the Senate has already said, no, that's the wrong way to go, is to pretend the COVID pandemic is still happening. Let's actually talk about what are we doing, I should say, on trying to be able to reduce the amount that people have to personally pay. So our direction wasn't sending it to insurance companies and saying this is to help during the pandemic. It was trying to get assistance to individuals that need the assistance the most.
Understood, and I would go so far as to say I think some of the Republicans who signed on for that are not interested in simply extending the ACA subsidies for another 3 years without any changes. But there doesn't seem to be any sort of mix of what Republicans are talking about and what Democrats are talking about, where you make some of those changes, but you extend some of these ACA subsidies for a year or maybe a little longer beyond that while you work through the changes that you want to make to the system. I think there are plenty of Republicans, not only in the House but in the Senate, who are worried about the political backlash that will come when rates go up next year. And I realize these subsidies are only for 22 to 24 million people, not for all Americans. But there are massive increases in healthcare costs that are going to go up to hit those people and lots of others. And I think there are plenty of Republican politicians who are worried about getting blamed for those higher costs.
Sure. Yeah, there is real dialogue about what can we do to be able to deal with these subsidies and the high cost premium that will spike for those above 400% of poverty. Just to be clear, you had about 10 million people in Obamacare at the beginning of the Biden administration. They added all these subsidies in, and then you had about 21 million people in subsidies for the marketplace by the end of his administration. So he doubled the number of people in the marketplace, and the way that he did it was just uncapped. It's unlimited. It used to be 400% in poverty down would get some kind of subsidies. This was on top of that. So we're not talking about people 400% of poverty and down. They're still going to be covered. That's the vast majority of people in the marketplace. You're talking about people above 400% of poverty, the subsidies that were put on top of them. So that's the specific area we're talking about and what needs to be done. Those folks used to pay, let's say, $1,200 a month. Then with the subsidies, they went to paying $80 a month. Now they don't want to go back to paying $1,200 to $2,000 a month because the marketplace continues to accelerate. In my state, in Oklahoma, the marketplace has gone up 200% in 6 years. At the same time, commercial insurance has gone up 29%. So Republicans are simply saying there is a structural problem in the marketplace that it would accelerate so much faster than the commercial insurance. We should take a look at that and find out what the problem is rather than just sending more tax dollars over and over again and pretending there's not a problem.
That's a fair argument, but the idea that it has taken this long to kind of take a look at it, I think that's where you have a political problem. The idea that, okay, we're going to take a look at it, but we're taking a look at it as these premiums are going up for people and they're seeing that hit them in their pocketbooks.
Well, I would only tell you we have taken a look at a lot of things for a long time. Trying to get bipartisan agreement in the Senate is not as simple as it looks. We have bipartisan agreement, for instance, on pharmacy benefit managers and what's happening behind the scenes that's driving up the cost of pharmaceuticals and pushing out independent pharmacies all around the country. We have bipartisan agreement on that moved through the Finance Committee that I serve on unanimously. We've not been able to get that across the floor. So some things are tougher than it looks when you got to get 60 hard-headed people all in one room and to be able to agree on something.
So what do you think you can get 60 people to agree on?
I hope that we can deal with the pharmacy benefit managers. I hope that we can deal with what are we going to do to actually assist individuals in taking care of their deductible. That's the most important part for most people, is their premium itself and then their deductible when they use their health care. Many of these plans in the Obamacare marketplace may have $9,000, $10,000 deductible. So basically it's like having catastrophic insurance for them, and they're in trouble with higher deductibles and higher premiums on it. So we're trying to be able to figure out how to be able to get them a lower premium and then also take care of that first part of their deductible for the folks that are most affected there. Again, if it's 400% in poverty and down, those folks are already heavily subsidized, they're taken care of. These are the folks that are above 400% of poverty we're talking about.
Do you think you have a political problem, though? I mean, this is the issue that the Democrats are planning to lead with when it comes to these midterm elections.
Oh, I'm sure that they will politically. I would tell you, Democrats have done a very good job of saying, if your health insurance has gone up in any level for any person in the country, that's the Republicans' fault, knowing full well it is only this specific slice in the Obamacare marketplaces. That's the part that we're actually dealing with. The other 320 million Americans, Democrats are not dealing with at all at this point as their insurance goes up. We're trying to figure out what is actually causing the rise in prices on everyone's insurance and how do we deal with that. But after Obamacare passed, it has been very, very difficult to be able to deal with anything in the healthcare space because Democrats will immediately say, we don't want to deal with anything on healthcare unless it's just adding on to what we're already doing. Republicans say we have a problem because your plan has risen 200% in 6 years. That is an issue that everyone should at least admit there's a problem, and we've got to be able to deal with that because it's affecting everyone's insurance.
Senator, it's the end of the year, and it's a time when a lot of people start looking to make charitable donations ahead of the end of the year for tax purposes as well. You led some efforts in the One Big Beautiful Bill to try and make sure that people can go ahead and still deduct about $2,000, even if they are non-itemizers, to make sure that they can still give money to churches and beyond. What do you think that's going to do?
Well, I hope that it encourages a lot of people to start re-engaging giving to nonprofits on this. It's a change that we made in 2017 to double the standard deduction so more people would have a simplified tax filing. One of the things that we used as a trade-off for that is that individuals that didn't itemize, they would no longer be able to write off their nonprofit donations. The problem with that is it's been about a $20 billion loss to nonprofits around the country. Nonprofits are the basic safety net that are in our culture. Our culture has 3 safety nets: the family, churches and nonprofits, and then government is third on that. If we have weaker families and we have weak nonprofits that are out there, we're going to struggle because the government can never keep up. So I did make the change and push very hard for this, that individuals that don't itemize on their taxes can, starting next year, be able to get up to $2,000 per family in a tax-deductible donation that they give to any nonprofit of their choice. It doesn't matter what nonprofit is, they can give to anyone of their choice. They'll be able to write $2,000 off their taxes. One thing I would encourage as well, if you're above this deduction there and you're going to be able to write off and you're itemizing on it, this is a better year to be able to give to nonprofits as well. There'll be a small amount of reduction for what that'll mean for itemizers starting for next year. So for those folks that enjoy giving to charitable donations, please do that, but I'd encourage you to do that before the end of this year, even if you're an itemizer.
Be interesting to see if the $20 billion hole is made up for with that, or if the changes to higher income individuals end up having some offset to that too. But Senator Lankford, thank you for your time this morning. We appreciate it.
You bet, glad to do it.
Coming up in the 8 o'clock hour, we'll talk more healthcare with House Minority Leader Hakeem Jeffries. Buff Box will be right back. We're watching shares of British oil giant BP. The company has appointed Woodside Energy chief Meg O'Neill as its next CEO. O'Neill will replace Mari Auchincloss, who will step down today after less than 2 years on the job. BP's executive VP, Carol Howell, will serve as interim CEO until O'Neill takes over on April 1st. O'Neill has more than 25 years experience in the oil and gas industry, including 23 years at ExxonMobil. She's expected to hold the line on BP's recent pivot away from green pledges and back to fossil fuel production.
When we come back, Evercore founder Roger Altman will join us. He is representing Warner Brothers Discovery in its merger deal. He'll give us his view of the Netflix and Paramount bids. That's next, right here on Squawk Box. All right, welcome back, everybody. As we reported on the show yesterday, the Warner Brothers Discovery Board is unanimously recommending that shareholders reject the hostile takeover offer from Paramount Skydance and instead stick with what they are calling a superior offer from Netflix. Our next guest has been advising Warner Brothers Discovery in this contentious media deal. Roger Altman is the founder and senior chairman of Evercore, and obviously a friend of the show, too. And Roger, it's good to see you this morning.
Thanks for having me.
So talk us through this. We yesterday heard from Sam DiPiazza at the board of Warner Brothers about what he thought, what the board went through when they were thinking about this. But as somebody who has seen a lot of different offers, what makes you think that the Netflix deal is better than what you're hearing from Paramount Skydance?
Let me start off by just saying one word about the process that the Warner Brothers board has used. You know, that, as you know, they've received 6 separate offers from Paramount Sky, in addition, of course, to the process involving Netflix and other companies. And I've done this a long time, and when I was, when one of my kids was younger, she once said, you know, Dad, what Dad does is talk on the phone and go to board meetings. So I've seen a lot of them. And the process here was as fiduciary driven and as clean and thorough and independent as anybody could ever want.
Are you saying that because you anticipate that there will be shareholder losses?
No, I'm saying that because
happens?
P-Sky has criticized the process.
Yeah.
So that's number one. Number two, I'll call him Peace Guy. The Peace Guy offer is on a risk-adjusted basis is not higher. And here's why. Peace Guy has a $15 billion market cap, and it's a weak company. It doesn't have any real free cash flow. And it's trying to do a $108 billion acquisition. So it's effectively an extreme LBO. Now, if you're the target of an extreme LBO, you're the company that the offeror is trying to buy, what's your number one question? Do they have the financing? And can I count on the financing being there? And the answer in this instance is no, which is why I say the risk-adjusted value of the offer is not higher.
What makes you say no?
No, because they need about $40 billion of equity to achieve the total debt and financing package necessary to do the deal. Despite repeated, and I mean repeated, efforts on the part of Warner Brothers Discovery to get clarity and assurance on the so-called Ellison backstop, we have not received that.
And the concern with that is that it's a revocable trust, the Ellison revocable trust, and the board's concern is that at any point Larry Ellison could take the shares of Oracle out of it.
Think of what the word revocable means. The word revocable means that the day after the merger agreement, or any day after that, you can take assets out, you can leverage it up, you can completely change it. So there's no assurance that the necessary equity would be there. In addition, we don't know the composition of the trust. We've not been given information about the assets and the liabilities of the trust.
So Roger, and you've asked for this repeatedly.
Yes.
So the question is, if they came back to you and said, now, given that you're out here on television saying this, and others have obviously said this from the companies, if they came back and said, we're going to put the money in an escrow account that's just going to sit over here, or whatever, would that fundamentally change the calculus, or are there other issues and items that you're considering?
It's always a matter of, as you well know, of the fine print.
Right.
Is it really legally binding? Now, look, in Twitter, yes, it was a smaller deal, but it wasn't that small. Elon Musk contractually guaranteed the equity. I will put up the equity. I may syndicate it down later, which you did, some of it, but I contractually commit to it. We've repeatedly asked for something equivalent on that.
And you haven't gotten it. So, but why do you think you haven't? Which is to say, do you believe that really the money isn't there? Do you believe that there's something else going on? What is your analysis of to the extent that you've said this to them, they know it, and for whatever reason they haven't done it?
By the way, the Warner Brothers releases, including the most recent one in response to these several offers, has been explicit on this deficiency. It's right there on the public record. I don't know the answer to your question. Andrew, I really don't. I have my own guesses, but I'm not going to do that here. But I don't actually know the answer. By the way, in response to your other question, yes, there are other deficiencies here. Let me just mention a couple. We have to refinance Warner Brothers, a $17 billion bridge loan, which we're planning to do over the next couple of months. If we don't refinance it, we owe the bondholders $1.5 billion. The Peace Guy offer says that's subject to our approval, and they've given us some terms that they want to see us achieve, which, by the way, would be difficult. This is a year before they'll own the company. In addition, under their offer, we have to cancel the spinoff of Discovery Global, which is likely going to take place in about 6 months. And that also is long before they would own the company. Now, the spinoff of Discovery Global is important because it provides a lot of optionality, including M&A and possible consolidation. And everybody can see that might be logical in terms of platforms like Versant and Discovery Global. We wouldn't be able to do that.
So it doesn't matter if Peace Guy comes back with an offer of $35, you would still think it would not be sufficient or verifiable.
Well, again, you have to see that every single term, every single condition. You can't judge that in advance. I can't. Yeah. But again, in a situation where a $15 million company trying to do a $108 billion deal. The critical question, if you're on the sell side, is, apart from price, of course, is the financing secure?
My guess is that you are out today, just like Sam DiPiazza was out yesterday, to try and persuade shareholders of Warner Brothers Discovery of this, because they're now going to be asked to vote on what they want to do if they want to tender their shares. And I will tell you, I spoke with Mario Gabelli yesterday, who does own, I think, about 7 million shares of Warner Brothers, and his thing is, hey, this is still on, there's a lot to play out, he just wants more money. What do you tell shareholders like Mario and others?
Well, first of all, by any standard, Becky, it's going to take a long time to close this, because anyone who, Netflix, for example, requires global antitrust approval. An optimist would say that's going to take 12 months. I think Peace Guy has said 12 to 18 months. So this can't be closed for quite a while.
So in other words, you don't have your money. You're not getting it anytime soon.
It's going to take a while. But contrast what I was just saying on the 15 billion and the 108 and the secure financing to the Netflix agreement. Netflix has a $400 billion market capitalization, has an investment grade rating, and is providing us three components of value: 23, 25 in cash, 450 in Netflix common stock, subject to a 10% symmetrical collar or downside protection, and the so-called stub value, or the value per share of Warner Brothers Discovery of Discovery Global, the spinoff. And the street is all over the place on the value of that. Some say it's as low as 1, some say it's as high as 4. But it's a very good offer. And unlike Peace Guy, if for some reason Netflix didn't perform under the merger agreement, they failed to close, we can sue Netflix for specific compliance. Peace Guy says we can't do that in their case.
The question of the stub value has been brought up too. We had Rich Greenfield on yesterday who said, hey, it may be even more than $3 because you've got a bidder on it already. You mentioned Versant as a potential bidder, or someone who would be teamed up and partnered with that. Are they Company C?
I'm sorry?
Is that Company C who's given a bid already on some of those assets?
Well, the materials talk about Company C. And you'll have to see once the spinoff occurs, because the Warner Bros. Discovery wants to do the spin and intends to do the spin. But it's so logical that there would be consolidation among these cable network platforms that's part of the upside associated with UG Global. And whether it initially trades on the basis of anticipated M&A, I'm not sure, but there's a lot of upside there.
It seems to me that as a negotiator, you would want Paramount to come back with a higher bid, or you want a third party to show up at the doorstep. But the things that you're saying make it actually even harder in certain ways, because it sort of suggests that actually there is not another bid out there, and that actually for Peace Guy to come back, they would have to be doing a lot of things.
Well,
and I only ask that because I think right now in the marketplace, if you look at where the stock is trading on an arbitrage basis, there is an expectation that Peace Guy comes back. But it sounds to me like, given the things you're talking about, the hurdle is actually even higher than maybe the public understands.
Well, to start with the biggest issue, which is that they have to provide legally binding assurance that they have the financing. Now, that's not that hard to do.
Yeah, if you have the backstop,
You're suggesting that these other items.
The value of Larry Ellison's stake in Oracle is down 50% from the high in 3 months, right? So if you have this long process, does that come into play where you're like, what do we know about where this asset ultimately is going to be backstopped?
Well, look, if you just step way back and you look at the value of his Oracle shares, even when down that much, and the equity required for this deal, you say to yourself, well, just do what Elon did.
Yeah, he could do it.
Just guarantee it.
Yeah.
I don't know why he hasn't been willing to do that. I don't know. But that's an obvious issue here. Now, Andrew, there are other issues, but they can cure those. There's no need for them to tell us that they have to approve our bridge financing. And there's no need for them to say, for example, these series of interim operating covenants where they want to be very micromanaging in terms of how we run our business in the interim. There's no need for that either. I mean, they could cure a lot of that, but we have a signed merger agreement with Netflix. It stipulates, as most of them do, a very precise set of criteria under which someone could judge that there's a superior proposal. It's not a cavalier type of thing. Right? A board has to come to the conclusion that another proposal would, I think the legal language is or would likely lead to a superior proposal. But again, stepping way back, these shares, as you know, were trading, I don't know, around $12 6 or 8 months ago. Now, there's a $30 agreement from Netflix, and that's a pretty impressive result. So my impression is that the Warner Brothers Discovery shareholders are thrilled so far, and they ought to be.
Roger, thank you for coming on. As you mentioned, this is probably going to take a while, so we'd love to have you back, talk more about it.
My pleasure. Thanks for having me.
Thank you.
Okay. Coming up, we're going to talk tariffs with U.S. Trade Rep Jameson Greer. We're going to do that next. Plus, we're counting down to the 8:30 a.m. CPI inflation data report. That's coming right up on Squawk Box as well. And later, Steve Schwartzman. We're coming right back. Welcome back to Squawk Box. United States Trade Representative Ambassador Jameson Greer has issued a warning to the EU over discrimination against U.S. tech companies and is now threatening to penalize EU tech companies in return. Ambassador Greer joins us this morning. Good morning to you, sir. Where does this stand? And just so we understand the various chess pieces here, what kind of leverage do you think you have to actually effectuate this in the EU?
Well, good morning. Good to be with you. There are a couple of things. First of all, the EU itself knows that it lags on innovation. we had the EU put out the Mario Draghi report a year or two ago, talking about how what a lack of innovation they have and high regulation. So there's incentive on the EU side. On the U.S. side, there are a number of types of investigations that we could conduct to look into this and potentially take action. President Trump's been talking about this for several months, so this is not a new issue, unfortunately. And even before that, we've been dealing with it for years.
So, but in terms of what happens next, and assuming the EU says talk to the hand, which they could, are we talking just about fines? Are we talking about a different tariff regime? How are you thinking about this?
So this past summer, we issued a joint statement with the European Union on a variety of topics. One of those topics was about having fairness and non-discrimination in digital trade. I was in Brussels a couple of weeks ago, and I spoke with counterparts over there, and several of them just really refused to engage on this topic. I'm happy to engage with them. The United States is happy to engage with them. We've been trying for many years to do so, and they've not been responsive. So we have tools like Section 301, which is an investigatory tool that is designed to have a negotiated outcome. I don't think we're in a world where we want to have some, renewed trade fight or something with the EU. That's not what we're talking about. We want to finish off our deal and implement it. But this is something that's really important, and we need to deal with it. We need to deal with it quickly. It'll be better for the EU and for us to have it resolved.
One of the things I wanted to ask you about was the president spoke, obviously, to the American public last night and talked about the $18 trillion, I think was the number he used, of investment pledges made into the U.S. as part of some of these tariff transactions or tariff deals with various countries. And I think the American public wants to understand the math behind that, because $18 trillion is an extraordinary amount of money. You look at some of the countries that have made these pledges, it's close to their entire GDP. Over what period of time should we anticipate these deals actually coming to fruition? And I should also just mention that Bloomberg had done an analysis of this and suggested that, in fact, there were closer to only really $7 trillion, which, by the way, is still an extraordinary number, but in terms of measurable deals that we should be thinking about.
Well, remember, the deals, they really have a couple parts to them. One is the investment headline numbers that you're talking about, which are really important. It's helping to reindustrialize America, and I'll talk a little bit about that. And the other part are what I'd call the pure trade issues, where they're opening our markets to us. They're taking their tariffs down. They're removing their non-tariff barriers. And on that part, a lot of that is already in progress or going through legislatures in foreign countries. On the investment piece, this past week we saw a new zinc smelter be announced by a Korean company. We have the Koreans talking about more shipbuilding in the tunes of hundreds of millions of dollars and billions of dollars. We have the Japanese companies like Hitachi and others building. So we see a lot of progress on that front, and we're going to be looking at it over the life of President Trump's term on the investment figures.
Right. The other thing that I think we're all waiting to hear from is the Supreme Court about what they ultimately think of these tariffs and whether they're going to either strike them down or try to change them or something else. What kind of preparations are you making behind the scenes right now in that regard, and what are you hearing from various countries around the world?
So remember, the president has been focused on the tariff program for many years. And so even before Inauguration Day, we had a number of plans of how to implement tariffs, and the president ultimately appropriately selected that using his emergency authorities was the best, because we could move quickly and flexibly to respond to the emergency of offshoring and the deficit. That being said, at that time, we also had other options for the president. We have tools under Section 301 to deal with specific unfair trading practices and use a tariff to combat those. We have Section 232 tariffs that are in place and aren't challenged. So tariffs are going to be part of the policy landscape going forward, regardless of what happens. Pretty confident about the case, by the way. We laid out a pathway for success for the Supreme Court to find for the government, but we have plans if it goes the other way.
Ambassador Greer, the notion of using tariffs as a means to negotiation and opening up other markets and reducing trade barriers from other countries perhaps seems not to apply directly to China, where it seems like it's a little more of a managed disengagement. It doesn't seem like they're lowering really trade barriers to U.S. Imports into China. How do we think about the state of that relationship and where it's going?
Well, first of all, President Trump and President Xi have both put a premium on maintaining their personal relationship and having discussions at their level. So they've had meetings, they have calls, they write letters, and they'll meet again in April. That being said, the Chinese economy and the U.S. economy are quite different. They don't fit together quite neatly, so we have to manage the way they interact. To your point, there are a lot of barriers and things structurally in the Chinese economy that are, it's part of the nature of them being a communist country. They're not going to sign a paper that says, I'm not going to be communist anymore. But what we can do is try to have the right outcomes where they're buying goods and services from the United States that they should be buying, right? Airplanes, medical devices, agriculture, soybeans, sorghum, etc. And there are things we can buy from them too, consumer goods, low-end tech, and other things like that. But we want that trade to be balanced, so it does require some management.
Ambassador, I want to thank you for joining us this morning.
Thank you very much. Have a good day.
You bet. Happy holidays if we don't talk to you before Christmas. Thank you again.
Thanks.
Meantime, it is just past 8 a.m. right now on the East Coast. You're watching Squawk Box on CNBC. I'm Andrew Sorkin along with Mike Santoli. Becky's going to be with us again in just a moment. She's making her way over to Blackstone's headquarters right here in New York for a big interview with that company's CEO and co-founder Steve Schwartzman, the legend that is. She'll be joining us a little bit later in the hour with that conversation with Steve.
All right, we are less than 30 minutes away from inflation data from October and November. Steve Leisman joins us with a preview of what we can expect, what it means for the Fed.
Oh, yeah, what we can expect. This is going to be, Mike, a unique inflation report that's going to lack some key details as the result of the government shutdown. Raise questions about, hey, just how good a guide is this to what's happening with prices in the economy right now? A couple things we're going to lack here. No overall month-to-month change. So what we'll do is we'll calculate a 2-month average. That'll be accurate, I guess. Only limited data from October if, some places not going to have it at all. And the November data collection only began mid-month instead of happening over the full month. That mid-month start raises the question whether inflation could be understated if it picked up the beginning of the holiday shopping discounts in the second half of the month, but missed the higher prices earlier in the month. Economists at Nomura saying, quote, core goods inflation appears to have remained solid due to the lingering impact from higher tariffs and rent owners' equivalent rent probably rebounded. Here's the numbers that the street is looking for. An average 2 month was 0.3% month over month. Was 0.3 in September, and the core 0.3 up from 0.2. And there's that 3.1% number that we keep hanging around, and we can't really get beyond it. It's the number that I guess is the debating point right there. While some Fed presidents are troubled by the idea that we're still at that 3% number, showing inflation running above the 2% target, several top officials like Governor Waller I talked to yesterday have justified these rate cuts by insisting tariff inflation is going to come down, and the weak job market, guys, is what needs attention from the Federal Reserve. Tomorrow, we're going to put this number, these questions to a leading Fed official. We're going to talk to John Williams tomorrow, right here on Squawk Box at 8:30. A traditional interview we've done every December.
Yes.
With him for many.
It's always a goodie. It's always a goodie.
I mean, I've been struck by the way, for really a year, the market has kind of treated inflation as, sure, persistently elevated, but not an emergency and almost like not today's problem. If you just look at how, not just market-based inflation expectations, but just how the market reacts to, all the different inputs related to growth and inflation.
It is extraordinary, Mike, because what you're also saying, the other side of that comment is the market is not demanding inflation compensation.
Yeah.
And it's something that you would do. There's a couple of things going on. One of the commentaries I read, maybe this was Andrew Bremer, I can't remember who it was, who said the market is afraid to bid yields higher because of what it thinks the Treasury's going to do. They think that there's going to be some operations out there that will push down the 10-year, so it doesn't want to get too far. It looks like the 10-year has this 420 top right now that it won't get beyond. I agree with you. It looks like the market has bought the view that tariff inflation will come down. I think there's also this Fed credibility thing out there that the Fed will take care of this eventually.
They know how to do that.
And so over a 10-year horizon, I don't require full compensation. The 5-year forwards of the market-based are up a little bit.
Yes.
Quarter, 35 basis points, but not the full percentage point. You're absolutely right, and that's a great observation.
All right. See how it goes in a little bit. Thanks, Steve. Coming up, reaction to the president's address to America last night from House Minority Leader Hakeem Jeffries. From healthcare to the state of the economy, we'll cover it all. Squawk Box, right back.
I want the money to go directly to the people so you can buy your own health care. You'll get much better health care at a much lower price. The only losers will be insurance companies that have gotten rich and the Democrat Party, which is totally controlled by those same insurance companies. They will not be happy.
Okay, President Trump addressing the nation last night, defending his economic record and outlining plans to fix health care. Joining us right now is House Minority Leader Hakeem Jeffries. Good morning to you. You heard the president last night. He says the Democrats are in the pockets of the insurance companies and that the price of your health care is actually going to go down under his plan. What say you?
Well, good morning. Great to be with you. The Republican health care crisis is devastating the American people, and Donald Trump has zero credibility on the issue of health care. This is the party that has enacted the largest cut to Medicaid in American history in the same bill where they enacted massive tax breaks for their billionaire donors because of Republican policies in the one big ugly bill. We know that hospitals, nursing homes, and community-based health centers are closing all across the country, including in rural America. Republicans have launched an all-out assault on the Centers for Disease Control, the National Institute of Health, the Food and Drug Administration, on vaccine availability for children, and now Republicans are refusing to extend the Affordable Care Act tax credits, which means that tens of millions of Americans, working class Americans, are about to experience dramatically increased health insurance premiums. We are working hard to decisively confront this Republican health care crisis and fix our broken health care system.
Leader, let me ask you this, and I recognize the complications of and costs to the American public. There is a question, and maybe you'd say it's a longer-term question that has to be dealt with later, but the true question ultimately underneath all of this is how we're going to actually lower the costs of health care in America. And when I say lower the cost, not just lower the cost for individuals, meaning in the moment subsidize it, but how we actually change the market dynamic at play and whether what you have proposed even tries to address that at all or frankly exacerbates it.
What we've proposed at the moment relates to the fact that the Affordable Care Act tax credits are going to expire on December 31st. And no one disputes that if that happens, tens of millions of Americans are going to experience skyrocketing health insurance premiums, in some cases increasing by $1,000 or $2,000 per month. And 90% of the people who rely on the Affordable Care Act tax credits make around $63,000 per year. These are working class Americans, everyday Americans, and middle class Americans. And so we've got to make sure that we don't allow these tax credits to expire. At the same time, you raise a very good point, Andrew, that the healthcare system is broken and we need to fix it. We want to fix it in a comprehensive way, in a bipartisan way. But that actually requires Republicans deciding to abandon their my way or the highway approach to everything, which is what has led to the extremism that they're jamming down the throats of the American people, and the fact that everyday Americans, voters, are rejecting that extremism, as we saw in the off-year elections last November.
Leader Jeffries, you mentioned that the vast majority of those who use the supplemental subsidies for the ACA are, well below, kind of the wealthy thresholds that the Republicans are talking about, which is 4 times the poverty line. Is that in play in terms of a negotiated agreement here? They keep talking about that as maybe a sticking point. How does your party feel about simply having an income cap for these subsidies?
We have a bipartisan coalition right now that supports, in the House of Representatives, that's every single House Democrat and at least 4 House Republicans, supports a straightforward extension of the Affordable Care Act tax credits. Time has run out. Republicans have had all year to deal with this issue and have chosen not to do it because they were focused on passing their one big ugly bill, which they enacted with great urgency months ago. The largest cut to Medicaid in American history, the largest cut to nutritional assistance in American history. They literally ripped $186 billion away from SNAP. That's food from hungry children, hungry veterans, and hungry seniors. And why did they do all of that? So they can enact massive tax breaks that they made permanent for their billionaire donors and skyrocketed the debt by over $3 trillion. And now, at the 11th hour, time has run out. And we've got the votes to pass a straightforward extension and send it over to the Senate. Mike Johnson needs to make sure we vote on this legislation today. The House should not recess or adjourn until this issue has been dealt with.
What is your expectation? You say you have the votes. You'd mentioned the 4 Republicans that have come on over to join you. And then the Senate seems like it's kind of a no-go no matter what. So, I mean, what are we looking at come next week?
Well, what's interesting about the Senate is that there are a majority of U.S. senators, Democrats and Republicans, who've already supported, in the vote that took place a few weeks ago, a straightforward extension of the Affordable Care Act tax credits. And so once we send the bill from the House over to the Senate, then the Senate can negotiate a path forward that enables them, hopefully, to break the filibuster and get something done for the American people. We can work on this issue in a bipartisan way, as has now been demonstrated in the House of Representatives. We do need some presidential leadership. Part of the issue is that Donald Trump still seems to believe that the affordability crisis is a hoax. In fact, he said that repeatedly. Costs haven't gone down in this country. Costs have gone up, despite the fact that Donald Trump did promise, his words, not mine, that costs would go down on day one. Housing costs out of control, grocery costs out of control, electricity bills out of control, healthcare costs out of control. Action needs to be taken in all of these areas. We're prepared to work with our colleagues on the other side of the aisle. We just need good faith and Republican leadership.
Talk about costs getting out of control. You mentioned healthcare. Interestingly, you look at employment in America over the past year, and actually it is the healthcare industry where so much of the employment has come from. What do you make of that?
Well, listen, I think we've got to take a look at the economy as a whole and all of the individual sectors. In this country, fundamentally, here's our belief. You work hard, you play by the rules. You should be able to live an affordable life, a comfortable life, live the good life. And to me, that's good paying job, good housing, good health care, good education, and a good retirement, which means the extremists need to keep their hands off Social Security and Medicare. That should not be too much to ask for in this great country of ours, the wealthiest country in the history of the world. So, listen, we support the notion that economic growth that moves in a positive direction is good for everyone. But we've got to make sure that this fundamental principle, hard work paying off, playing by the rules paying off, and the American dream being brought to life is actually realized and revived, because far too many people understandably have concluded, I'm talking about working class folks, middle class folks, that the American dream is out of reach. As we approach our 250th birthday, that's a shame.
Leader Jeffries, I have maybe a curveball of a question, but we just talked to Jameson Greer. It's something that I think is on the mind of a lot of folks who are watching this broadcast now as it relates to tariffs. A lot of folks waiting to find out what the Supreme Court has to say about the tariffs that have been implemented by the president. I believe you have come out strongly against those tariffs. There's a real question, though, about whether, if they were struck down, whether the court could force effectively the U.S. government to give back the $200 billion that has been collected in tariffs, and how that could re-scramble the economy. And I'm curious what the sort of Democratic position would be on something like that.
Well, the implications of the Supreme Court striking down those tariffs, I think, have to be evaluated. Our view, as you indicated, Andrew, from the very beginning, is that the president has violated his authority. He doesn't have the emergency authority to implement this random, massive tariff scheme that's imposing thousands of dollars of additional cost on everyday Americans, which is why the American people reject these tariffs. I think that if the Supreme Court strikes down these tariffs, then Congress should come together in a bipartisan way and figure out the path forward. Anchored in the reality is what's best for the American people, what's best for our companies and our corporations, what's best for the economy, to ensure that we can continue to see American exceptionalism prevail.
Leader Jeffries, I want to thank you for joining us this morning. I want to wish you happy holidays if we don't see you before the break next week. Thank you.
Happy holidays. Thank you.
You bet.
The European Central Bank is out with its latest interest rate decision, leaving interest rates unchanged. That was the expected outcome, and it comes just an hour after the Bank of England cut rates by 1/4 point. That likewise was expected. You see relatively muted market reaction there. Most of the European index is up just slightly, while the FTSE in the UK is down small. Still to come, Southwest tapping 2025 Word of the Year for a limited time deal. That is next. And then inflation data, jobless claims, and the latest Philly Fed survey. And later, Becky will rejoin us with an exclusive interview with Blackstone's Steve Schwartzman as the firm marks its 40th anniversary. Squawk Box will be right back. Welcome back to Squawk Box. The futures right now indicating some gains. The S&P 500 up 28 points. That's just a little under half of 1%. The Dow looking for about a 97-point gain. The NASDAQ is where the strength is. It is down the most from the highs, about 200 points. Micron's earnings and the reaction to those results last night seem like it's going to bolster the semiconductors at the open.
Meantime, we got some deal news, and this one's interesting. I think we're all still scratching our heads a little bit trying to make sense of it. The Trump Media and Technology Group announcing plans to merge with TAE Technologies. It's a fusion-powered company. It is backed by Alphabet's Google and Chevron, and it's an all-stock merger valued at more than $6 billion. And upon closing, Trump Media will be a holding company for its current portfolio of media brands, including Truth Social, and then as well as the power brands owned by TAE. So you're looking at sort of a conglomerate of sorts. I think there's an argument to be made that to the extent you think that Truth Social or Trump Media stock was overvalued, here's an opportunity for them to use that stock to buy another company, that private company, sort of a Trojan horse to take that company public in some ways.
And, I don't know. I mean, I would think of it as, well, first of all, Trump Media is also kind of, sort of pivoted toward crypto and said they're going to do payments and asset management, other things. It seems to me this is exactly the type of alternative energy play that has excited parts of this market, right? It's nuclear reactors in space, all this other stuff that, you get this kind of pie in the sky type of potential energy source. not a lot of fundamentals, if any, right now, and it makes for a perfect way to harness some of that investor energy and kind of change the character of the stock and the story behind it.
Right, so it's a shift.
Yeah.
We're going to probably have to do some digging to understand more of some of the personalities behind it, why they would do this.
Why this particular?
Well, the other flip side is, if this company has so much promise, backed by Google, backed by Chevron, why go public this way? Meaning, why not go public on your own?
Well, 6 billion in shares that are now up 28%.
Well, but that's the question. Is that the answer? And by the way, do they stay there?
Yeah.
It's an interesting approach.
Many questions for sure.
You bet.
All right. Eli Lilly releasing data this morning from a late-stage study showing its new obesity pill helps patients keep up with their weight loss when switching from the injection Zepbound and Novo Nordisk's Wegovy. Lilly has filed for approval for the GLP-1 pill from the Food and Drug Administration. The company says the pill isn't as effective in helping with weight loss as the injection, but will help maintain weight loss without having to take the injection on an ongoing basis. Shares of Eli Lilly are flat this morning, but up 35% in the past 3 months. The stock hit a high November 26th, has since dropped about 7%. There's a lot more on this breaking story on CNBC.com right now.
Okay, meantime, Southwest Airlines jumping in on the 6-7 trend. And when I say 6-7, for those who have kids, 6-7. You know about the 6-7?
Right.
The airline offering $67 basic economy fares on select Tuesday and Wednesday flights between January 6th and March 4th, calling it the trendiest sale ever. The deal running through December 18th applies only to flights within the continental U.S. So 6-7. I have children who say this to me all the time.
Yeah.
6-7. They do this. They do. Do you know about this?
I know about it, but I'm a little beyond it.
Do you even know what 6-7 means?
Well, apparently it kind of doesn't really mean much.
Doesn't mean anything.
It's like very obscure origins.
See, I thought 6-7 was like meh.
Right.
Sort of, because between 6 and 7 would be like a 65.
Right.
And that would be
Just
sort of
mediocre.
Like mediocre, meh, 6-7. But apparently I'm told that is not the case.
Right. Right. The meaninglessness is the point in a way, I think. It's just viral. So, but I mean, once the company starts to seize on it, you have to imagine it's running its course.
The trend
among the kids
is late.
So, all right, up next, inflation data and weekly jobless claims. The numbers and market reaction are next. As we head to a break, a look at this morning's pre-market winners and losers in the S&P 500. Be right back. We are just seconds away from weekly jobless claims, October and November CPI, and the Philly Fed manufacturing survey. Take a look at how markets are set up ahead of time. The equity index futures are solidly positive. Had a rough run. S&P 500 has been down a few days in a row, but it's up about 30 points, less than half of 1%. Dow up 107 points, and NASDAQ indicated higher by 214. Take a look at treasuries. Been kind of hovering in this area for a little bit. You see the 10-year at 412. The highs recently have been about 418, 419 thereabouts. 2-year yield at 346, so that is a little bit lower. Steve Leeson is going to have the numbers for us when they do break, and it is an unorthodox release. We have CPI for 2 straight months. We're going to have to make some modifications in terms of drawing conclusions as to what they mean, but we'll be glad to get some delayed data nonetheless.
Yeah, here we go. We got jobless claims just coming straight across here, falling to 224 in the week of December 13th from 237. That was revised up from 236, so not a big deal. Let's see, 4-week average rising to 217, because remember we had that big low number from Thanksgiving, so that was a seasonal problem, I think. Continued claim rising to 1.897 in the week of December 6th. That's below consensus, and it is up from 1.83 the prior week, but still not at 1.9%. Now, the number of the morning, the CPI, maybe coming in a little bit better than expected. 2.7%, a little light here. I'm just reading the headlines here. Year over year, 2.7. Ex-food and energy core, 2.6. So 0.4 off. That is a very good number here. And it really, I have not looked at the internals. I'll look at them now, but it suggests that the internals are good as well. Let's see, year over year, over the last 12 months. There is no month to month, but some guys will be able to calculate. Seasonally adjusted index for all items on food and energy rose 0.2% over the 2 months. So, correct my math here, Michael Santoli, but 0.2 divided by 2 is 0.1.
Yeah.
So therefore, that's a very, very low monthly rate here. The index for shelter increase, so you did get a really nice decline in shelter, which was 0.2, so that was 0.1 per month. Energy index rising 1.1%. Over the same 2-month period, and what's good about that is energy prices have come off.
That's right.
And so the December numbers are going to pick up a better number here. Let's see, the all items index.
Oil has come off.
Oil has come off. I'm going to go and find right away here. All items less food and energy, that's the core, 2.6, so that's a very good number. With a big rise in like gas services up 9.1%, electricity up 6.9%. This is the year over year rate. I don't have a month to month on that. Shelter up 3% year over year. I'm looking for goods, but I got to go to another table for that. Why don't you? You have some guests there.
We do,
and I'll fill in the gaps in my knowledge over that period of time.
And markets did get a little bit of a bid. The equities did extend their gains. As you see, the S&P up now about 40 points, and the Dow higher by 175 versus 100 from before those numbers. Let's bring in our panel. Joining us now, Brookings Institution Economic Studies Senior Fellow Wendy Edelberg, and American Institute for Economic Research, Monetary Economics Managing Director Lydia Mashburn-Newman. Welcome to you both. Wendy, I mean, I know you haven't kind of been able to dig into the guts of this report, but it seems like a pretty benign reading. How do you feel about it?
Yeah, it's frustrating because they haven't even posted the information that I would need to really parse all of this, given the confusing way they've displayed the information. But the important number is the year-over-year change in the prices of core goods, and that was 1.4%. And that may not sound like a lot, but this is a category that in normal times has negative inflation all the time. And this is where we're seeing tariffs. So I think this is the category where we know that tariffs are having, in some ways, the absolutely expected effect on inflation.
Yeah, so for that subcomponent of inflation where you would be able to isolate perhaps the tariff effect, maybe we are seeing it, although Lydia, I guess not necessarily feeding into, by this number, a broader lift in CPI.
The headline number definitely seems to be a step in the right direction, coming in at 2.7 year over year. We should keep in mind, though, that that's on some higher inflation numbers that we saw with the Federal Reserve's last rate hike cycle starting at the end of 2024. So we would expect these upcoming readings from November and then December and January and February to look a little bit better because their relative year-ago comparison was also relatively high. But as Wendy was saying, those goods prices are definitely an indicator of inflation showing up in tariffs showing up in inflation. But we still need to keep an eye out on services inflation. While we have seen housing come down a little bit, services are still elevated, and that is a monetary issue. That is related to the Fed's monetary policy, and so we do still have some pent-up price pressures from both the Fed's last rate cutting cycle last year and even some overhang or maybe hangover from their post-COVID policies.
Wendy, given that we are able to, identify perhaps this tariff effect in core goods, what does it mean on a forward-going basis? Because you do hear some folks who are kind of, inflation doves who are essentially saying we're going to, anniversary the initial tariff effects and it kind of will come out in the wash. So what's your expectation for how inflation tracks from here?
I don't think we've seen the last of the tariff effect by any stretch. I think we're only seeing a modest part of it so far for a whole bunch of reasons. One of which is that we, firms hoarded inventory ahead of the tariffs and are probably still working through that. So I think tariffs are going to continue pushing up inflation through 2026 and maybe even into 2027. And then at the same time, by my reading, the labor market is just a tick soft. I think that the monthly payroll employment gains of around 20,000 a month are just slightly below what my estimate is of the break even, given what I think immigration is doing to labor supply. So what all that means to me is I think we have more inflation in train, and I am very, very puzzled by market expectations. Markets right now are expecting the next Fed chair put in place by President Trump to cut by a sum total of 40 basis points. My guess is if that came true, President Trump would be incredibly disappointed in his Fed chair pick. So I think we're in for lower interest rates, higher inflation.
Yeah, I guess we'll see if the markets try to maneuver ahead of that and price that in. It doesn't really seem to be happening yet. But Lydia, you did mention that you think services inflation is to some degree a monetary phenomenon. So an outgrowth of somewhat looser Fed policy. Where do you think the neutral rate is? What are we heading toward in terms of where the Fed's going to land?
Yeah, so the neutral rate is a bit all over the place right now. We have estimates that are really low, some below even 1%, and then you have estimates more in the 2.25%. But I do think we're also, to Wendy's point about the labor market, that natural rate may be shifting a little bit. In my opinion, I think there is something happening in the labor market where we're having some shifts. I'm not sure it's entirely cyclical, and I'm not entirely sure that the Fed can actually solve some of the changes that are happening. I think some of it is also a hiring. We've had a low hire, low fire rate, but businesses are grappling with higher inflation and still looking for ways to find cost savings within their businesses. And you're seeing that, I think, starting to affect employment. And that, I think, is a very serious issue and may potentially change where the natural rate is. And it's something also that the Fed can't do a whole lot to fix. If they are just going to throw money at that problem, which at the end of the day, if we're just being transparent, that's what the Fed can do, it doesn't really fix any of those fundamental changes in the labor market that businesses are having to go through right now, whether due to AI or just trying to find efficiencies on their balance sheets. But at the same time, as the Fed tries to increase employment while we still have a very high and relatively high inflation environment, all it's going to do is continue to push up equities, and it's not going to help small businesses or households at the end of the day.
All right, we'll see if they're in that kind of a fix or not into next year. Lydia, Wendy, thank you very much. Appreciate it. And Steve as well, of course.
Meantime, I'm going to get over to Becky, who has made her way over to Blackstone's headquarters, where she's going to be bringing us a special interview. Becky.
Hey, good morning, Andrew. Good morning, Mike. It's great to see you guys again. Yes, we are at Blackstone's headquarters today on Park Avenue, and the firm this year turning 40. This morning, they're actually releasing their annual holiday video. Take a look.
Well, I was thinking of becoming a DJ.
Steve Schwarzman, a DJ? He'd crush.
A cameo from David Solomon on this one this time around, but the theme this time is, of course, 40 years back to the future. And yeah, you got to check the video out yourself to see all of the 80s retro things that are going on with that. We're going to have more on the firm's anniversary, the markets, and much more. We're going to be sitting down with Blackstone's co-founder, Steve Schwarzman, right after this break. Squawk Box, we'll be right back. Welcome back to Squawk Box, everybody. I am here at Blackstone's headquarters on Park Avenue in Manhattan this morning. Of course, this is the world's largest alternative asset manager, and it's just turned 40 years old in 2025. Joining us right now with a look back and a look ahead is the firm's CEO, chairman, and co-founder, Steve Schwarzman. And Steve, thank you for taking the time to sit down with us.
Well, it's fun for me.
It is fun for us, too. We don't get the chance to do this very often. 40 years since you built this firm. Coming out with $400,000 in capital, where you sat down and kind of branched out into this new and fledgling private equity world that you helped build. What do you think 40 years later, with a market cap of, what is it, just about $187 billion today?
Well, it's been 240 at the top.
Yeah.
So that's been quite a journey, and it's been fascinating, like all entrepreneurial types of enterprises. You don't know quite where you're going, but when we started, we knew we'd be doing private equity. We called it LBOs, and we also knew, besides our advisory business, that we'd be starting new businesses. That was part of our strategic plan. And we were going to go into new money management areas
that we thought would be great for customers, that we also thought we could build into very big businesses. And we've been following the same strategy ever since. It's different than almost everyone else who just said, I'll do LBOs, I'll do private equity. Because I always worried that if you stay in one business, if anything goes wrong with it, then that's not so good. So I like the idea of doing new things. I actually find it fascinating, and it ends up being a great business strategy because the people who work here don't have to get glass ceilings. We're always doing something new. They can move to those businesses. So it's great for people retention and satisfaction. It's great for customers, and now we have such a broad platform that when we talk to an institutional investor, for example, it's really like we can bring you a solution for almost anything you want. We have 85 strategies now. We started with one. Now, it sounds like a lot, and we have almost edging up on $1.3 trillion from 400,000.
The assets that you were holding, right?
But it happens quite gradually. Those are like 2 new products a year in 40 years. So it sounds like we're doing a lot, but we're extremely careful that we only do stuff that's great for customers, great for performance, and if we can do that, they become very happy and they give us more money.
One of your newer businesses that you announced last year you would like to be the biggest in is being an owner of data centers. That's been a huge move, and obviously it's been driving major markets higher, driving the averages higher. But there are some concerns about AI in general and data centers in particular as well. Yesterday it was news about an Oracle data center in Michigan and Blue Owl Financing no longer being involved with that. Your name was one of the ones mentioned as a potential financer for that particular project. What can you tell us about A, that project, but B, maybe overall, where you see data centers and where that's headed?
Well, AI is, as you know, Becky, because you covered in 2018, 2019, a gift I made to MIT to start their College of Computing for
artificial intelligence at the time. That was a big deal, but you were far ahead of your peers and where everybody else was.
And that was way before, ChatGPT.
Yeah.
And so we saw that there would be a new world being created by artificial intelligence, and it's a bit like Thomas Edison inventing the use of electricity in the 1880s with the electric light bulb. And that's sort of what's happening now. And you need the data centers to create the use of artificial intelligence. And so we could see there be an explosion in this area. And we bought a company called QTS.
$10 billion purchase.
For $10 billion in 2021. And it's now 14 times the size in 4 years.
So what do you tell people, though, who say we're at a bubble in AI, we're at a bubble in data centers? Do you think that's the case?
Well, I think what's happening is that we've got rapid expansion. It's being done principally by 5 or 6 companies. Almost all of them, not all, are great credits. And so what we do is quite simple in a way. We're the largest in the world building data centers, and we're the largest owner of data centers. But it's very conservative, picks and shovels type business. And what we do is we build these enormous facilities, and basically Jensen Huang fills them up with semis, although other people are doing it now, and they sign a lease with us to lease that building for 15 or 20 years. So we have AAA, AA credits. This is not bubble type work. This is extremely conservative. Now, the whole field is exploding with growth, so there are new people entering. There's some people whose credits aren't as robust. And so you'll have some problems, like you always do at this type of thing. but we will power through this. And there's going to be a profound change in the world looked at 5 to 10 years from now.
Steve, let's talk a little bit about private credit too, because that's another area where Blackstone has excelled. There have been some issues that have popped up, bankruptcies that showed up that people said, oh, this is a problem with the private credit markets. I think you've had a different view on that.
Well, those bankruptcies that showed up, there were 3 of them, happened to be done by the banking system, not by private credit. Private credit's been around for quite some time. We've been doing this for over 20 years, and the results have been terrific for the investors, for the companies, and for the overall system. It's much more conservative, very lowly leveraged extension of credit compared to the banking system that's leveraged 10 to 1 or less than 1 to 1. And instead of taking deposits, which people learn in Silicon Valley Bank when they want their money back, that could be a problem. We're match funded. So people can't get their money back if it isn't appropriate in terms of timing. So we have a very safe business, and it yields about 200 basis points more than leverage loans. And so it's growing rapidly, and for customers who borrow from us, they just deal with us. They don't have to syndicate their products. It's much faster. And instead of having a range of cost, we tell them exactly what they'll get. And as a result of that, we're the largest in the world doing this, and we've had great results. And stuff that's in the press recently is really quite excessive and doesn't reflect what's going on.
In terms of questions about private credit.
What's that?
You stuff in the press in terms of questions about private credit.
Yes. We look at it and say our results are going along quite consistently. So we anticipate good outcomes for customers. It's a very safe business, and sometimes when I read these inflammatory statements, I go, how is that occurring? So I think every once in a while we hit a public relations issue. You power through it with your results, and then we go back to business just the way it was.
When we were sitting down just a moment ago, someone walked over to you, showed you their iPhone, and you went, whoa. I asked what that was, what you were reacting to. It was the CPI data. It was much lower than most people had anticipated. Not lower than you were thinking, but you're finally seeing the print of what you've been talking about for a time, that inflation is less than the numbers are kind of showing.
Yes, well, we've been quite public. When you go public and say things are going a different way than the rest of the world, I guess you're at some intellectual risk of some type, but we understood that the real estate component, which is about a third of CPI, was being measured in a way that was inconsistent with what we were seeing happening on the ground. And even still, the numbers that are being used as part of CPI are still much too high in real estate inflation. And if you adjusted it, we're actually quite close to 2%. And so I think the Fed has, in effect, done its work. And I look forward to other cuts now because they have 2% as their target, and they're really very, very close to that. So it's not really 2.7 the way we look at the numbers, and we've been right.
What do you see in the actual the real estate portion of CPI? What do you see, at least in your numbers?
Well, if you look at, in effect, what is happening in apartment rents and so forth, I think they're saying the whole category is like 2.7, and we're seeing it like at 1.2, for the whole real estate area, and that's a third. So that gets you much closer to the 2% number. And the way the Fed measures, they actually get to that number but it takes them 9 months to a year. And we live in the real world where you have to get there right away. So I think there's reason for optimism here. And that division that the Fed had, that at least was reported, I would anticipate there won't be much division in the future.
Steve, you are someone who has been close to the president, President Trump, in his first term and also in the second term. It's been reported that you're helping negotiate a settlement with Harvard University. We've even heard that you have told him a little bit about what you think about the potential for a next Fed chair. Do you tell him what you think in terms of inflation and where things stand and whether the Fed should be cutting rates at this point?
Well, I always tell people who ask me, except major television figures, where I can't just say certain things. When people ask me, I tell them what I think. I found that to be a simple way of dealing with people, and they expect you to do that. So I give feedback when I'm asked.
Yeah. And has he asked you about these things? I would imagine he has.
I can't tell you stuff like that, Becky.
I understand. I understand. Let's talk a little bit about China, because you are somebody who has been a China booster for a long time and making sure we have a relationship with China, but I think you've also had some concerns about where things have headed, just in terms of our relationship with them and what we get back from China too. Where does that stand right now, that relationship between the two superpowers?
Well, China and the U.S., just to set a stage very quickly, have about 42% of the global economy. People don't typically understand how dominant these two countries are. And so it's essential that they have a functional relationship, given the impact on the world of not doing so. And so we had a bad period during the previous 4 years where China ended up, as a result of that, becoming an ally of Russia, which really changes the geopolitical balance of the 21st century. And I think the good news is that after a lot of breaking apart, when threats, if you will, over rare earths and what that'll do to the Western economies, I think that both China and the U.S. have looked at that and said we really have to lower the temperature. This is not functional for us as countries or for the world. And so they reached an agreement to basically take a number of the issues that were concerning them and pushing them out for at least a year, if not more, because it's easy to push things out. You can just have a meeting and say, what do you think? Let's push them out. They pushed them out. And that was a good job done by the president and then by Scott Bessent. And I helped him out a little bit too. So they've agreed on at least 2 meetings, maybe as many as 4, between the 2 presidents. Now, that's a big symbol in China. The idea of having meetings between heads of state means you don't do anything to inflame things in that run-up. And in the original discussions, I guess it was about a month ago, they talked about as many as 4 meetings. Well, that won't give you any opportunities to really have difficulties, and there's much more of an open dialogue now. And so I think for global stability, that's a very good thing.
We are almost out of time. I wish I had much longer to talk with you because I've got a million things I'd love to talk to you about. But while you're here, before we run out of time, can you tell us where you see your take on the U.S. economy? You've got over 200 businesses that you own and manage at Blackstone. What's your read on things? Where are we?
The U.S. economy is doing pretty well. The data center AI expansion is really unique to America, unique to China, and it's pulling our economy along. I see pretty good times ahead. It's a little soft, with some of the sort of lower income people, which has to be dealt with. But 80% of companies last quarter exceeded S&P estimates. Our businesses are growing at 9% revenues. That sounds like a pretty good number because we have roughly 275 companies and over 250 billion of revenue. And the people running those businesses are quite optimistic. But I would say in closing that we appreciate your relationship with us over the years. You said you've been CNBC for 20 years. That's half of our 40. And so it's fun to deal with you. And it's also a proud moment at Blackstone. All of our businesses are pretty amazing. And we've been a pioneer in every area. And we've sort of shown the way for a different type of company in finance. I'm really quite pleased, but that was yesterday. There's the future. And we never stop innovating. We never stop pushing. We always believe that we have smart competitors, and our job is to stay ahead.
And that is why you've made it this far in 40 years. Steve, we thank you very much. It's an honor to be here with you today. Thank you. Steve Schwarzman. That does it for us today. Make sure you join us tomorrow. Right now, it's time for Squawk on the Street.
Good Thursday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer and David Faber at Post 9 of the New York Stock Exchange. Futures are rallying here on a much better than expected CPI print for November and October. Only 0.2 for those 2 months, and that is the lowest annual read on core since 2021. Markets pricing in a little more Fed cutting for next year, now up to 62 basis points. Our roadmap begins with the latest inflation print coming in cooler than expected. We'll talk about what it means for the Fed and the markets.
Shares of Micron are soaring this morning. The company posted blowout earnings, gave a bullish outlook. It said it expects record revenue thanks to strong demand for AI-related products.
You know it.
And we're also keeping an eye on shares of Lululemon. They appear to be rallying in the early trading here. The largest, biggest activist, Elliott Management, takes a relatively small position for them, but it's a $1 billion stake, and they are pushing for changes at the top of the retailer.
Let's begin with this market reaction to CPI. Shelter carrying an awful lot of water, which is kind of a consensus view, Jim, going into 26.
Yes, you got to go with what Lennar is saying too. Giant home builder dovetails with this. You go to Gemini. You put in Lennar, you put in home prices, Lennar, and you'll see way back, all the way back to 2019, before there was inflation. But this is the 40% inflation in housing, David.
Yep.
Done. Okay, so then you look at CarMax, you look at cars, 8% decline, done. Then you connect the dots with this CPI, and we are almost all the way back to Liberation Day, and the direction is amazing. And then we have a president who was on TV saying, listen, don't worry. A little late maybe, but he's got it. Look at that. Analysis.
Whatever you said.
There you go. I say it here, it comes out here. It's not supposed to be the way it is. Hey, look, we can go right to Sanjay. You rated for not coming on.
You want to just move past CPI like that?
Well, you left me on the track.
I got nothing. What do you want?
Melinda Kramer? What am I doing? I'm like balancing? All right, go where you want to go.
No, I got nowhere to go. I'm following you. Is there anything you want to add about CPI and or our esteemed colleague here?
Well, the only thing I would say is that memory prices are going up.
Well, yeah, I mean, there's going to be wrinkles. We'll get to memory and Micron in a second, but heating costs are going to be an issue. Tough story in the Times today. It's going to cost about $1,000 for the average home to heat their home this winter, and that's 9%. I think energy overall utilities up 13 since the president took office.
There is an oddity. Natural gas is in plentiful supply, even with all the exports. That's an incredible figure, given the fact that we probably have the most we've ever had.
And we're exporting the most that we ever had as well. Of course,
I don't know. I think that the president has to talk about gouging, because that's a natural thing to talk about. Natural gas gouging, and then how we need to have a check cut to the cattlemen so that state can come down. And then he's home free because you got cars, you got housing. You
don't have health insurance, and that is an issue right now in Congress, of course, as well.
And you're talking about
the ACA increases.
Cutting checks to farmers.
Not that many.
The military.
Military, yes, the warrior dividend.
Well, checks don't cost anything. I think that
checks don't cost anything.
Well, I mean, we never see it. It's never in the budget. I'm not being cynical.
Money's coming from
I'm
somewhere.
not being cynical. I'm saying yes, the natural gas. I don't get that at all. I want that investigated. And if you pay the cattlemen, or look, I know you could also get a break from Brazil, but that may be too political. You pay the cattlemen, and then we see steak down, and then the American people are saying, you know what? I'm seeing a real break from the president, and it's so necessary. You don't want to slice the cattle.
So you think next year will be the year of price controls?
Yes, I do.
And you think that's a good thing?
Well, I want balanced price controls. I don't want any particular group of farmers to be disenfranchised. So you cut the farmers a check, you let them go buy Deere equipment, which is made in America. That's fantastic. You get a circular, just like with just like with the information on ag, we get more circular deals, except this time they're from the government.
Oh boy, here,
You-
just 5 minutes.
Lazy Susan?
It took
Yes,
4
Lazy
minutes, but
Susan.
now we're back to the theme.
A lazy Susan with the cattlemen, the price of steak. We gotta get steak down. The reason why Darden did better than we thought, okay,
tell me.
is because that's about salad. Chicken. Like he's been to OG. He thinks the OG means like, kind of like gangsta. No,
I do.
OG is Olive Garden. Look at that.
Oh,
You know what that is? That's because it's chicken.
That's pretty good, yeah. Olive,
That's chicken.
Olive came in. What was Olive's number, Jim? I'm looking for it here.
Oh, my
up 4.7.
Oh, it's just amazing.
Longhorn 5.9. Although it is the third quarter in a row of slowing Olive comps.
Well, we don't care. You have to go be. David. Slowing Olive Garden comps. I mean, come on, look at that chart. That's a chart of America.
That is a chart of America. Can I come back to something for a second? What are you talking about with natural gas price gouging? What is?
Hey, it's an easy thing to say because natural gas should be down a lot. We're the surfeit of natural gas in this country is ridiculous.
All right, but you're
it
not
has to do
actually
with-
saying that's
it has-
happening.
It all has to do
You're
with
just-
pipe. It has to do with pipes.
But you're not saying that's actually happening.
No. No, in reality it's not happening. I just thought that in the fiction that is Washington, it's a good thing. The reality is that we don't have enough pipes to go to where we need it.
We've talked about
So
that a lot.
instead we have a shortage in certain areas, but it's really ridiculous because we have the most natural gas that we've ever had. That price should be down. And it's not just because there's usage, because it was up before it got cold. So I think that should be looked into.
Okay. Just wanted to clarify. Thank you.
It should be looked into.
So
By the
does
way,
you think this gives the Fed a green light for January?
100%. Yeah, let's just stop at that. And then we got these guys, the people who are. I've not been interviewed.
Yeah, I know you're sad about that. I really thought for a while you had a shot. I really did.
I
That
told
was a
my wife
while
I was
ago.
ready.
That was a while
I told
ago.
Lisa I was ready. I was looking at homes.
Well, he did
It's
say
Bethesda.
last night on the address you mentioned that there will be a new Fed chair, and that person
Well, I
will
gotta tell you.
cut rates by, I'll quote, a lot. Here's what the president said.
I'll soon announce our next chairman of the Federal Reserve, someone who believes in lower interest rates by a lot, and mortgage payments will be coming down even further early the new year, and you will see this. In the new year, I will announce some of the most aggressive housing reform plans in American history.
Remember, Jim, when the Fed began cutting last fall and mortgage rates rose.
Yeah, but
so we're
that's
hoping that doesn't happen again.
Well, look, I have to tell you, let's take a look at what Lennar's saying. I don't know if everyone's going to Gemini yet by now, but the prices are down so much, it doesn't matter if rates actually go higher. But I do want to have teaser rates. I want to be able to have the Fed funds down so we can do teaser rates of 1 to 2%. And I'm going to get all this done. People think I'm being facetious. I've always wanted a shot. Always.
You're not getting it, though. You're staying right here. Sorry.
Was it?
There was a period where I actually thought it might be possible, but it's not. So you're staying here. Any idea what he's talking about when he says aggressive housing reform plans? Is it Fannie and Freddie, perhaps, which we know are going to, at least there is the plan to return them to private hands, at least a small portion, but it could still be a very
I
large
think that is.
IPO.
That is, but he doesn't need to do that. The price of housing is coming down rather radically because we are, frankly, no one can afford it, so it's coming down. It's going his way. I'm surprised you didn't know it's going his way. The stuff that's not going his way are natural gas, and that's a piping issue, and steak. And steak is in front of you. When you're at the
And
supermarket,
the number
you
of unemployed Americans is up 1 million from the
4.6,
beginning of the year.
4.6. That's true.
Yeah.
That's true. But again, that's where the jobs are. I had a Texas banker on the other day, and you can get all the jobs you want in Texas, but people have to move. They have to move.
Yeah, I continue to wonder at what point we're really going to come face to face with the reality of AI and what that is going to mean for the job market. And there is no ability to prepare oneself for what might. Now, we're not. It's clear it may not happen, but what could occur there.
Right, but there are gating factors, and one of the gating factors is Micron, because they are able to. Sanjay's got he's got the latest, but it's really just what he was saying. But it's really pretty amazing. Which is, remember, AI demand acceleration, execution helped drive record quarter. In the quarter, he says, look, we are able only to meet 50% to 2/3 of demand from customers. Their prices.
This pre-market gain, if it holds, will be the best day for Micron since April. The guidance on fiscal Q2 is way above consensus. And then they talk about one of the EVPs said it's the biggest disconnect between supply and demand in magnitude and in time horizon since she began her career.
It's bigger than NVIDIA. It's bigger than the amazing NVIDIA quarter. Now here's what the street's saying. Bank of America, stronger for longer, upgrade to buy. JP Morgan, AI-driven memory remains strong, outsized beat and raise. Morgan Stanley, Micron EPS guidance 75% above consensus. And then here's what David never wants to hear. UBS, as good as it gets. And then Wells Fargo, memory super cycle.
It's a memory super cycle.
A lot unlike the coal super cycle and the fractal.
That's always a scary sign.
You generally don't like words like that.
I hate super cycles because that's the top.
Yes, it typically can
It's
be.
top, but right now we've underinvested. We don't have enough AMAT and Lam research.
But again, we
machines.
should make the larger point. Step back here.
AI.
This is all AI. This is
AI.
data center demand because the memory is needed in the servers that create the AI factory, as Jensen Huang likes to call these data
Right,
centers.
so they can't make enough, and it raises the price. Now the question is, winners, is Gemini or is it OpenAI?
Well, now you're changing the subject entirely.
Well, that's the only thing people care about. They've already written off every stock that's in that chart.
I know, but we want to.
Well, you wrote.
I'm trying to keep us on Micron a little bit here before we move on to what dominates most of your brain these days, which is OpenAI.
Well, no, or Gemini.
Or Gemini.
I think that what this says is that there's another gating factor which calls for discipline. That's all I'm saying. I used discipline 4 times at the top of the show last night. We need discipline in spending and everything goes fine. We just can't keep rushing.
I did want to ask you, a chart of the SMH, for example, down 9 over 5 days. There's chatter last night of a double top at 375-ish. You can sort of see it on a longer term.
I went through all the charts last night and I said these charts are hideous.
They're hideous.
They're hideous.
What's Oracle down since the first time I put up at CDS?
Still up.
Remember that day?
Killed
I should find.
You killed Oracle, but it's still up from when they started. When Safra announced his game plan, it's still up dramatically. So some people feel it's got to go back to 118, where you really got the feeling.
By the way, that's the highest cost to protect since 09. Basically, when we were in the depths of really bad stuff.
And that was back in early October that we first sort of focused people in part on that.
Discipline. Right there's the discipline. They cannot afford to do it.
I do want to come back briefly, guys, to that story from yesterday that did involve Oracle and Blue Owl, because I have been, and Seema Modi's been reporting this as well, I have been hearing different things about that it was not at all about Blue Owl somehow saying no, that this is a related digital and Blackstone data center in Michigan. It's going to produce 1.4 gigawatts of power when it is completed by the end of 2027. 6 weeks ago is when Related went out for equity checks, and Blackstone, is my understanding, ended up being the equity check. They're now in the market for $13 billion of debt. $13 billion of debt to finance this data center. That's going to come from banks and the like. And so I think the market may have misinterpreted that FT story from yesterday in terms of what...
the FT story said exactly what you said.
They did.
I read that story a dozen times, and it says Blue Owl showed discipline.
All right.
You're telling me that may not be the case.
Well, I'm just... the way I've heard it is they were not a part of winning so maybe they claim they showed discipline. They aren't necessarily...
That would mean the story was
dispositive.
You're saying the story is completely inaccurate.
No, well, I'm saying
that's
what I have heard is in any way reading it along the lines of somehow this data center is not going to get built and or be leased by Oracle. So it's Oracle's balance sheet leasing for who else at the end is the customer of this data center?
OpenAI.
Correct. But it's all happening. And Blackstone is the equity, not Blue Owl.
Okay, well that changes it.
And by the way, Blackstone's pretty good.
That story
pretty
should be
good at
retracted.
underwriting, generally
Story
speaking.
should be retracted. Yes, they are. Now, I'm going to go to David. He's going to hate this question. Is it possible to raise money at a level of 500 billion or more at the same time that you're pre-marketing an IPO at 750 billion? Because that's what OpenAI is doing. Can you do that? Like if we had the CFO, say this is Sarah Pryor, the CFO, she was sitting there and said, well, are you raising money at a $500 billion valuation simultaneously offering the company at 750 billion?
You could do that back in 1929. I've been enjoying, Andrew's book showed how that went on, right?
Well,
Charlie Mitchell might have done that for you, yeah.
Yeah,
National City.
True.
That said, no, that is not. I don't have any idea whether this is true. They've been discussing it, by the way. They certainly need more money. They have $40 billion right now in cash at OpenAI.
Yes, they
right?
do.
They are not a debt-laden company in any way. They use others' balance sheet to help finance the compute that they need over time.
All true.
All true. And they will raise even more money, conceivably. I don't know exactly where it's coming from and who's providing it to them, and I don't know the valuation.
But CoreWeave would tell you we don't have enough people, we don't have enough materials, we are nowhere near being able to complete all the stuff that we need to. Again, that's going to call for discipline. If we can't make the stuff, then we're going to slow things down.
I've been hearing you say that for the last few shows.
There's also advantage being true.
No, I'm not saying it's not.
I didn't make up the Blue Owl story, I just read it.
There's also the notion that we had data center delays and chatter of cancellations back in March and February. Microsoft was a good example, and that told you nothing about what was going to happen with demand over the preceding 6 months.
I think that Oracle is the linchpin, not OpenAI. OpenAI probably can pull what?
No, go ahead. Yeah, OpenAI.
OpenAI can tell a great story because there are people who want to be with Sam Altman so badly. Intelligentsia.
We had Altman last week telling us that story. I think we can take a listen in terms of he continues obviously to see the need for more compute and revenue growth that will go along with it.
We have a lot of other things that we expect will drive incremental revenue, but the only way we can deliver on that is with more compute. So we will continue to build out compute. We'll try to do a big multiple on that 1.9 gigawatts over the course of the next year, and we'll keep going from there. We are confident we can continue to drive the revenue growth to meet this compute ramp. Without the compute ramp, of course, we can't drive the revenue growth, but we see way more reasons to be optimistic than reasons to be pessimistic. Of course, we'll continue to be responsible, and of course, we'll adjust our plans as necessary.
Good to have his voice there. Still fairly recent from our interview a week ago.
People need to raise, Oracle needs to raise more money. You agree with that?
They may, and at some point even they might raise more equity. Not, I don't think, in the near term. Yeah.
Oracle raised equity. What's our ballpark? 60 billion in debt over the next 2 years?
Yeah, I think that's a possibility, Jim. I'm not saying now, but you can't rule it out, and/or that you get some sovereign that comes in for something.
I just want to know how you can raise money at 500 billion at the same time that you're telling people you're going to sell at 750 billion, which means I want some of the 500 billion.
Well, they had their employees, right? That was the last round where the employees were able to sell it at 500. But I don't know the information.
You're not a fan of the information.
Yes, thank you. By the way, a lot of the reporting on OpenAI has been very good, to be fair to them, and they get a lot of
I know, but I just remember in 2000 I heard these stories and they were terrific. I give you money, I give you 10, you give me 50. Okay? And we just don't tell anybody. Here they're telling information. Before it was secret.
Sam Altman is not expecting to go public next year, I don't believe.
That story narrative is changing right now.
Take a look at the pre-market this morning. There's a couple big stories right there in CPI and Micron, but we'll get to some upgrades once again on GE Vernova, Disney top pick, Lennar. We'll talk more about housing when we come back.
agree. That's
been a rough stretch for tech, obviously, and the S&P going on 4 days of losses, but big turnaround in store, at least this morning, on the back of Micron and CPI. We'll get Kramer's Mad Dash in the opening bell in under 10 minutes.
Six minutes before we get started with trading here at the New York Stock Exchange on this Thursday. Let's get a mad dash in. We're going to stay on the power generation theme if we can. With GE Vernova.
Yeah, so we have two themes. One is we have the actual building the data center, and the other is we have do you have enough power to do it? Now, GE Vernova is the cheap way to do it because they're natural gas. The problem is that they did not increase capacity. There's only 3 companies that actually make natural gas generators. They're one of them. They've increased capacity, but you can't get one until 2030. You get the Q 2028, they're sold out. The question is 2029, can you begin to get it? This is the other gating factor that calls for discipline. So when you hear Sam Altman saying, listen, don't worry, we're going to put all we want, that's OpenAI, you run smack into GE Vernova. And by the way, the nuclear power situation that we're hearing, that's 2035.
It's 2035.
Yeah.
All right. Now, obviously, this is great. But there was quite a move down yesterday.
Yeah, so,
what was that all about?
Well,
I mean, was that just the overall trade, what we saw yesterday?
The day before
in part related to the Oracle story I was talking about earlier?
And the day before it had been recommended. Look, my travel show so it's been a home run. But I will tell you, I don't like all these calls because what happens is you don't have a lot of pricing power if you're sold out. That's Sanjay and Micron. He doesn't have a lot of pricing, but he's sold out. If you're sold out, you can't raise prices because I've already bought it at a certain price. Now, Sanjay can only raise prices if he gets equipment, but if he gets the equipment, then the prices start falling. So these are all catch-22s. I do not think that this stock, which I love and should be at 700, is anything but another call for discipline for those who want to put up endless numbers of data centers. Forget about it. And we can talk about the space data center, which could be reality, but I need to see Oracle. to do something. That's
Well, you know,
said equity. Oracle equity?
There could be fusion.
Where did you get that?
I'm not. Don't make too much of that, please.
Is that like the FT with the boom?
No.
Is that the
No, I'm just saying at some point it's not inconceivable that they might have to. Who knows?
But read Joe Stern and watch the video.
All right, we'll get to that in a minute. All right, we got an opening bell less than 5 minutes away. Don't go anywhere.
With growth in AI data center capacity is driving a significant increase in demand for high performance and high capacity memory and storage. Server unit demand has strengthened significantly, and we now expect calendar 2025 server unit growth in the high teens percentage range, higher than our last earnings call outlook of 10%. We expect server demand strength to continue in 2026.
That's Micron Sanjay Mehrotra on the call last night, Jim. At least one upgrade today out of BofA. JPM goes to 350, bunch of 3 handles today.
It was an amazing quarter. Value of memory is higher than ever before. It used to be a commodity, it's obviously not. Sanjay has a high bandwidth memory component that is perfect for the data center. Others that will go up, once again, we're going to see Seagate go up, we're going to see SanDisk go up, we're going to see Western Digital go up. Those are not the ones to be in. They can go up, but Micron is the one that is really outstanding. Outstanding. Sanjay, we said this would happen 2 years ago in January. 2 years ago we said this would happen, and it happened. Congratulations, Sanjay.
Let's get the opening bell here in the CNBC Real-Time Exchange. And the big board, it's Picard Medical, maker of the Syncardia Total Artificial Heart, celebrating a recent IPO. And at the NASDAQ, it's IT and enterprise software company NetSol Technologies. Speaking of IPOs, what'd you think of Medline yesterday?
I was very impressed by it. I did a piece last night saying it's a little too high for me now, but it's the kind of deal that I like to see. People making money on both sides. I think it probably comes in a little, and then you can buy it. Well, there it is. Okay, it's coming down a little. Yep. It's a very good company. It was the way, David, this was the best one to start the process. Very good growth, accelerating growth.
Yeah, and obviously an established company that's been around for a long time, not obviously in AI world.
Yeah, the compares are very, very hard. You know, Owens and Minor, 3.5 times earnings there, and Becton Dickinson. And I like this company, and I think that if you get it 32, it would be good. And it can't come down. We know that. We know that the IPOs this year started too high and then come down. But this is a good one. Good.
Yeah.
Company. Nicely done.
Still not bad. Yeah, nice performance 2 days. Yeah.
Good to see that.
Speaking of upgrades today, names that are not AI related, Jim, at least one, I think Merck over at BMO, Rivian, Sherwin-Williams at Citi goes to buy.
Sherwin-Williams is aggressive. Go buy Home Depot if you really think that. The Rivian, I feel, was fatuous. I mean, they need to raise money as far as I'm concerned. Merck is an inexpensive stock. All these stocks are coming back. Now, it's interesting. Eli Lilly has a study which is basically you can take the pill, and they're going to get business from Wegovy with the pill. It's probably worth 100 points. But people are, at this level, refusing to pay more. They're trying, it's almost a double top. I don't think so, because if you can take the pill and switch from Wegovy, that could be game, set, match for Lilly against Novo Nordisk.
Wow.
Novo, a trouble company. Hey, how about BP? They had a new CEO. Boom.
BP has a new CEO.
What's going on over there?
Interesting. Elliott supportive of new CEO at BP.
Yeah. It was 2 years, the previous CEO.
Yeah.
It's a long time for BP.
A long time. No, I know.
BP
it's
is a revolving door.
It has been. It has been. But yeah, they're saying Elliott, they're supportive. And then, of course, when it comes to Elliott, we've got Lulu this morning.
How about that? Lululemon.
And we can confirm, as others, that they do own $1 billion, and we can take it from there on Lulu in terms of a change in the CEO suite and other things that may occur.
Oh, I know. Look, do you think it had anything, Calvin McDonald's? Do you think that had anything to do with him declining to serve more?
Yes, it may have.
I think it may
Not
have.
sure.
Meanwhile, Starbucks is up very big one. No news that I can see, but perhaps you guys know something. They have they have a new program for them, but that's not it. I think that I continue to believe the turns. You remember the turns that we need: the Nike turn, the Starbucks turn, the FedEx kind of minor turn. I think all three of them are going to. Nike has too much inventory still. I think FedEx could be blowout.
You do?
Yeah, we had a truck driver shortage rather than that. Holy cow.
I mean, it's been straight up since mid-October, along with all the transports.
Right, that's true, but I think the world of Raj, I think he's sensational, and I think he can deliver the real numbers.
There is some chatter about what kind of guidance we might get out of Nike. Do we get full year or not?
I think that he's worried about, Elliot's worried about China. He doesn't have any clarity on China. If he had more clarity on China and he had more innovation, which is what I'm counting on, it's the two eyes here. Innovation, they need more innovation, and inventory, they need less. If you can get the two eyes going, the stock goes to 100 rather quickly. I think the stock has 3 downside and 20 upside. Not bad. Yeah. Not bad ratio.
To your point about restaurants, got an upgrade to Shack today. Maybe to your point about coming lower beef prices. MCD, by the way, is close to a 1-year high. I don't know if that's on the dollar weakening again or what.
Yeah. Look, Shack is very interesting. The problem with Shack is the stock was going straight down. The analysts had it dead right, said sell. It was much more of a victory call. I think Rob Lynch is doing great, but this company is 100% tied to the beef futures. That's why I say if the president were to give the cattlemen a check, get beef down, clear victory. Housing, gotta get nat gas down. But that's just has to do with pipes. We have to be able to better distribution of natural gas in the country.
Yes, we do. Particularly, as you say, in the Boston area. I know that has always been starved up there because of the lack of pipeline, right?
Well, RBN has a great piece today about how Vermont has incredibly sky-high prices because they were trying to get away from greenhouse gases. can't. It's very hard to wean yourself off. They have oil and propane is the majority of it.
It's hard.
Terrible skill set.
Guys, I didn't think I'd be talking about Trump Media and Technology Group this morning, but I'm going to talk about Trump Media and Technology because it's up 23%. We know it, of course, is the owner of the Truth Social platform, the platform the president chooses to communicate through. Oftentimes, DJT is the symbol here. You can remember this company, of course. It has seen far higher prices. Remember, it was brought to market, I'll never forget, by E.F. Hutton.
You're
That
right.
one I loved. E.F. Hutton brought it public, but they just thought it wasn't the old E.F. Hutton. Why am I telling you about it this morning? They're merging with a company that does fusion power. It's called TAE. It is one of those companies that is pursuing fusion as a key power supply. Not fission, fusion. And as we all would, of course, put it into ChatGPT and asked about fusion.
Why not Gemini? Why do you keep going to ChatGPT?
I don't know. I went to chat. Remaining hurdles. Fusion must still produce net electricity, not just net fusion energy. Run continuously, not in short pulses. Survive extreme neutron bombardment. That's a problem.
Yeah.
And be cost competitive with solar, wind, fission, and gas. Likely timeline, according to chat, 2030s, the first pilot plants producing electricity, expensive and experimental. 2040s, early commercial fusion plants. And perhaps in the second half of the century, we could have meaningful grid-scale impact if costs fall.
When? When's it coming?
Second half of the century.
Of the...
Yes, of the current century.
Okay.
So that's...
It's a massive
that
shift in
fusion.
narrative.
It's always been huge promise. There have been technological hurdles that have been overcome. There are many more to come. And here I'm not quoting the
Are you
chat.
telling me it's a
I'm
switch
talking
from
about
media to
what-
megawatts?
Well, they're going to keep running media, but there's no cash. I mean, they are providing some cash at close of about $200 million, I think. Yeah. Agreement to provide up to $200 million of cash TAE at signing, and an additional $100 million available upon initial filing of the S4. It's moving the stock up. So yeah, when you buy DJT in the not too distant future, when they close the deal, it won't just be about social media.
But David,
It will be about
that's incredibly
fusion.
capital intensive.
No longer about crypto, I
But
guess.
it's yeah, I know, but it's
Yeah.
not sure now. It's incredibly capital intensive and heavily regulated. What say you?
I don't know. Let me go check. Should we just have chat talk to Gemini?
Yes, let's just solve that and get Joanna Stern on here. And then we can go to Anthropic and see what's really
The
going on.
Joanna Stern piece that Jim is referencing was in the Wall Street Journal. It is a great read about how Anthropic gave them a vending machine that was run by AI, and what those creative people at the Journal did with that poor thing is pretty funny.
Yeah, it really, it just tells you how early we are in the industry. But I was actually asking all questions from Gemini of David's chat.
There's some video that they showed, and they were able to query it and basically get it to believe it was part of a communist
so great.
system, and so everything became free. It bought a live fish. It bought a PlayStation.
And they had a guy
Pepper spray, underwear.
It is a cautionary tale, perhaps, that agentics, may not quite be there in certain ways. By the way, in this piece, Joanna Stern says, and probably very happy with this because it gives them all the things that they can now work on, and that was the whole idea.
Well, I mean, again, this is the not enough compute. I would tell you once again, the reason why we're way behind is we don't have the Vera Rubin yet. Remember a company called NVIDIA that everyone's forgotten about, or is everyone? NVIDIA became a free fire zone. Everyone has a better chip.
Well, you'll allow that the Google TPU kind of cracked the narrative on NVIDIA, right? There's nothing wrong with that.
No, nothing at all. It's just that NVIDIA, they have no shortage of customers. And all these stories seem to act as if there is. Now, NVIDIA, horrible chart. NVIDIA, nothing new, not until the spring. So NVIDIA has to mark time. Unlike Sanjay Mehrotra, who doesn't have to mark time.
No.
NVIDIA is a mark time stock right now. I know. Look, I can look at a chart. I was in a chart.
And by the way, I think Jensen was on Fox yesterday, has not yet given OpenAI a penny. As we mentioned yesterday, that deal having not closed.
I was not going to mention it until I knew. But yeah, the linchpin of the valuation of $500 billion or more from OpenAI was from Jensen.
Right.
And that deal's more of an MOU, David.
It is an MOU. We don't. I know it was announced, so to speak. It was a press release. At this point, it's still only worth, as we often say, the paper it was written on. But we'll have to wait and see. It's important, though, Jim.
Yeah, I mean, look, I want to go a step back for a second. Sound like Steve Wiesman. I love this. Here's the deal. The reason why we talk about it is because if you don't build this thing out, everything doesn't work. But if you do build it out, it's all too expensive, whether it be from Micron too expensive, the Google chip is too expensive, and NVIDIA's chips are too expensive. So what we have this Mexican standoff. GE Vernova, I want to expand, but I can't get the power. And Trader would tell you I can't build it. I don't have the ability to have a structure that works if I'm Oracle, unless he issues equity, which would be insane, he being Larry Ellison. So we really have a situation where if someone doesn't exert discipline soon, the whole edifice collapses. And that would be terrible. But if we get discipline and a slowdown and everything,
you're definitely on it.
You are, yeah. You're gonna.
What was your line yesterday? A sham? Is that it's all becoming a sham?
Becoming a sham.
Wait, what's becoming a sham?
This pricing of OpenAI that they offer it to you at 500. You can come in at 500.
First of all, I don't think you're being fair to them when you say that, because it's not clear to me at all that they are actually issuing new equity or finding a new investor at 750
You don't think
billion.
that they're putting feelers out at 750? I read it in the information.
I don't know.
You're telling me the information might be wrong?
I haven't sufficiently confirmed that would be the case.
Telling me that the information.
And by the way, moving up in an increment of 50% more of your value when you just did that seems a little much. Not to mention, where's...
That's my point.
I know, so... Yeah.
It doesn't seem right.
No, but
that's a sham.
You're accusing them somehow.
No, I'm not accusing them of jack. I think they're above board. 100% above board.
Here's what Jim said
1,000% above
yesterday.
board. 1,000%. Look, this is all, it's becoming sham-like. And we all know, we don't want to talk about it. In the year 2000, those of us who had to deal with these deals where it's like, here, you take this and I take that, those were against the law.
The circular deals. By the way, we got this one too. Now this is a.
That's a solid deal. Give me $10 billion, and you know what? I'll buy your chips. Are you kidding? Look, I really respect Amazon, and this shocks me that they even want to put up with this.
Man, you just come in here every day on fire
Because it's
for
got to
OpenAI
end.
and Oracle.
Because it has to end. It has to end, or we're all fools, and we're just playing the game like they did. And it's 2000, and we're saying, hey, you know what? InfoSpace is going to $1 trillion, partner. Well, I'm not playing that game. We want to stop this right now. And Larry Ellison knows this, and Safra Katz knows this. I don't know what OpenAI knows, but this is over. All of this stuff. Amazon, come on, Brian. Come on, Andy. Don't play this game. You're real. You are serious business people.
It's moments like that that make the show so special.
Look, I was involved in 2000. I chose not to play at the advice of my lawyers. I chose not to play in a world where I give you money and then you give me money back. Why? Because my lawyers felt that it was illegal. Now, did it ultimately come out illegal? No, what it did is it cracked everything. And the company that offered me a deal where I could give them money if they gave me money was destroyed by this. It still existed in some sort of sham form, a total sham. But I'm saying that we all know that this is happening. And David, you remember Lucent and Rich McGinn and that Brazilian contract?
I do. You're talking about Lucent, of course, which at one point was the most widely held stock. I don't remember. It was not. It was amongst the most highly valued, but it had more shareholders, Lucent, than anyone.
But these
and those were the great years for Lucent until they weren't.
And that was the beginning. What you had to do if you were sitting here is cry out like I was and just say, you know, it's got to stop. And if it stops, we're okay. But if you continue to do these deals where it is vendor financing and it is circular, then the bubble is breaking. And they are circular. And that's why I was so glad to hear that Jensen Huang may not be playing it. Because this is what destroyed so many retail investors in 2000. We got to try to stop it. Us, this show, has to try to stop it. We have to be willing to say it, not scared to say it, not afraid of the mean phone calls, not afraid of people saying, well, you can't do that, I'm going to call your bosses. None of that. We just have to tell the truth, and we have to help stop this juggernaut before it gets off the rails.
I have every intention of doing that.
Okay?
Yes.
Time Warner, the fugitive scene.
Based on the
Trace.
facts.
We have to stop it. We have to play a role and stop it. We have to do it.
Well, stopping it,
we have to say, well, these deals are not right. What I'm saying is, it can't be illegal. My lawyers can't say you can't be involved with that. And these companies do it, and not just say, you know, they got to stop it. You can't give me this and then take the money back. It is circular.
Okay, so the NVIDIA deal with OpenAI, that we were just talking about, that hasn't happened. Okay.
Although apparently that interview was a taped interview. Who knows what's happened since?
Everyone's hoping
the AMD deal with
Everyone's
OpenAI?
hoping that they give them $500 billion worth of stuff, which, by the way, they end up paying. That's the circular reasoning, right? That's the circular deal. That's the lazy Susan. I give you $500 billion, but I pay with that money. And then $750 billion public, the moronic public, the stupid idiot public, the hoi polloi. They pay $750 and everybody's home free. That's what we're gunning for here.
What happened then to the notion that if I'm not first, I lose, right? I have to be first.
Gemini won.
No.
Oh, really? Oh, Gemini won.
Jim.
Gemini won. Look at those numbers.
We've seen the lead change more often than in an NFL game.
You cannot make a statement. I mean, you can. You just did. But I don't believe that to be a correct
combination
statement.
of Google and Gemini. For that, they won for search.
Alphabet
they won for search.
is
Microsoft,
incredibly powerful.
Incredibly
powerful.
They've won for search.
And they have so many different platforms.
And they're going to have the Oscars.
They're going to have the Oscars.
Yeah.
No kidding. What?
YouTube.
Really?
YouTube. Oscars going to YouTube in 29.
They own the NFL.
I missed that.
Yeah.
Well, YouTube
100X.
itself is the most powerful platform, arguably, in video.
100X,
Waymo now, think of what they're conceivably going to be able to do.
Does great work. They came on Goldman Sachs guy.
The data
It
they
shows
have
you that it's
available
like
to
this.
them for
Gemini
training
like this,
Gemini.
OpenAI
I
like
get it.
this.
You're right.
Gemini
But
like
Carl's
this.
point is a good one too. The leads can change quickly.
Right, but I just say that
And you see it as winner take all, or when then one day you're
No,
saying all their commodities. You kind of say two different
I'm
things.
saying that search has been won. You can't go into search if you're OpenAI. You maybe can go in against Anthropic, but that's business to business. I don't know about whether Zuckerberg's spending enough. Maybe you can go in social.
Can you fight Apple on devices?
No, you have to pay Apple. Whoever's losing has to pay Apple.
Plenty
a
of people are
gigantic
going to
check.
be willing to pay for ChatGPT, or already are, and there are plenty of advertisers that are going to want to get involved there every time. And you know how many queries are hitting that thing?
Sell the public at $750.
I don't know the answer to that. I'd have to know the revenue numbers.
You know what? If you give me
And the
money,
cash flow
if
numbers.
you give me money, I'll say what you want. But you have to give me the money first. And what I say is worth more than what you gave me.
Circular anchoring? Is that
Oh
what
my
that is?
God! It's called alchemy, and it's nothing better. It's alchemy. We have to stop.
Yeah.
We have to say something. I don't want anyone to say, "Where were
Why
those
didn't
guys?
they say
Why didn't they
something?"
say something?" Well, we have.
Yes, we have. Yes.
That's good. You're on the record, Jim. No doubt about
I
that.
am on the record.
Interesting. We might have an inside day here. Haven't been able to take out yesterday's intraday high of 68.12. We'll see, though. Early days. Dow's up 220. Watch bonds. A lot of empty spaces in the CPI table as data collection was inhibited by the shutdown. But the 10-year is still awfully close to the bottom of that range at 4.1. watching some of the action in the cannabis ETFs. It's been slow going over the years, but there is a report today that the president may announce a new Medicare pilot program that would reimburse patients for CBD treatments.
I never saw THC in it.
Right. Although we'll see, kind of was expected to talk about it a bit last night. We'll see what we get in the days and weeks to come. Meantime, Dow's up 206. Stop Trading with Jim is next. Let's get to Jim and Stop Trading.
One of the remaining areas that's been really strong is fintech, as other tech rolls over, and I still don't see the major players, by the way, in the data center going up. They seem to be struggling. A firm has been my favorite. That's Max Levchin. She's great, but everybody seems to dislike PayPal. Morgan Stanley comes out with a piece that is so devastating. Downgrade to underweight. This is PayPal. It used to be Venmo. They're talking about Agentic's not helping, earnings risk, slowing Venmo, branded share loss. Holy cow, that stock's going lower. Maybe
remember we had, David, a mid-year discussion about a turn in PayPal, right?
We did. I mean, so Alex Christnow has been there for a while.
I
can remember that first interview. You've done a few with him since, haven't you?
I've liked him, but this piece is devastating. Melting ice cube, they call it. Melting ice cube.
Wow.
Ugh, what a horrible chart. Oh my God.
Wow.
Yeah, it's a good piece. It's a good piece. And now, by the way, Accenture was one I was looking at. Haven't really grasped exactly why people despise it today, but they despise it. But just be careful. Just because Micron says great things, that's a separate cycle. That is the Western Digital Seagate cycle. That's the SanDisk cycle. It is not the Broadcom cycle, as much as I do like Broadcom. Wow.
What is between Broadcom and Micron?
Micron is a huge shortage. You just can't get those.
Right.
Broadcom is at Taiwan Semi. That's just a line. Yeah. Who's in line? And Nvidia's still. I mean, not heard from. Look, I still think Nvidia's the best in show, but I recognize when you keep your head down. I'm not lifting my head up right now. There's snipers everywhere. It's incredible. It's not quiet, David, on the Taiwanese front.
On the Western Front.
What about tonight?
I've got the man of the hour. I got FedEx. I got Raj Subramanian. People have to listen to Raj. He is so good. I love him. I love him. I think he's done a remarkable job at FedEx, and I think he's the winner. Let's see what he has to say. And heard of Mr. Smith's company's done a fantastic job.
Huge macro bellwether.
Oh, is that one the bellwether?
We'll see you tonight, Jim.
Yeah, I'll be David's going to be here tomorrow. I'll be here tomorrow.
Well, I'll be here tomorrow.
I was afraid you had the morning off, which means you're not here. That's code for not here.
I'm here.
Mad Money, 6 p.m. Eastern Time. Most sectors are green, and the Dow's up almost 300.
Welcome to Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and David Faber. We are live as always from Post 9 of the New York Stock Exchange. Today, Micron breathes life into the AI trade. Shares of the chipmaker surging after last night's results. We'll talk about what it means for the tech trade at large. Plus, the CEO of Accenture, Julie Sweet, will join us as that stock pulls back despite strong earnings, including solid AI bookings. And another pop for Lululemon, now up more than 30% in a month as an activist takes a big stake in the stock. We'll bring you the latest. But guys, the big news today is CPI, which comes in lighter than expected, and that is good news. We got, I'll do the year over year because it's really hard. There's no month over month because we didn't have October CPI. So let's just show you where we are. And that's also what the Fed looks like. The headline number, 2.7%. Again, better than expected. Core, even better at 2.6%. And that means that it was not the 3% that was expected. If you break it down into inflationary spots that we talk about, that we worry about, I think food was a pleasant surprise, up 2.6% overall. And food at home, which is grocery bills, that's what you're paying, that's what people feel, up only 1.9%. It's a lot less than it has been, and also less than eating out at restaurants, food away from home. Energy prices are a problem, 4.2% gain, and part of that, at least, is the electricity. You know, we talk about with all the data centers and the high electricity we're paying, 6.9% increase in November from the November before. And then shelter, which has been stubbornly high and been a factor in the higher services inflation, up 3%. Looks a little better than it has been. So overall, you know, Carl, I would say that if you're worried at the Fed about inflation that is above target, it's still above target, but it's not getting worse. And then maybe getting a little bit better.
Everybody's pointing to this footnote, though, at the bottom, and I'll read it. The October and November 2025 data values are not available due to the 2025 lapse in appropriations. And some of these columns are, on a monthly data standpoint, are empty.
Empty. And also, like, I went down to do my basket breakdown of white bread and everything like that. They don't even get that granular, and they don't even have even the year-over-year numbers on those. So yes, is it the most reliable data? Maybe not, but it's something, and it's something for the Fed to look at as we've been trying to figure it out. Also, I would just note the jobless claims were pretty good as well. You know, the no hire, no fire labor market we've been talking about. If there were firings, you would see elevated numbers on jobless claims, and we're just not seeing that. The latest read was 224,000 Americans. That was actually a decrease from the week before in terms of jobless claims. That's kind of where we've been right now. And if you zoom out and look at a long-term picture, it's not a level where you would worry about stress in the labor market, where you would see kind of mass layoffs. We saw that obviously during COVID. That was the crazy spike there. But so far it's been low, pre-COVID levels, which was, you know, not recessionary levels, even though we are watching an unemployment rate go higher. So I think that the combo of data today makes the Fed probably feel really good about its policy, that it cut 3 times, you know, inflation not sort of rearing its ugly head in a worse way. But let's see what happens on the jobs picture.
All right. A little more Fed cut getting priced in, but not a great amount, right? Maybe 5 or 6 basis points for next year?
Yeah, we'll get more data because the next Fed meeting is until the end of January.
Sarah.
So we'll get all the early January data, you know, for December and all of that. And you know, it's not enough to sort of sway one way or another. I think if you started to see bigger spikes in jobless claims, then maybe that would feed into the labor market is worse than the inflation picture. But you know, for those that say we're not too restrictive, they can point to the fact that we're just not seeing big jumps in claims.
Let's talk a bit more about the data this morning in the market with Mona Mahajan. Edward Jones, head of investment strategy, joins us here at Post 9. Always good to see you.
Great
Welcome.
to be
Happy
here.
holidays. You think there's time for a rally to show up before year end?
You know, look, Santa Claus came a little bit to town this morning. We enjoyed seeing that CPI print come in well below expectations. What particularly caught our eye was the core CPI reading. Nice to see 2.6%. You know, keep in mind 2/3 of the basket is core and services, and if that trend does continue, inflation was one of our risks for 2026, and hopefully that's moderating. I'd say, you know, 73% of the time the data shows since 1980 we have seen a Santa Claus rally between last 5 trading days of the year, first 2 trading days of 2026. Could we get it again? Absolutely. We're in this period where markets have moved a bit sideways, and so maybe we do see a year-end push. But more broadly, we feel pretty comfortable going into 2026 with the economic and earnings.
Have you established earnings or indices targets?
You know, we don't do targets per se, but we will say we know S&P returns are driven by 2 factors: earnings growth and valuation expansion. We do see earnings growth double digits next year. The scope for valuation expansion a little bit limited, especially in the tech and growth parts of the market. But could we get some catch up in parts of the market that are outside, you know, Mag 7, 493? We think there is scope for that. So there is a basis for positive returns for 2026.
You think that is most evident in, or continues to be most evident in banks, or healthcare, or transports? I mean,
Yeah.
there's been a few.
There certainly has, and all those sectors you named are good ones. We particularly like healthcare and industrials here. We remain overweight going into 2026.
CPI.
We also actually still like consumer discretionary. We think there's some valuation potential there as well. But more broadly, the theme is let's get some non-tech and growth in the baskets for 2026.
Actually, to your point on discretionary, that's the leading sector today, and I wonder if you think it has to do. There's some desk notes today about what a stimulus check would be spent on, what income
The real
cohort would
Jim.
benefit the most?
Yeah, I think all of the above. You know, look, we're in an environment where the Fed is lowering interest rates. That's a good backdrop for the consumer overall. Especially
Goodbye.
if we see that 10 years start to stabilize and maybe impact mortgage rates overall.
Overall.
So, obviously, this is more of a risk-on, risk-off indicator, as well as Bitcoin actually up today. Bitcoin's up around 2.8% if you're looking at the futures contract here. You know, the technical setup is very unique because we are hitting a key area of support. We tried to bounce off of it, coming back and hitting this 85.
Technical setup is there.
$100 there, and you really want to kind of see a consolidation and a breakout to the upside. That 20-day moving average in blue has been an area of resistance. We are seeing kind of that bearish cross, or some even call it the death cross, with that 50-period moving average moving below the 200-day moving average. But I think this is just an indication of liquidity in the marketplace. You are seeing a little bit of a bounce back here today. Consolidation, come back, retest, I think is also going to be key. And any type of failure from here, you're really talking about 80,000 to around the 78,000 level for Bitcoin. So right direction that you'd like to see. You'd like to see green on the screen when it comes to Ethereum, Bitcoin, you know, all the altcoins and things of that nature. That kind of shows a risk on tone. Any type of reversal of Sam, that's where you get a little bit concerned that maybe this is one of those situations where you kind of sell into any type of rip in the market.
Got a Christmas party I got to go to.
And just talk to us about the commodities patch this morning at KG. Obviously,
The IRS.
Oil, these prices ticking up. We've got the geopolitical risk premium being priced in here, as you mentioned yesterday. We've got Russia, we've got Venezuela, but we've also got the macro picture. I mean, Madame Lagarde talking this morning about you know, a positive economy out there in the Eurozone as well, no doubt, helping things out too. What are you seeing as far as the energy complex?
Yeah, so you are seeing crude oil up about 0.8% at this point in time. It was actually higher overnight on the anticipation that President Trump, during his address yesterday evening, would actually announce a war with Venezuela. That was kind of the rumor that was out there. But you did see it kind of pull back here a tad bit. What's actually interesting from a technical standpoint, yesterday we actually had a bullish engulfing candle at those lows, which once again is bullish, and maybe some buyers try to step in here. The fundamental landscape is still a little bit lackluster. Gasoline demand here in the United States is outpacing what we saw for 2024, but we're not really seeing incremental gains on a year-over-year basis like we would normally see. So that's been something that's been on the radar. And then there's this concern around a supply glut. Now, when you're looking at the ECB and the BOE, we actually saw the
Looks like we're coming in on a double bottom, yay.
And kind of talking about maybe economic growth expanding here and inflation going in the right direction. And there's also concern around the labor market. Now, we have not seen as much of an impact on tariffs.
I went to a place called Scooters Coffee.
Expected this year, but there's
I
still a
like it.
cautionary tone that maybe some of that is going to be reflected in 2026, which once again could kind of compress prices for the energy patch alone. But I think the geopolitical risk premium that's being priced in right now still looks relatively cheap compared to the escalation that we are seeing in the Caribbean. And I think the market, especially for these bulls, are really looking for that first
/ES is at the 63.
Escalating even further within that region to really try to push prices higher. And then you're looking at around that $58 level, which is a major area of resistance for crude oil.
Okay, keeping an eye on some of the commodities as well this morning. Plenty of moving parts for us. So busy this morning. Thanks so much for breaking down the data and what's moving markets this morning, KG. Coming up, we will take a closer look at the global macro landscape in light of the latest central bank decisions overseas. Morning Trade Line will be right back after this.
Coming in for a double bottom, yay. On the SPX. The 18th.
I'm Nicole Petalides at the New York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at schwabnetwork.com.
What's up, Carl Nation? It's your number one broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah,
We're close to the first part.
They can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
Prepare ye. We need to hold this support, please, for it to stay bullish. 67.6902 is our second chance. At the 63 on the 1 minute time frame. For I'm Washboardjim, the founder of the Sneaky Snake Trading Strategy, where I talk about chart patterns, moving averages, and being in the now. We're getting real close to support. Prepare ye. Prepare ye. Okay, we tried. We tried to get in it at $6 and it didn't let us do it. But I think I'm going to do it again here. This is the 1 minute time frame. We're now at $6.50. Prepare ye. Okay. Trying it. I'm trying. $6.70. Prepare ye. $6.20. Oh. $6. Strike is the 6,800. Come on. $5.90. They're trying again. $5.90. Ooh, no. He's trying again. Needs to break. SPY bounced off the 200 EMA in the orb. Pretty respectful looking right now. I'm at 770. Now I'm basically saying sell, 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 sell. How's he do it? I don't know how he does it, but he did it. $7.80, $7.90. Uh-oh. Jim, how do you do it? Okay. 3 white soldiers. Three white soldiers. Randy. I don't know how he does it. It's beautiful. Oh God. That's beautiful. We were all around the Thanksgiving dinner table the other day, and Grandma says, "Who was that fine man there that you were talking to on that YouTube channel?" His name's Washboardjim. Did he ever used to play down there at the Grand Ole Opry down there with Stretch and Scruggs? I said, yeah, that was him. Yeah, I was there. $10.80. Oh my God. Ooh. Okay. Randy, what do you do when you're up so much? What do I do? That's what I thought. My name is Washboardjim. I'm the founding think jet mechanic on the at 1140. How's he do it? How's he do it? They're now at $13.30. Jim, do you have any regrets on selling that trade? Well, you're sitting up here with another $600 in your pocket in a matter of minutes. You kind of makes you wonder sometimes, but no, I don't regret it. From Washboardjim, the founder of the Sneaky Snake trading strategy, where I talk about chart patterns, moving averages, and not being a homosexual. It's a hard threshold to pass. That's correct. Okay. Today I'll be going to a Christmas party at the IRS. Anybody want me to say any kind words for you? Today I got a spoonful of gifts, pun intended. I'm going to show you what I got for the IRS agent that picks my box. Right now they're at $13.90 at 410. Tell them to what? I can't do that. Today, the IRS agents will be getting a big box of Russell Stover chocolates. There's an assortment pack of 32 of their top-notch chocolates. That will go down as a tax write-off to the IRS. And then the lucky person that picks my box will get this large set of salad forks and spoons. It's got I've got a fork in there with 2 spoons and a big spoon. And I'm going to throw in a couple of these fentanyls in the boxing. Oh. Always clean. $15.60? Are you kidding me? $15.90? Jim, that's another $900 you left on the table there. Are you proud of yourself? Well, not really. I think that I could have probably raked in a little bit more profit. For you people on YouTube, this will be going to an IRS agent. Big old fork and 2 big spoons and a bigger spoon. That makes me a good taxpayer. Be kind to your worst enemies. Yesterday, Jim mentioned the Open. Good call there on SPY, James. Anybody want to say yes? Magnificent. Sheba. Jim, that was an extremely nice call you made. We were all flabbergasted on how you called it out off the 200, having a previous bounce before, and then also having that support level of the orb to give it a higher low. And as you can see, we did have a higher low right here as the pullback began to happen, bouncing again off the 200 EMA and the orb. Now I'm less reluctant to jump into the trade now. Although these things went up to 1680. Do you know how much I left on the table? You're right, I left $1,000 on the table. Does that make me a bad person? Maybe. But what are you going to do about it? Randy also left $1,000 on the table with a SPY. You could tell he wasn't wanting to jump into the more lucrative trade. I'll be right back. He sold at 150. Oh. Try not to share that too much. I'll be right back. We'll see if there's any cleavage on today. Carl's way is the best way.
Cited in a lot of the notes. They also say that my
turtleneck
2 through 26, they agree with that sentiment. Over at Citi, they raised their price target to 330. They maintain their buy rating. They said that they estimate the AI super cycle has come to memory, and they upped their fiscal 2026 earnings per share estimates by about 35%. That takes them about 50% above the consensus. Barclays has a 275 price target now. Micron, Raymond James 310, Mizuho 290, and KeyBank 325. So a lot of price target increases, a lot of buy ratings across the board, Sam.
Yeah, I had to double take it, Rosenblatt as well. 500 from 300 as well, giving a buy rating there. I mean, that is just bullish. So thank you so much for getting us across some of those notes this morning. Marley, I'll check in with you later. Let's trade it now with Joe Tigay, portfolio manager of the Rational Equity Armor Fund, and an example trade for us for Micron today, Joe.
Micron with a hat trick on earnings, the double beat plus the guidance raise, and it was a staggering guidance raise. This seems like an NVIDIA moment from like 2 years ago when NVIDIA just kept on having quarter after quarter, but then having just like this blowout quarter, just way surpassing everybody's expectations. It's just a sign that the more people compute, the more computations that are happening, the more memory you're going to need. What good is the knowledge if you can't store it somewhere? So it is just a sign that the AI trade is continuing, and it's not a question. This isn't questioning can the AI trade continue. This is just confirming the AI trade is absolutely ballooning and continuing to grow. Seemingly the only constraint is the data centers. How many more can we build, and how quickly can they come online? So it's just a fantastic sign. And really, yeah, it was a hat trick for Micron, and really the market seeing a triple play in good news for the AI trade too. Good CPI numbers. Also, I think the OpenAI raising money, I think that's great news for the broader market right here. Some stability and some of that worries that is there enough money to go around for this financing. Just really cooling that idea off that OpenAI is not going to be able to finance some of its commitments. So I think that's really good news broadly for the trade in general. So, you know, I think it makes sense that the market's very positive day. My trade for Micron, just given what we've seen recently, 170% on the year right now, which is huge run up after this announcement. I still expect further growth to the upside, maybe just a little bit slower growth than we've seen this year. Shouldn't expect 170% gains every year. But just looking out, we had a 260 high recently. We're right about at 250 now, pulling back off just slightly off of the intraday high on this event. I'll just be looking out to March, something like a 240, 260 call spread already in the money. I saw this just a few minutes ago, about $8.50. It's about what the intrinsic value is anyway. So it's essentially me getting into the name right here with a covered call, buying Micron for $8.50, covering myself at 260. I have a potential gain of $12, potential loss about $8.
All right, good example trade for us for Micron this morning. Shares are rallying up 12.5% right now. We're at 253 and change on the name. It's our best performer on the S&P 500. Joe, thank you so much for that. Joe Tigay, portfolio manager of the Rational Equity Armor Fund. Coming up, we'll take a closer look at energy markets and how Russia-Ukraine peace talks are impacting the price action there. Morning Trade Live will be right back.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, Technical Analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Stay connected to what moves the market. Download the Schwab Network app and stream anytime wherever you are. Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Whoa!
Welcome back to Morning Trade Live. I'm Sam Barnes, coming to you live from the floor of the New York Stock Exchange. Let's take a closer look now at these energy markets. Joining us is Carly Garner, who's the Senior Commodity Strategist Broker at Carly Trading. Thank you so much for joining me today. Look, where do you see things heading in 2026? Obviously, it's not been a great year for prices. We've had a lot of the geopolitical risk premium being priced in right now. Plenty of moving parts. So what's your outlook?
Well, you're right. There's a lot of moving parts, and it's never boring in oil, right? The one thing that I can say is I can't see the future, but I look very closely at what we've seen in the past. And when I look at historical charts, the outlook for crude oil looks relatively bleak in 2026. Now, seasonality is bullish for the next 2 or 3 weeks, so I would expect to see crude oil get a little bit of a bounce in the short run. The chart looks good. On a daily chart, we're a little oversold. Seasonality is strong. The dollar's weak. So I do expect a little bit of a short-term bounce, but I think it's going to be a lot of what we saw last year going from 2024 to 2025. That seasonal rally last year was about $10. It was pretty sharp. It got, market participants and analysts pretty bulled up, expecting higher prices, thinking that was the bottom in oil. And it wasn't. It ended up being the starting point. We really haven't seen $70 oil, which is where we came in at the beginning of the year. We haven't really seen that much at all this year. We saw one quick rally up to 70 and it's still up. And that's kind of been the modus operandi for crude oil since March of 22. Every single rally has been sold in too sharply, and I think that's going to continue to be the case. Over the last 2 decades, we've had 4 bear markets in oil, this being the 4th one. And the other 3 really didn't end in a civilized manner. In fact, it was very uncivilized. We saw around the financial crisis, oil capitulated into the 32 area. In the 2016 bear market in oil, we got down to 26, and then we all remember 2020. The bear market didn't end until we saw crude oil slide to $20 on the back months, and the front month went negative. So it's too early to call a bottom. I think we've got some more pain in the tape here going into 2026. And unless we see capitulation of price and sentiment, if analysts start talking about lower for longer, that's when I might start looking for a bottom. And I think we're far, far from that. I think we could easily see $40. Historically, when crude drops below 65, we generally have support at 40. But with time, that 40 support has been given way to much lower prices. So be on the lookout for a bit of a washout before we can start looking for an oil bottom.
Wow, okay, interesting. Obviously the prevailing narrative this year has been one of a supply concern. We've had OPEC Plus, of course, that's now said it's going to basically sit on its hands in Q1. But we've got plenty of moving parts as far as, the Ukraine-Russia peace negotiations that are going on right now, what that's going to mean for the potential for Russian volumes to hit the market in what is oversupplied already as far as the market is concerned. Obviously this week we are tracking the lines of this blockade of these sanctioned Venezuelan oil tankers as well. Which is the biggest story that you're keeping an eye on right now? Which has the potential to impact prices?
In my opinion, the Russian-Ukraine story is kind of the driver. I believe that the market has had a roughly 10, maybe even more risk premium built into pricing because of the Russian sanctions and the idea that we're going to enhance sanctions and that sort of thing. And if we do get some sort of progress in Russia-Ukraine conflict, I do believe it probably allows crude oil to finally fall to that $40-45 dollar per barrel area that has historically been the case. I don't know what it's going to take to trigger the washout to deeper levels, which again, the last 3 bear markets have required a massive washout before we can get a bull market in crude oil. Just to put things in perspective, I'm not saying crude oil is going to $14 or $15, but if we repeated this in this cycle, what we repeated in the last 3 cycles, we would absolutely see $14 or $15 per barrel. I don't want to see that because if that happens, that means there's something lurking around the corner that we're not expecting. But I just want people to be aware that that is a possibility. There's no reason to be complacent here. Crude oil, once it gets on this slippery slope, it's really hard to stop the downside momentum until basically everyone in the world is too scared to buy, and that's when crude oil bottoms, unfortunately.
Okay, just talk to us about some of your thoughts on natural gas. Obviously, we've seen some signs of stabilization this week. A lot of seasonal factors driving that. Obviously, the colder weather looks bullish as far as the bias for nat gas, but just wondering what your overall thoughts are and the outlook for natural gas going into 2026.
So like in crude oil, 65 is a historical pivot. Natural gas has a similar historical pivot around 360. And what that means is when prices get above 360, the market behaves very bullishly, and when it drops below 360, it behaves very bearishly. And so we're looking at a kind of a potential test of that 360 mark here in the next week or so. We got pretty close to it a few days ago, and we've bounced, but this is an interesting time of year. Most people expect natural gas to go higher during the winter because we're consuming energy to heat homes. But the reality is the seasonal rally, the consumption or expectations of the consumption of that energy occurs earlier in the year. So this time of year, it's generally a sell the rallies type of market. So I do expect us to see a little bit lower. And I'll put things into perspective as well. Natural gas trading at roughly $4 seems very cheap because it seems expensive because we're coming off a $2 low, but it's a far cry from the $10 we saw 3 years ago. I wouldn't expect natural gas to really have any momentum more than $5, $6, even in the most bullish scenario. So we need to kind of pull back our expectations. What we saw in 2022, 2023 was abnormal, and going forward, we're probably going to see much tighter ranges. I'd say low around $2, highs around maybe $5.50 at the most. So keep your expectations tempered.
Okay, good look at the commodities patch for us this morning. Thank you so much, Carly Garner, Senior Commodities Strategist and Broker at Carly Trading. All right, we're going to go for a quick break here, but coming up, it's time for Inside Out. And we'll take a closer look at FedEx and bring you an example trade for that name when Morning Trade Live returns.
Hey, investors, you know the market moves. Whether you're buying, selling, holding, planning. Whether you're ETFing, a 401k, saving, spending, or even retiring. You can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Alice Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
That could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network. Trade Live. FedEx will be in focus this afternoon and the company reports earnings after the close. Analysts are expecting adjusted EPS of $4.07 on revenue of
Perry, I'll be coming back shortly.
Shares are flat this year and up 2% this month. We're trading around 1.5% or so higher this morning.
We're under the 9.
Change for FedEx.
So we could see the 21.
On this name ahead of earnings, joining us now is Don Nesbitt, who's the Senior Portfolio Manager at FM Investments. Nice to see you there, Don. What are your expectations for FedEx? Because, this is such a good barometer of the entire global economy with regards to supply chains, how things are holding up, particularly with the consumer and small business as well. So what are you thinking?
Good morning, and thanks for having me. And just as you said, there's two things here. One is what is FedEx telling us as they develop their stock about the global economy, about the U.S., about the shape of the consumer and businesses and how they're spending. The other is the stock itself and how its earnings are going to come in, how some of the cost efficiency programs that they've been running over the past year or two are playing out. And also they're going to be having a restructuring coming up this year that we'll hopefully find out a little bit more. They're going to be spinning out their freight division.
You make such an interesting point in your notes about just the calendar year and, where we saw obviously the tariff announcement and how they've had to, obviously model that in some of their guidance too. Obviously there's been a huge amount of a lack of visibility for a lot of these corporates, but this one is particularly exposed to the tariffs, the geopolitical tensions. Just talk us through what your expectations are as far as that and the outlook for this one.
Yeah, and as you can see from the price chart you put up earlier, when these tariffs came out about 2 quarters ago earlier this year, FedEx was a casualty of that, in the fact that they were basically being honest and saying we don't know how to basically measure the impact of these tariffs. And so they were penalized for that. However, last quarter they began to reinstate their fiscal year outlook, and
brought a little bit more confidence to the stock. And again, if you look at the price chart, you can see that it's had a pretty good run up over the last 3 months or so.
As far as the metrics to watch out for, what are the key numbers that you're going to be looking out for when we hear from this company later on, as to what could be the sort of market-moving type of metric to consider later on?
Well, I don't know that there's any major market-moving news in here. The options are implying about a 6% move. However, as you said, they're going to be looking at the earnings, and I think you're going to be diving in deeper to see how their margins are doing, how again their cost reduction and efficiency programs are coming into the bottom line. And again, also on the top line, what's going on in terms of shipping. We've seen the consumer confidence numbers very weak. However, the economy seems to still be moving along. So shipping again is going to help us maybe ascertain exactly the strength of the economy, especially when we've been at a loss for so much of the government data over the last couple months because of the shutdowns.
Okay, all eyes on FedEx later on this afternoon. We've got sitting up 1.5%
FedEx.
now. Thanks so much for that, Don, and giving us a bit of a setup and a preview of this name. Don Nesbitt, who's the Senior Portfolio Manager at FM Investments. Appreciate it. Let's trade it now with Tom White, host of Fast Market. So FedEx and an example trade for us this morning, Tom.
Bullish.
The bar is actually pretty high on this one, Sam, going into the report. And just a few months ago, the bar was actually pretty low. It had been underperforming, but seen a nice pop of about 26% over the last couple of months. The option market priced in about a plus or minus 6% move in the shares, just over $17 either way in this one. But it's getting a little bit frothy. The RSI on a technical basis approaching that 70 level, which is considered overbought. So I looked at a strategy that I don't care which way it goes. I just wanted to maybe move about that one standard deviation that the option market's pricing in at this point. So I looked at a double calendar strategy that actually gives me some upside exposure and downside exposure, and a nice range to trade in to potentially be profitable on this position. So I went out to the December 26th weekly options, so just 8 days to expiration. I'm buying the 305 strike call.
Okay, Christmas gift is wrapped.
And then buying the 265 strike put. So I'm buying a strangle there in the December 26 weekly options. And then in
FedEx, earnings are coming out. There was a cup and handle on PLTR. The heck? IRS agent gave me coffee. Huh? Should I trust it? From the CI department. I was wondering what he was up to yesterday. Hey, Jim. So what about these coffee grounds? Where do you buy them at? What kind do you like? Well, on the SPY, on the 1 hour, if you notice, we hit the 200 EMA for an exit idea. Did you see that? Someone say yes, because I don't think you did. Did you see it? JYH says he saw it. Did you also see that on the hour, the SPX hit the 63 EMA? Did you see that? And did you see on the 5 minute that were coming down to the 9 for support. Do you also see on the 5-minute that we have 3 black crows, thin boxes? Do you also see the tweezer top on the 5-minute? Yep, he saw it all. And the tweezer top. And on the 1-minute, looks to me like a bull flag. Getting ready to squeeze. Right now we're bearish because we're under the, but we're still bullish because the 9's above the 21. You know, if I was a woman listening to me talk about stocks, I would be probably looking for seeking a divorce and find my address. Who is that sexy man tucking candlesticks? Am I right? I bet you are an attractive woman. Woo! You gotta watch how you say things here on live on the YouTube. You're not allowed to talk tranny talk. Well, Jimmy's watching. We're kind of going sideways. We did this yesterday. But we went downwards. And now we got a bull flag. Kind of like build like a little dinosaur here. You got the tail and you got the legs. And you got the hump. And you got the face. A big old long snake. Usually when you see 3 soldiers like this, you sometimes get a little pullback so you can get in this at a cheaper price, but not today. $5.90 was the cheapest I could get. Snake breakout, pulled back, double top, boom. Snake breakout, pull back into 3 white soldiers, boom. I gotta see what time I got. I think it's 12 o'clock. Wrap, 1 gift, $20. You're under. December the 18th. Oh, there's no time on here. 12 o'clock. No, that's that Eastern time? They made a mistake. They didn't diagnose if it was Eastern. Main entree would be breaded chicken tenders or grilled salmon. That's right, no Diddy. I look at a woman's IQ and how they handle themselves. The crowd's going wild here. We're just been going sideways. I think if you just keep watching this, you'll get a short little dip, and then people will get tired of it and then buy the dip. See, right now, it moved down to the 68.20s maybe. Oh, yeah. You ever thought about that, James? Hello? Yeah, have you ever thought about the 68.20s telling instead of having people jump in at $17.70? Wouldn't it be more reasonable if they took the 68.20s at $6.35? Yes, I think that would be a logical idea. Did you take it? Yes, I did, sir. I was able to buy 3 at your 1. We're close to it. Boom. So that's called tuition. After you watch it every single day of the week, every second, you start to realize, okay, something's got to happen. I mean, it's getting old. We need to have it break out or break doubt. And we had to break out. Right there, you made 15% on your 68.20s. Almost 20% right there. How does he do it? Okay. I have this imaginary line of resistance. And I can count to 3, which is very important to be in this trade. So you go 1 there, 2 bits right here, and we're going to extend that line on down to the 2 bits. So you got to 1 'em, 2 bits, and a freebie. So that was the sweet spot. 1 'em, 2 bits, 3 bits, and 4 bits. There's a little red line right there. Extend to the right. 1 of them, 2 of them, 3 of them, Forbes. Boom. That's the sweet spot. So you kind of know if it's not going to work or not when it reaches the sweet spot. The 68.20s from 6.30 is now at $8. Or is it 5.30? Could have been 5.30. I think it was 5.30, wasn't it, Randy? Say yes. Randy, say yes. Whatever you say, Jim. Right now I'm talking about hate. 1 of them, 2 bits, and a freebie. Boom. 1, 2, 3. Boom. Now we're at a double top. SPX double top. Yippee-yi-yi. Ooh. Tesla yesterday. Jim? I was sitting over here next door listening to you on live on YouTube, and you mentioned yesterday about a double bottom on Tesla. Well, I just want to say thank you. I got in that trade yesterday, and then I had to go and breastfeed my little baby girl, and I had to get away from the monitor for a bit. And when I came back, woke up this morning, passed out in the bedroom. I noticed it was at 488, and I jumped in there at 468. I want to give you a big old smooch. Oh, you're welcome. So you made what, $20 a contract? Yeah, I did. Her name's Ethel. You should be grading me magnificent with good grades. People see that, and they'll remember that. better keep an eye on Mister and Coin. Oh, yeah, not today, but soon. Tesla. Tesla stock rebounds after AI sell-off. Why the fears didn't make sense. In another month or so, you'll say, we jumped in on all the dips on AI. What a great buy. We fooled them stupid retail traders. Well. Yesterday looked really pretty for I could have gone a lot more. It was a double bottom on a 15-minute. So you look here, 1, 2, 3, 4 days in a row, we've had a pretty good struggle right at, well, this in here happened later in the day. Still yet, we had a good pullback, but this one happened after hours, which would have probably pissed off a lot of people. Then yesterday's, I was doing okay until that last trade. I thought we'd get some kind of bounce, but man, I was wrong. I mean, I wasn't doing real good, but I was up. I know what the heck, let me throw this money away. But look at that, it's a big sell-off. I mean, well. You kind of expect this thing to pull back some. With a big old hard sell-off, but we've consolidated for the last hour. And that's 15-minute. So let's look at the 30-minute candle. So that's bearish on the 30-minute. And we're staying within that channel, so that ain't too bullish. For it to be bullish, you'd have to break the tweezer top. Yeah, I said it. That's PLTR. Excuse you. My daughter is listening to that. It's quite rude. Well, I see a 1, 2, 3 flips. And I'm going to do a little trick here. I bend the rules. See, I'm going to take the body of that candle and run it to the body of that candle. Why did you do that? And that would hit the wick of that candle. And that would give me an equilibrium, let's say, a better chance of hitting that resistance because we already broke that next one there. So that's a quad. Do you understand? Soon I'll be going into the kitchen, making dinner. I went and paid my personal taxes yesterday. I got to pay it in 2 different places. I think if I won't be much of a material kind of guy when I retire. I think I'll be just the kind of guy that just travels and doesn't have too, if I have anything, it'll be nice, but NVIDIA 175.14 is my resistance channel. 175.14 to 177. Do you understand? For NVIDIA. And we got Netflix. We got to remember all these ones that were good stocks that had all this drama. Netflix under $100. People, what? Fuck, I'll take it now and run it up to 200 or $100. Stock that everybody flocked to ain't flocking to it now. That's interesting, James. We got a special guest showing up. Man, your microphone smells so good. So, wouldn't that happen to be Mountain Rain from Certs? As the IWM comes down, we could be approaching the 200 SMA on the 1 minute time frame. There it is. IWM. The crowd's going wild here at the sports arena. The 200 EMA on the 1 minute time frame. Will it hold? We were standing over there by the pickle bush and Washboardjim called out, IWM off the 200 SMA, and it came down and it hit that son of a gun. I never seen anything like it in my life. And I asked Washboardjim, I said, how old are you? My grandma, she'd like to hook up with you, baby. We got 250 coming up. Boom. Nice little bounce up. Netflix pulled back some. What to do? What to do? So now you got an ascending triangle kind of set up, which is bullish. That's a bull flag. We broke out, and that's a bull flag, and it's called an ascending triangle. Nope, didn't hold. Now we're back at the 63 here, so I'm thinking it's where we bounced before. It's still a bull flag. It's kind of a Darvis box. The 6800s were at 1520, now at 1690. Off the 63 EMA on the 1 minute.
Well, BYD, Hyundai, and others are taking up market share globally. Tesla really needs three things: new models, price cuts, and true level 4 full self-driving. That's the challenge for them. And I think to get to return to past growth, they're going to need all three of those things.
All right, we got those headlines out that the videos emerged over the weekend of Tesla testing out some of its Model Ys without the safety driver in the car. Elon Musk then confirms that they are moving forward towards that, but no commentary yet on whether they've gotten regulatory approval to actually remove the safety driver. It would certainly be a major headline win. I mean, we saw one of those first all-time highs hit this week on that headline. How far behind Waymo is Tesla really, though? And what does catching up even look like at this point?
Listen, that's the big question. So I'm hoping that
it's a good question.
The regulatory approvals. I want to see U.S. companies do well. But the fact is, Waymo is miles ahead, literally and figuratively. So Waymo provides 14 million rides in 2025. They're up and running in 6 cities. They're heading to 30 million plus rides in 2026. It could be as much as 40 million rides. So Tesla, 2 cities.
Excellent question.
16 cities by the end of 2026. They're going international, London, Tokyo. They're moving pretty darn quickly. Tesla's still in 2 cities. It still requires a safety driver in most of the cases. They've got a lot of ground to make up.
So we've got a lot of ground to make up in terms of autonomous driving. We know how you feel about auto and the weakness we're already seeing. They're losing share. Their sales are declining. What about their energy vision? What's your outlook for their energy division? And does that have the possibility to realistically offset some of the weakness we are seeing in auto?
Of course, baby.
I think Tesla's energy division, fastest growing part of the company, could be the saving grace. A lot of people are saying, I thought Tesla was a car company. What is this energy division business? So it could be they're saving the future. And what Tesla's very quietly done, they've become a major provider of power walls. These are the batteries you see in people's garages, but it goes much beyond that. They're now producing what are called mega packs and now energy blocks. These are enormous batteries that they sell to utilities. And with this revolution in artificial intelligence, data centers are forcing the world's utilities to look for new power supplies. Tesla appears to be filling that void. Let me give you some numbers. Tesla's energy division will grow from about 10 billion in 2024 to about 14 billion in 2025.
Correct.
If they can keep up that 40% year-over-year growth in the energy division, that could give the share price a much-needed boost.
So let's say that happens. Let's say they maintain that 40% year-over-year growth. Does the market then start valuing Tesla more like a diversified energy and mobility company, or will they always have this EV overhang?
Well, they have to do both. When you've got a $1.6 trillion market cap, the market can be pretty unforgiving. But the real punchline here is everybody said, gosh, is Tesla a car company or a technology company? The new question that everybody's going to be asking is, what about the energy part of the equation? One thing that many people don't know, energy firms like Vistra, an independent power provider, actually had higher growth than NVIDIA last year. So energy is becoming a bigger part of the equation for the global economy. Tesla has very quietly become a global leader in energy. If they can continue to expand their energy division, that could add real momentum to their growth story.
All right, Steve, so last question here. For investors who are watching, what do you think the single most important metric to be watching for Tesla is in 2026 to know if their growth narrative is back on track?
Well, look, we're going to see numbers soon for what they Q4 and annual sales. I think they're going to be flat for the second year in a row. That's not good. Most all stocks are valued on growth and some metric of profitability. Tesla's got to get those numbers up. The way to do that is to come out with lower cost cars and expand in the rest of the world. In my day, if you won in the US, you're looking pretty good. Then it was you got to win in the US and China. But now the fastest growing markets in the world are China and rest of world. EVs are booming there, but you've got to have the lower cost models that people want there, the $25,000 car, increasingly a $20,000 car. People looking poised to win that are Hyundai and BYD. Tesla's got to get in that mix, and they need a lower cost car to do it.
All right, into the mass market model they may go. We'll certainly see next year. But Steve, we appreciate you taking the time to talk Tesla. Its year that was and the year that's coming. That's Steve Wesley, the founder and managing partner of the Wesley Group. Coming up next, we've got the disruptors. We'll take a look at PayPal after a downgrade at Morgan Stanley. George Tillis will bring us the news behind the downgrade and an example trade. Stay with us.
Oh yeah. 2060. Broke out of the channel.
Network. Tune in 24 hours a day, 7 days a week on SchwabNetwork.com.
How's he do it?
Favorite streaming services. Schwab Network. Available anytime, anywhere, on any device for free.
Whether
Extend
you're
to the
an
right.
investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks?
I do.
Our technical analysis webcast series breaks down different charting techniques.
I do.
Analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Trading 360. I'm Marley Caden here in our Chicago headquarters.
This is Marley.
Down to the New York Stock Exchange for a check on the markets and welcome in Nicole Petalides, host of Opening Bell and the Watch List. Good morning to you, Nicole. You know, we're into the trading day. Certainly a more Christmassy picture that we like to see with the green on the board this morning after we got our CPI number out. You know, what's catching out your eye so far this morning?
I think a lot of folks are talking about the Fed and the meetings that are coming in the new year, and they have so much data that will come in between now and the next few meetings. But today's CPI print, which you mentioned, this inflation print, comes in cooler than expected. And with that, we did see the core number 2.6% year over year, and that was the lowest since March.
So what's that supposed to mean, baby?
2021. It was with that print that we saw stocks moving higher. In fact, the S&P and the Dow now are on track to snap the 4-day losing streak. The NASDAQ is doing well on the heels of particularly of what we heard from
I don't think it was necessary, do you, baby?
12% today on the heels of its number and rallying on earnings and raising its forecast. So you had good numbers there. Jobless claims that were down 13,000 to 224,000, and the continuing claims are also in our sights. The big picture here is most of the guests I'm having on are still optimistic for 2026. Dryden Pence, for example, thought that 2026 would be pretty good. In fact, he thought there would be fiscal stimulus, tax reductions, earnings at 13%. And he named names like Amazon and GE Aerospace and United Rentals as some of his picks. We continue to watch Medline, which was the biggest IPO we've seen in years. Very few IPOs are this size. Rivian was in that group, of the really big ones. MDLN, it soared 41% yesterday, so you could keep an eye on that.
Rivian.
The Micron story really helping names like AMAT, Intel, Western Dig, Seagate, and more. Marley?
All right, and let's talk about Darden Restaurants. We got their earnings report. They raised their full-year outlook for revenue for the second time in a row. What stuck out in this report to you? They are higher today, but just marginally higher right now, about 0.25%.
The big picture is they're just not feeling the pain. I mean, they are noting higher growth numbers. So the projections for the full year are now a growth here of 8.5% to 9.3%. The prior growth projections were 7.5 to 8.5. So really shows you they do plan to see more growth. They talked about the consumer being cautious, but that spending was resilient. They did see a bit
Christmas
of a
party
situation where the lower income folks under 50,000 had a light pullback, but it was easily made up for by the higher income folks. The prices of beef was one headwind. Soaring beef prices, in fact, were a headwind for the likes of Longhorn Steakhouse and Ruth Chris Steakhouse, but they've seen some improvement in pricing most recently in the recent weeks, and said that lower demand and also increased production should help to bring the price down of beef inflation. They also did a few things here. They, for example, looked at GLP-1s and noticed maybe the impact on drinking, or people drinking less. They prepared a lighter portion menu for Olive Garden for people who want smaller portions and or are looking for value. As far as the growth that came in the latest quarter, we did see the sales up, total sales up 7.3%. Same store sales did also beat the street. The best under the umbrella of Darden was in fact Longhorn Steakhouse, and that was up 5.9%. In second place was the Olive Garden, up 4.7%. But this particular name here, which traded as high as $198 today, is still holding on to the green. It lost a lot of the gains it saw earlier. But the big picture here is that the outlook is looking pretty good, and they think fiscal stimulus will also help and benefit consumer spending in 2026. So it doesn't seem that the cautious consumer or the macro environment seem to be a headwind at this time for Darden. And I'll add that Chipotle is also moving forward with more protein. I saw that today as well. So people are eating out. Maybe they're a little cautious on the spending, but they certainly want some protein, it seems. Marley.
I saw that same story, Nicole. So while we are seeing a more cautious bargain hunting consumer, they are still getting their food where they want to get it. And Olive Garden and Texas Longhorn seem to be two of those places. We appreciate you breaking that down for us. That's Nicole Petalides. And now it's time for the disruptors. George Tillis, our senior markets correspondent, is here with the company we're talking about today, PayPal, with a downgrade at Morgan Stanley as it moves from equal weight to underweight. George, what's behind this move to the downside?
Well, this is kind of interesting, and I covered PayPal on and off in the past few years, and this stock, I've talked about it's being really challenged. If you look at the last year, it's down 30%. If you look at the last 5 years, it's down 75%, which is kind of remarkable considering the name and the brand. And they did publish, if you look at their Q3 2025 numbers, 435 accounts, but if you look at the monthly accounts, they're about 227 million, which is a little bit more of a better proxy. If you look at the brands for PayPal, I mean, they include brands like Venmo. If you look at Braintree, which is essentially a web payment solutions business, Zettle, which is point of sale, and Zoom, which is international transfer business. And of course, they're kind of mixed in terms of buy now, pay later. They bought a Japanese, Payify, if you will, business, but they also dispensed of their European buy now, pay later business. But at the same time, PayPal is trying to aggressively compete in the branded checkout space. If you look at that space right now, it's pretty crowded with big players like ShopPay, Shopify, as well as Apple. So there are some competitive challenges as well. Now, I think, Morgan Stanley is really looking at this carefully. Their price target now is $51 from $74. They basically printed a rating now underweight from equal weight. They still see challenges in the checkout space, which is costly for brand integration to start competing aggressively in that area with Apple and ShopPay. But they also talk about Venmo. Venmo is very popular, but monetizing Venmo is a different story. That's been a challenge for PayPal as well. And with that said, margin estimates are declining. And you can actually see this if you go back to last quarter. The company denoted that total payment volume increased by 8%, revenues increased by 7%. The total payment volume is in dollars and cents, and that could be a function of inflation. But if you strip that down and look at payment transactions, they were down 5%, as well as payments per active account down 6%. So that tells you that irrespective of top line sales growth, there's margin compression, and that really speaks to why the stock right now, albeit again trading at around 11 times this year's earnings and even 10 times next year's earnings, which is more than half of the historical average, the stock price is down. It comes down to that earnings growth just isn't there, and we're seeing multiple compression. And what this is the company with about
Can SPY go to the VWAP?
single-digit
That's the
growth rates,
question.
basically stock in not necessarily a value
I think
play,
it can.
but also not a growth play, and that's why the stock has really been an underperformer, to say the least, in the last year, but also the last 5 years.
Yeah, certainly an underperformer, a pretty beaten down here. I did see a headline come across that PayPal's applied to become a U.S. bank as well.
Oh, really?
Yeah.
That they want to become a
Yes,
lender
and that's
here.
That's correct, and you see this across the board to integrate, of course, the capital structure within the banking space. They can bring in deposits and, of course, use that to make loans on the wholesale market level. Affirm essentially is a business that has a wholesale market and a buy now, pay later. But essentially, PayPal is looking to become a little bit more like SoFi in the sense that that company secured a bank charter. And this way, PayPal can essentially get cheap funding through deposits.
So with the possibility of a bank charter sort of lingering in the future, but knowing how under pressure their chart has been, how would you structure an example trade here for PayPal?
Yeah, so those are some good points, because the long-term outlook may be better for PayPal, but right now, in the context of the trend, the stock is trading below the 200-day moving average. So right there, the intermediate trend is bearish. If you look at the price action in the last few months, trading below the 20-day moving average, that also speaks to pressure, at least in the short term. So I'm going to use that as a proxy. That 20-day moving average is near-term pressure. I'm going to structure a bear call spread for a trend continuation, possibly downside, with, again, some room just in case it does move higher. So essentially, I'm going to sell the January 29-day expiry 62.50 call, and then I'm going to buy the 65 call above that. So altogether, this is sold for a credit of around 75 cents a share, or $75 a contract. Now, the premise behind the trade is for the stock to remain below 62.50. Break even in case it does break that level is 63.25, and then you're earning 75 cents. Spread is 250, so effectively $1.75 is your max risk, and that only occur if the stock hits 65 or higher by expiration in 29 days.
Yeah, right now we're at 59.73 for PayPal. George, we appreciate you being with us to walk through that latest note and also for the example trade. That's George Tillis. Coming up next, we've got our 360 round. We'll be taking a look at Micron after it reported its earnings yesterday after the close, moving to the upside today. We'll break all of it down in our 360 round next.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's markets.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Hey, Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. Nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren planning for their college educations. Someday it'll be their turn.
This is Fast Market, built for traders.
Very strange relationship.
We walk you through trade ideas with structure, risk management,
Very strange.
and focus on execution.
From options to earnings to volatility plays, we bring decades of trading experience to every segment.
With real-time insight across products and sectors, we deliver what active traders need to stay ahead. Fast Market weekdays at noon Eastern, live on Schwab Network at schwabnetwork.com.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So
yes, you are.
Further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Welcome back to Trading 360. I'm Marley Caden. It's time now for our 360 round. For that, let's bring in our panel to discuss Micron, trading up more than 12% right now. Joining us, Daniel Kern, Chief Investment Officer at Nixon Peabody Trust Company, and Olivier Blanchard, the Research Director at Futurum. Daniel, we saw a really impressive quarter in terms of the beat that they posted for the quarter and also the guidance. What stuck out to you the most?
It's a great day to be a Micron shareholder. The results were really fantastic. They beat on revenue by a great margin. Their profit was better than expected, really a gangbuster profit picture. Their margins are up significantly quarter over quarter. But I think the two things that really got me were that, one, their forecast revenues, they ratcheted that up to nearly $19 billion. So $18.7 billion is the midpoint of their Q2 revenue expectation. Consensus was a little bit north of $14 billion. That's just enormous. And then the margin side, they're really seeing great margin expansion. They're projecting to hit 68% margins. So from 56.8 to 68% in margins is fantastic. So that's, I think, the first part of the story that's, I think, really interesting. The second part of the story is that they've sold out their high bandwidth memory production for 2026. They've got fully contracted production, showing a really an urgent desire to lock in supply amid demand for AI computing power. So that's, to me, that is incredible. And it shows that the real constraint for Micron is not demand, but it's their ability to expand their capacity. And we saw, I think, encouraging signs about capacity expansion for Micron.
And Olivier, we got this report on the heels of Broadcom and Oracle sort of drawing down tech here. What does this report now mean for the AI trade and potentially reigniting optimism here?
Yeah, so thanks. That's a really good question. So I think, we might have overshot expectations for AI, but the reality is that memory and storage are really critical portions of this big AI puzzle. And whether we might have overshot expectations or predictions for AI in general, and maybe we have to just adjust down, memory is still going to be a huge commodity, and not so much the commodity that it used to be before, and storage as well, where it was sort of like they weren't as sexy as GPUs. Let's just put it that way. But now they're critical elements of this AI boom, right? They're enablers of AI. And so what you see with Micron and with other memory and storage vendors is that because there's so much need for memory and so much need for storage to be able to access all this compute at will, and also to be able to store all this data and these models, it's going to continue to increase. So
we're going to see how bullish we are.
Co-guests earlier point,
IWM here.
What's really important is that demand exceeds supply at the moment, and for the foreseeable future, that's going to be the case. And so you're seeing companies like Micron stating, for the record, that they're only able to really meet half to 2/3 of the demand currently. And so they're starting to work on locking in customers for the next few years in order to ensure that their supply is basically spoken for. So what that's going to do is essentially take away some of the volatility and some of the uncertainty in the storage and the memory market when it comes to AI, and bring a little bit more certainty, at least for the next few cycles.
Well, Citigroup said it this morning. They believe that the AI supercycle has come to memory. It certainly may be indicated in the report they put out, but trading more than 12% higher Micron this morning. We're tight on time, so we have to say goodbye there, but I want to thank both of you for being with us today to talk about Micron and their impressive move to the upside. Daniel Kern, Chief Investment Officer at Nixon Peabody Trust Company, and Olivier Blanchard, the Research Director at Futurum. I also want to thank all of you for joining us on Trading 360. I'm Marley Caden. You can download the free Schwab Network app available in the Apple App Store and tune in 24/7 on Schwab Market and SchwabNetwork.com. Fast Market with Diane King Hall is coming up next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited API fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Hey, Bob. Hey, Andrew. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable. Wait, had a stroke? Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time. Jim's my advantage.
Looks like SPX lost grip.
Years ago. Jim's really been there to answer
We got
questions I ever have, make
796.
that actually cares.
The orb.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
We're getting close.
Pearl Nation, it's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time market moves, earnings breakdowns, and trade-ready insights. Follow me on X at Sam_Vardis and connect with me on LinkedIn or Instagram for more.
SPX.
Welcome to Fast Market here on Schwab Network. I'm Diane King Hall. We're at the top of the lunch hour at the New York Stock Exchange, and the bulls have control of the floor so far today. Let's get right to a check of your scorecard on the major indices. The S&P 500 has a gain right now. It is better by more than 1% at the moment. At the top of the leaderboard there in sectors, you've got consumer discretionary, information technology, and communication services. You do have a little bit of weakness in energy that is weighing on things, but again, still strong gains. for the broadest benchmark of U.S. stocks. The Dow right now has a gain of about approaching 0.5% at the moment. You've got gains
Come on,
in
baby.
the tech sector as well. The Nasdaq is higher, pacing the gains today up more than 1.5%. Give a lot of credit to Micron and the tailwind it's giving for the tech sector. Russell 2000 gain of more than 1.25%. Here's the roadmap for today's show. We'll look at example option strategies for FedEx. It's got earnings due after the bell today. Plus, the team from Lightfolio will be along with new data on Nike, and Carnival Cruise Lines is also on our radar today. Now that we've got the roadmap for today's trading action, it is time to bring in my co-hosts. You've got Tom White in our Chicago studio, and Joe Mazzola is joining us today, stepping in for Kevin Hings. All right, it's a little early, some say, for Santa Claus cheer, but we're seeing a little bit of the signs of Santa showing up, sending Wall Street off to the races today after several days.
We're at the VWAP.
Tom, what's your take?
Diane,
We're
giving
at
us
the
that
200.
humbug. This is maybe the start of that Santa Claus rally. At this point, I think this is what the market wanted more than
It's
anything.
what I want.
You know, when you look at the data that came out today on the inflation front, because that had been the thorn in the side of what the Fed's kind of conveyed to markets at this point. But, you know, if you take a look at it, you know, on a month-to-month basis, you know, December's still down for the NASDAQ and S&P ever so slightly, with the Dow and Russell outperforming that rotation trade. And we've talked about that a lot this week, is the fact that investors aren't getting out of the markets, right? They're just moving into maybe unloved areas. We've seen airlines spike this week. We've seen cruise lines catch a bid. We've seen the Dow Jones Transports, DJT, $DJT, that is hitting near record highs also. S&P 500 equal weight index, while the market was down yesterday, that was relatively flat. So I think that's a positive for the markets going into the last couple of weeks of the year, is the fact that not everybody's getting out of the markets. They're just rotating into maybe areas that they want to get more exposure to, and maybe out of tech, although tech's leading today.
Okay, all right. I promise you I'm not bringing the bah humbug. And you know, Kevin, I think, accused us both of that this week, and he also said it was too early for Santa. But listen, some of the who I hear from say that Santa may be coming early. Joe, what's your take?
I would agree. I think that given the setup of a down December, you know, the question was, did we pull a lot of that forward into November? What could that mean for December? Well, December was basically a flat to down month up until the last couple of days, or really up until today, right? So, you know, we're back almost to a break-even level for December for the overall S&P 500. As Tom mentioned, look, there's winners and losers within every index, within every sector. I mean, think about where we've seen strength this month. We've seen it in financials, industrials. We've seen it in materials, and we've seen things like gold and silver break out to all-time highs. So, you know, there's always winners somewhere. It's a matter of finding that rotation and whether or not that's going to continue. I think, you know, a couple of things that Tom mentioned, I think keeping an eye on the transport.
$5.10.
And with FedEx is important. But I also think keeping an eye on things like the small caps, getting some confirmation that these interest rate cuts that we saw earlier this month, and then the probabilities of what might happen in January and March are really starting to kind of move towards the favor of those small caps. If you do see those interest rate cuts, and we do get some confirmation from the small caps setting all-time highs, once again, I think it sets up for maybe not a one-week rally, but at least some strength heading into the new year, and providing a base case of where we could move.
I'm glad you mentioned the Fed, because that brings up the data point that really set things off to the races. Well, I guess some would argue Micron set things off, but inflation. The inflation print we got this morning was cooler than expected, had a two-handle on both headline and core CPI. For headline, it was 2.7% year over year, 0.2% higher on headline, and then core month over month, and then core was up 0.2%. 12 months, 2.6%. Now, we didn't get October, but November was, I mean, this was solid. And it's like, where does this leave the Fed? Tom, what's your take?
Yeah, if you take a look at that, the core numbers kind of stuck out to me at 2.6% year over year. You know, that's what the Fed's kind of focused on at this point. And that's the lowest level that we've seen since March of 2021. So these are good numbers. You can't push back against them. Now, some of the data might be skewed a little bit because October got taken off the table. This is an accumulation of 2 months worth of data. at this point. But then you start looking at oil prices, even without the core, 2.7%. But then crude oil hit near 5-year lows earlier this week. So that's going to kind of keep coming down. Stephen Myron from the Fed basically been talking about shelter costs. Still up 3% year over year, but that's starting to come down. Remember, that's a lagging data point. That's one of the things they're going to be focused on more than anything. Now, the jobs reports with jobless claims that came in a little bit lighter than last week's pop post Thanksgiving also. So jobs market's weak at this point, but the jobless claims on a weekly basis still reflect that we're still at full employment, even though that unemployment rate ticked up to 4.6%. So yeah, I mean, you can't. This is exactly what the market kind of wanted, was this type of inflation numbers to kind of get away from that 3% level. But that being said, maybe it'll be skewed next month.
I picked one up, 6,800 at $4.70. Now they're at 420.
On CPI and where this leaves the Fed.
So I think the data's murky, and I think you have to take a step back and consider that, because it's still running on, it's slow. We haven't had the ability to collect all of the data, or the BLS has not had the ability to collect all the data that they normally would in terms of the interviews and reaching out for that data. What I would do then is I would, just like anything else, we talk about moving averages on charts with the technicals. You can take a 90-day rolling moving average of what we're seeing with the CPI data, and that does show directional benefits, or at least a
90-day
where we do see inflation kind of moving down, and I think that's good, and I think the market kind of keyed in on that today. The housing, the shelter component, to me, that's an important one, because that's a big sticking point in terms of maybe some of the 2026.
It's like that. Now we're 370.
Making housing affordable again. Now here's where that needs to happen. So a couple things. Number one, interest rates coming down. Looks like we might be setting up for a potential cut. It's around maybe 25-26% probability of a cut in January. But March, interestingly enough, within the last 30 days has moved up by about 15-16% chance to now right around 45-46% likelihood of a cut in March. That's moving in the right direction. If you are somebody that's looking for maybe a refinance or a purchase of a home, and you've started to see prices stagnate, I wouldn't say that they're coming down dramatically for housing prices, but that's something that come midterm elections, that's going to be a big sticking point, and something that the Trump administration is going to want to see come down.
Okay, let's talk about the chips, guys, or memory really is what this started as. Micron is off to the races. It's jumping more than 11.5% right now, sending Western Digital higher. It is sending Seagate higher. NVIDIA is catching a bid today, too. It's really just helping the overall tech trade. Tom, what's your take when you look across the tech sector?
Yeah, you got to look at this, when the numbers came out, you beat on top line, beat on the bottom line, but at the same time, that may be already been baked into the numbers just based on what the stock has done so far this year. It pulled back from those all-time highs recently, Joe and Diane, but then they give the current quarter update, and those are just blowout numbers. Some of those that they looked at, $8.42 a share. The street was anticipating under $4.80 per share, and then revenues of $18.7 billion plus or minus $400 million. The consensus was only $14.4 billion. So those are just blowout expectations. They're sold out of their high bandwidth memory chips for 2025 into 2026. They just don't have the capacity. They're starting to ramp that up. They're starting to build out capabilities for that, but it kind of is reflective that there's still CapEx and demand out there for these products as they build out these data centers and the data, the AI infrastructure build out that we've kind of gone through. So this isn't surprising. And the legacy parts of their business, the pricing's still doing really great on that side, on NAND and DRAM also.
Okay, yeah, listen, Joe, when you look across this, again, to Tom's point, it's really a lot about what their forecast looks like, almost double what was expected. It looks like memory is going strong. It is not a demand issue. Joe, what's your take?
So you know what happens when you predict an 840 to an 850 earnings per share? It pushes your multiple down. And it pushes something like not only your forward PE, but something like a PEG ratio, right? Which is your PE divided by the growth expectations for the next 3 to 5 years. It makes a stock that nominally at where its price might look rich, but when you take a step back and look at expectations for growth, now these stocks they become a little bit less expensive. I'm not going to say cheap, but a little bit less expensive when you're looking at it from that lens, and I think that's important. When we talk about some of the top 5 performing stocks this year, everybody wants to think about the Mag 7, SanDisk, Micron, Seagate, Western Digital. What do they all have in common? These are companies that are kind of old tech, if you will. I mean, the data storage, chips. These are companies that have performed the best year to date, and we don't talk about them enough because we get so fixated on the Mag 7 that it just once again shows that this is a stock picker's market, and you got to do the research to find out which of those stocks are outperforming.
Yes, you do.
That's what some people say, and then there's the expectation of the continuation of into 2026. It's still being a stock picker's market. All right, guys, let's put a pin in it. We have bull versus bear coming up. The guys will get their example trades put together for FedEx. It's got earnings due after the close of trading today. We'll have more Fast Market after this break.
Look at one heck of a sell-off.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
$2.60.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Fast Market here on Schwab Network. FedEx is on deck to report its quarterly results after the close of trading today. Shipping giant is expected to report earnings of $4.07 per share on an adjusted basis. Revenue is projected to top $22.8 billion. The question is, what does holiday demand look like? And investors also want to know the latest on cost reductions and the status of the spin-off of its LTL freight business. All right, time now for the tug of war on FedEx. For that, let's welcome back in our co-hosts Tom White and Joe Mazzola. It is bull versus bear time. Before we get to the example trades, we've got to talk about FedEx. What you're watching here, your take. Joe, let's start with you.
Look, the last segment we kind of mentioned transports and how they've been breaking out. This is a stock that's had an incredible run. I mean, if you were to just look year to date, you would just say, yeah, it's kind of a nothing burger, right? Only up 2 or 3%. But given the fact that it's rallied 60% from the April lows, it's had a really strong run. It's hard to deny what the charts are telling you that. The relative strength versus the S&P 500 is showing that this thing is not only outperforming, but it's building momentum along the way. You could look at something like an RSI, which, some people might say, well, it's overbought at this point. Remember, things can stay overbought for a while. It's not the overbought that gets me concerned. It's when it rolls back down below that overbought. That's something that I pay a little bit more attention to. Something like an ADX shows you that trend strength is improving on its way up, and and even if you don't know any of those indicators, if you just look from left to right on the chart, and the trend is pretty strongly bullish at this point, and they've kind of hit on all cylinders. Now, part of the way that they've beaten earnings per share estimates of late is kind of cost cutting, and I think that there was a lot of probably apprehension in April when it did put in the year-to-date lows. Okay, what are tariffs going to mean to this company? Well, this is the company that's been able to kind of make some adjustments in terms of, and to be honest with you, Diane, the overall economy has made some adjustments in terms of, is this a one-time inflation deal, or is it something that is starting to move past? And right now they're sitting in a good spot.
Okay, that's fair, but also, as you mentioned, year to date, it's a different picture, and on a year-over-year basis, it's kind of stuck in neutral when you look at it a little bit longer term. Tom, what's your take?
I don't know, you look at the chart, it's rallied about 25% from those lows that we saw in October, over 40% from the lows in April. It's gone parabolic. I'm not sure why. Joe mentioned the cost cutting. They've done a pretty good job there. I'm curious to see what they say about their partnership with Amazon now that UPS has pulled back from over half of their partnership over the next year or two with Amazon at this point, or USPS at this point. That's going to be a point of concern. So you have to start taking a look at the partnerships, the cost cutting. How does that equate to margins? They're always a company that's very shareholder friendly, whether it's trying to raise that dividend, buybacks on that front also. But I think cost cutting is going to be the biggest thing. But then again, the death of the consumer has been widely exploited and it's not come to fruition. K-shaped economy probably not going to help, and maybe some of those de minimis, shipping that they relied on quite a bit over the last couple of years is going away also. So probably a lot on the conference call to kind of digest here, but the bar's pretty high going into this report.
Okay, the bar is high going into this report. At first, I was wondering if you guys were both going to come with bull versus bull for today, but I don't think that's happening. All right, Joe, let's start with your trade example.
Sure. So a couple things that I looked at, Diane, is, once again, the setup from the charts. I've already covered this, so I don't need to go in more detail there. But I will say this. I always tend to look at kind of where we are in terms of the implied volatility regime. The markets are expecting about a 6 or 7% move. That's kind of the implied move that's built in to the stock right now. And then just the implied volatility as a whole is kind of below that mid-level, which is interesting because I would expect you would see implied volatility start to really kind of ramp up as you get into the earnings release, and we haven't seen that as much. So, the way that I constructed this was I was looking at maybe buying some of that volatility, and one of the ways that you can do that is by buying an at-the-money or even a slightly in-the-money option, and then selling some upside. The reason I wanted to sell some of those upside calls against it, as opposed to just buying the option as a whole, is number one, to cut the cost of the trade, right? It reduces your debit. But number two, the other thing that I've kind of noticed is as I'm looking at some of the call skews, they're a little bit bid to the upside, meaning this. They're paying a little bit more for the calls than they traditionally do, at least some of the out of the money, maybe say 10% out of the money calls. And by constructing a trade as a vertical spread like this, I can buy something that's at the money, sell something that's out of the money, take advantage of the fact that those calls that are out of the money are priced a little bit higher than they normally are, and that reduces the cost of this call vertical spread. It's not something that involves multi-months. It literally is just a January 16th expiration, so 2026 vertical call spread. When you look at it, I think it's probably a little bit cheaper now. I was wondering, what you and Tom and I said that kind of talked down the market in the last 15 minutes. I don't know. But I'm looking at the January 26th to 280, 300 vertical call spread. When I was pricing it, it was around $9. But in essence, what you're doing is that you're buying the 280s, you're selling the 300. You need to break even at 289. It's definitely a bullish trade, right? You need that upside movement in order for this thing to work out. But if you believe that that this trend is going to continue, it's a way for you to participate in that up until that 300 level.
Joe, yes, your question, just really quickly, sorry, Tom, just yes, what happened? What more does the market want? You got the cooling inflation, you got Micron, and yet we're flagging a little bit, still got gains on the S&P 500. Tom, I know you have thoughts on this example trade before you get into yours.
Yeah, pretty directional on Joe's. I think one of the keys is this isn't an earnings type of play, or well, it can be. But you still got 29 days till expiration. You got a month in this position, and you can take advantage of a move. If it moves tomorrow post earnings, you can take advantage of it because you get some flexibility as far as trade management goes. But let's break this one down. January 16th monthly options, 29 days to expiration. Buy the in-the-money 280 strike call, and then against that, sell to offset some of the costs on that bullish call purchase. Sell the 300 strike call. You're paying roughly, we've got a $9 debit up here. That's where it was trading earlier. It's trading closer to $8.40 right now because the market has given up more than half of its gains at this point, and FedEx has come in a couple bucks. But the debit you pay is going to be risk. So if you pay $840, if you pay $9, $900 per spread, that can expand to $20 if we get above that 300 level at expiration, but you got 4 weeks in this trade. I mentioned that flexibility. If you get the move that you need, market's open, you can maybe close all or a portion of your vertical early. You don't have to wait until expiration if you get the move that you want, but you definitely need about a 2% move to the upside to get above the break even here of $289 on this directionally vertical spread that gives you a little bit more duration. So there's the bull portion of our program. So I'm going to flip the script here, Joe. I'm going to look at something a little bit more passive, where I can still take advantage of a downside move, but then, hey, if I'm wrong and the stock was higher, I can still have a chance to be profitable on this trade. So going out to the December 19th monthly option that expire in just 1 day. This is a pure earnings type example here. Sell the 297.5 strike call, then against it by the 307.5 strike call. Short $10 wide, neutral to bearish, call vertical. You're going to collect a credit. I got 250 credit on there. It's trading closer to 210 now because, as we mentioned, the stock is lower. But the credit you collect is what you can make on this position, $250 per spread with $750 in risk. But Joe, it takes your break even up to the $300 level to the upside. That's about the one standard deviation move that the option market's pricing in. But you got a better probability of success on this one because you profit in 3 out of 4 scenarios, Joe.
Yeah, my trade needs movement, and it needs movement within before that January expiration, or if you get a big move tomorrow, as you mentioned. I think another key difference is this. The way that you've constructed your short strike puts it above that 52-week high. And so for a stock that's had that 50% or 48% move, I guess, from the April bottom to where it's at right now, you're not talking a tech stock, you're not talking a high growth company, you're talking an industrial stock. So it's one of those it's one of those trades where you might be thinking, hey, this move has already been baked in that we've seen up to this point. I'm fading the rally a little bit, but I'm doing it in a way that's risk defined. So in case I'm wrong, I know what my risk is to the upside. So it makes sense. I think this really is a bull versus bear. My trade is bullish in that.
Oh yeah, we're definitely at resistance levels
to be profitable. Your trade, by selling the call spread, you can move as long as it doesn't move beyond that kind of one standard deviation.
Yeah, I'd say so. FedEx.
7.5 strike call. About 75% probability of finishing out of the money, which means that you've got more risk on this type of trade, but you're giving yourself a better probability of success on the
They know it too.
Bearish short call vertical. So there you go, Diane. There's your bull bear debate.
There we go. It is bull
there
versus
we go.
not bull versus bull. We got cash tags coming up. The team from Likefolio will be along with new data on Nike. The shoe and
I need a breakout.
Set to report its results after the close of trading today. Stock's been a major it's been an underperformer year to date. Stay right here on Schwab Network. Fast Market will be right back.
Hi, I'm Alex.
I'm Jane.
And I'm his mom.
And I'm his mother.
No, you could have done better. Same goes for where you invest.
You missed out on that one, baby.
And invest smarter with Schwab.
I'm Sam Vardis, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time.
And I'm his
Stream Schwab
mother.
Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support, email, and in-platform chat. Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis,
It's not true.
futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
That is not true.
No politics, no spin, just the market from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
Welcome back to Fast Market here on Schwab Network. I'm Diane King Hall alongside Tom White in our Chicago studio. Time now for our cash tag segment. For that, let's bring in our next guest, and that is Landon Swan, co-founder of Lifefolio. We're taking a look at Nike today. Now, Nike's been a big underperformer this year. It's, trying to make some kind of comeback. Landon, when you look across your latest data, what does the landscape look like for Nike now?
Yeah, I mean, I think you could expand that statement and say it's been an underperformer for quite a while. I think back to 2021, the stock was $179. It's $66 now.
Ooh.
And it's just been a steady downtrend. Even this year, it's down, 14% basically on the year. So
Yep.
yeah, it's definitely an underperformer.
So what happens when you go out there?
And with them is...
That was like when you were in prison.
They shifted away from wholesale and started,
they went woke.
Looking towards direct to consumer. And frankly, it sounded great. Like, let's get higher margins. Let's cut out the middleman. I mean, I can remember coming on this show and talking about how that could be like the death.
Something
of
happened here.
Right? But it did not turn out that way. And they're starting to reverse that course.
Jimmy's green.
We talked about sales to wholesalers were up 5% globally, 11% in North America. So, Foot Locker, like I said, Dick's, JD Sports, they're getting back in the game, and they get that shelf space, which Nike really needed. I mean, they have probably one of the strongest brands in the world, in the history of the world, but even then, they still need to get out there and get.
How does he do it?
It just can't be all direct to consumer. Now, when we look at the data specifically around Nike, it's, among all of their competition, they're the worst. They are negative 6%
How does he do it?
year-over-year basis, where everyone else is positive. And so, we talked a lot about different companies this quarter. Lulu was one of them that we were pretty bullish on. And, OnCloud has been doing really well. But
how does he do it?
They're at the bottom of this list here. So even Decker Outdoors is beating
going small.
Exactly direct competition, but still footwear. And so
and then you
I
average
think the story here, though, is it's all about what is this company doing versus expectations, and that's always kind of the asterisk that comes into the play, because if it was just, well, are they doing well or not? No, they're not doing well.
They're doing horrible.
List. But that number, that negative 6% number on this chart, a quarter ago it was negative 18. And so they're moving in the right direction in that regard. The stock has sold off. There's a lot of reasons that it's sold off. They've been struggling. Their margins are under pressure. Their margins went
We're at 350.
42%. That's a big move. They're expecting, I think, another 3% move down on margins as they're absorbing tariffs, but also clearing inventory, and they're having to do that with selling cheaply to discounters and things like that. But once they get that cleared, it was down about 2%. Once they get that cleared and they start to adopt this back to the sort of the wholesale model, which is proving to be successful, I think we could start to see a little bit of a turnaround in Nike. Now, it's a question of what happens on this report. That's what people want to know, because, that's where you can make money on earnings. But I will say that, again, negative 18% last quarter. Now we're at negative 6%. The stock is down 2% year over year. I think a lot of people are expecting some pretty bad numbers. I think this could be one of those, the bleeding is stopping sort of trades, right? This is the chart you can see here on the, our data in the blue line, the stock on the dotted line. Don't be fooled by the seasonality on this one. This is not a huge divergence play. Nike's not all of a sudden surging. This is seasonal, right? You can see that spike every Christmas shopping season. This one is smaller than last year. So again, we're negative 6% year over year. So it's not like Nike surging. The data is still negative, but it's less negative than it used to be, and the stock is down significantly. And I think the way that
it's not funny.
guided down over the last quarter.
Well, I'm getting ready to go to a party.
A little bit of softness, and I think investors, they're
at the IRS,
obviously, and they would expect some softness as well. So I think that we're probably going to see numbers sort of in line or maybe slightly better than what investors are expecting.
I'll probably be trading the stock.
The bottom is in, buy out of the money calls kind of situation. But I do think the bleeding is definitely slowing, and Nike could be starting to make this slow turnaround. It's been a big bleed for the last 5 or 4 years. And I do think
we're back to the slash ESV WAP.
You can see the bottom. And you never know, a good report here could spark something. So overall, we got a slight.
If we break it, this thing could jump up a couple bucks.
Very low expectations.
Landon, I look at this and I think it's competitive pressures at this point. I look at on running, I wear those shoes now. I'm never going back to Nike. I didn't wear Nikes that much anyway, but
neither did I.
I'm not wearing any of their clothing. I'm going to Viore
They're
and
too
Rogue
query.
and all this other stuff. That's probably better quality. Maybe it's more expensive, but at the same time, is that part of the problem with these competitive pressures coming down the line from all these new startups and starting to establish
Randy wears
themselves,
Nike.
that people don't look back and go back to a brand like that, and this win now strategy that Elliott Hill is trying to do, do you think that has any legs at this point, or is he just still grasping at straws?
Look, I get it. I completely agree. The competition, the competitive landscape for Nike is rough. I mean, they have some really, really strong competition, and anecdotally, I agree with you. I'm buying On Cloud, Lulu, Viore. I don't think my wife buying any of that stuff. I don't think my kids are even wearing Nike right now. So
okay,
yeah, I agree. I think that they've kind of been.
We got to break resistance.
But when you look at the last quarter earnings report, running sales to run.
These are at $3.40. Jim, have you ever thought about selling?
That's a very low bar that they were coming off of.
You're up $38 a contract.
And so they're starting to turn.
You know how much money that could bring in to your family, feed them tonight?
Them, get a sales pitch, get the right size, all of that. And I think that they're still feeling the effects of that direct to consumer. And maybe, I think they got, a little bit cocky and said, hey, we are Nike. We can do anything. Let's sell to the masses directly. Let's cut out the middleman. And, as they became less and less in people's faces.
No, they didn't get cocky.
The competition started to, hey, let's check.
They got wokey. Brandon. Okay. Jimmy's up almost $92 a contract. $98 a contract. Have you ever thought about selling? Yes. Yes, I have. These are right now at $390, $410. Like 420. 420. Oh yeah. Perfect. Thank you very much. I'm Washboardjim. Get in cheap and then sell them at the highest price you can before you go to a Christmas party. From Washboardjim, I will be heading out. $4.80. $5.30. Ooh, this is pretty good. How's he do it? No. We were just all sitting here watching one day, and Washboardjim came in here and started trading stocks. Now he's broke resistance levels. And I gotta go. Never turned down a good Christmas party. I think there's going to be dancing girls here too. 3 white soldiers, $5.60. We're getting close to resistance levels.
This could be the one. We don't have a super positive score on them. We're plus 22.
We're at resistance levels.
Based on low expectations. But I do think that, you know, if I were to play this one, I would play it to the upside. Not looking for a huge move, but maybe just a little bit to the upside. Again, all on low expectations because they are very low.
All right, we'll leave it there for today. That's Landon Swan, co-founder of Likefolio, with the latest look at Nike, especially as it compares to other peers and competitors. So for the trading perspective on all things Nike, we got some good insights from the Likefolio team over there. When you think about what Landon brought and just how you've been watching this one, what's your final thought before we jump into the example trade, Tom?
Yeah, the bar is low. I think that's the biggest thing. You know, this hasn't been a 1 or 2 year story. This has been a downturn and a falling knife since 2021. So 4 years of losses for this stock. So the bar's low. So Elliott Hill, he's going to have to give some clarity on this win now strategy. I think that's the biggest thing. But I got an example trade here, Diane, that sets up with exactly what Landon said. If you're bullish on this name, this might be one of the ways that you can look at this. So I went out to really short-term positioning, December 26th weekly options that expire in 8 days. I'm going to buy the at-the-money 66 strike call. And then against that, in the near term, December 19th weekly or monthly options that expire in just 1 day, I'm going to sell the 71 strike call. That aligns up with about that 1 standard deviation move that the option market's priced in, which is about $4.50 either way in the shares. So it's a $5 wide bullish call diagonal. I'm paying roughly about a $2.15 debit for it. Might be a little bit cheaper than that. Stocks have come off. But the debit you pay is going to be your risk. So $5 wide bullish call diagonal, I'm paying less than half the width of it. Only $2.15 or $215 of risk per spread on this. It takes advantage of upside. You see where it peaks out as far as profitability goes at or near that 71 strike, which aligns with what the option market is pricing in. But because I'm paying less than half the width of it, anything above maybe the 67 level is going to be profitability on this position. And the reason I'm spending so little on a $5 wide call diagonal is because of the vol dispersion. I'm buying on aggregate in that 66 strike call in the December 26 weekly options, about a 67% implied volatility on aggregate. Selling in the near-term options where I'm selling that 71 call in the December 19th monthly options, selling about 158% implied volatility. So that dispersion lowers the entry point price on this. It's definitely a bullish trade. On a percentage basis, you don't need that big of a move, less than 2% to get above that break even near $67 at this point. You've got some assignment risk on that short option going into expiration over the next 26 hours or so. But a bullish trade here, Diane, that sets up with Likefolio's data, but also takes advantage of near-term higher implied volatility.
Okay, different direction than I originally expected. I mean, I did know that this was, kind of your headline approach, but before I knew, I was like, I wonder if he's going to take the, that bullish angle on this one. We shall see how this works out. Thank you, Tom. Coming up, we've got the breakdown. We're taking a look at Carnival, which is gearing up to set sail with its results tomorrow morning. We'll be back after this short break.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com.
And on all your favorite streaming services. Schwab Network.
Available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Fast Market here on Schwab Network. I'm Diane King Hall live on the floor of the big board. Before we get to the breakdown, let me give you a check on where markets stand as we get closer to the bottom of this hour. We have some turbulence in the middle of this hour, but the S&P 500 right now still has a gain. It's got a gain of 1%. It's reclaimed some of that, what we saw earlier in the hour. The Dow has a gain of 0.4%. It had turned under a little bit of pressure midway through this hour. NASDAQ 100 better by 1.8%. Western Dow has a gain of a little bit more than 1%. Shares of Carnival are higher ahead of the release of its results. Those are due tomorrow morning. The cruise liner is expected to report earnings of 25 cents per share. Analysts are busy this week adjusting price targets around Carnival. UBS is the latest, raising its target today, while Barclays lowered its target yesterday, both around the same level, though. Time now for the breakdown. For that, let's welcome in George Silla, senior markets correspondent, for a look across Carnival and expectations heading into its report. All right, George, so let's dive into this one with Carnival and talk what you're seeing in terms of expectations.
Well, I mean, if you look at the EPS numbers that are expected to report on an adjusted basis at 25 cents, that's about 78% higher than last year. Only on sales that are higher by 7.2% at $6.36 billion. So the question is how are they generating all that EPS relative to sales? I think the story here for Carnival, but also other, of course, transportation companies like airlines and the other cruise liners as well, is they're actually selling fewer available parts, if you will, or in other words, bookings, and charging more. The story is really about elasticity of demand and generating more operating leverage in this space. I think if you look at last quarter for Carnival, they demonstrated essentially more capacity utilization. Bookings were, occupancy was over 100%, 112%, and that speaks to basically increasing the children's bookings, but also group bookings. They're adding more passengers per cabin. And essentially increasing the operating leverage. You also have to consider the aspects of fuel right now. They're actually quite favorable in this space for diesel fuel, which these major cruise ships utilize. That's also essentially there. But the moral of the story, I think, for companies like Carnival and the other cruise liners is that the capacity, in other words, total cabins really hasn't increasing, but they're increasing the revenues on a per cabin basis. And that's really important in the context of the industry group. They're keeping supply tight, increasing occupancy rates, and that's again increasing marginal revenues, while at the same time the cost of the ship but also the cost of the fuel is relatively constant. So it's really a story of microeconomics that's going on with Carnival, and I can see why the analysts are still quite bullish on the name, irrespective of the fact that if you look at last quarter, one hang-up was that the passenger carry actually decreased by 3%. But at the same time, long-term debt decreased by 6%. And the challenge for Carnival, relative to the other names in the space, Norwegian, if you will, and Royal Caribbean, is the debt load. And if you look at the debt load for the business, albeit again it's declining because free cash flow is improving, still around $25 billion compared to market cap around $36 billion, sales around $26 billion. So unfortunately, that legacy debt that Carnival still holds is essentially keeping, I think, the stock down. But irrespective of that, the stock is higher in the last year by 9.6%, or the last 5 years by 31%.
Yeah, Carnival is not at the top of the list for the cruise liner Royal Caribbean. has that title, and that's been strong. Royal Caribbean has been an outperformer compared to the S&P 500 this year. Carnival still almost keeping up to me, you know, when you look at it. I mean, behind the S&P 500, but for its positioning, it at least has a gain versus Norwegian, which I know for Norwegian, a lot of that has to do with debt. For Carnival, so it seems like from my takeaway from you, George, is that it's about the pricing and being able to hold that up. But I also see they're, you know, kind of capitalizing on some big events like FIFA coming up next year, the World Cup happening, with, you know, having a relationship there. What's the final thought you want to leave us with when you look across Carnival?
Yeah, so that's, again, you kind of explained essentially some of the challenges that price action for Carnival is facing, and that really comes down to the balance sheet, which again is improving. So that's something to be mindful of. I think that the demand for the cruise industry space is still strong, but ticket prices are rising faster, and capacity utilization essentially is increasing. So all these, you know, core microeconomic metrics are improving. But again, it really comes down to, you know, guidance that the company's providing. But also, you got to keep in mind that fuel prices have been relatively tame, and that's a catalyst. And seasonally speaking, too, all the travel leisure stocks, whether it's airlines or cruise liners, typically do very well in the back half of the year, seasonally speaking, and the first half, the first you know, couple months of the year as well. Especially cruise liners, where you know, winter is coming across North America, and people want to experience something a little bit more beneficial in terms of seasonal weather patterns.
Warmer weather, to put it in, you know, the speak we like down here. I'd love some of that sun here in New York. Thank you, George. That's George Silla, Senior Markets Correspondent. All right, let's get Tom back in here for example trade purposes. So, Tom, you got the example trade in Carnival. How are you approaching this one?
Yeah, it's pretty straightforward. You know, I always look at trades like this. It's a low price stock, right? It doesn't have a lot of extrinsic option premium built into the option market at this point. So I looked at a strategy that's basically a stock replacement type of strategy. It's a straight call purchase if you think the stock's going to go higher. Now, if you think it's going to go lower or just kind of stay where it is, don't do this type of trade. But this is also in that realm that Joe Mazzola came with. I'm not doing an earnings play. I'm giving myself duration on this one. So I went out to the January monthly option, so 29 days to expiration, and I'm just going to buy a high delta in the money call. And I looked at buying the January 27 strike call. It's nearly a 70 delta on that call, so it's going to react more like the stock, right? If you were to buy 100 shares of stock, that's going to cost you about $2,800, right? Because it's capital intensive. Now, you buy one of these calls and you pay a $245 debit for it, your risk is $245. So it's less capital intensive. That's why we call it a stock replacement. Now, it's got a delta of 70, so it's not going to react one-to-one what the stock move is going to be. It's going to move 70 cents versus a dollar move in the shares. So you have to take that into context also. But this is a bullish straight call purchase, buying the January 27 strike call, paying a $245 debit. That means over the next 29 days, you want the stock to go above that break even of $29.45 to the upside. That's about $1.30 above the current share price. So not that big on a dollar for dollar move. And the key here is, Diane, that I'm giving myself duration on this one. I've got 29 days in it. So if you do a trade like this and you get the move that you want, where the stock maybe goes up to $30, $31, $32, you could, you know, if the market's open, you could close maybe all or a portion of it early if this expands in price. But if you don't get the move, you still have 29 days if you're still bullish on this position. But a straight call purchase here in CCL if you think the stock's going higher over the next month.
All right, so you have a little time in this one to adjust if necessary. That's going to do it for us today on Fast Market. I'm Diane King, all alongside Tom White. Our thanks to Joe Mazzola for stepping in today. Download the Schwab Network app. It's available in the App Store and tune in 24/7 on schwabnetwork.com. Stick around. You've got Next Gen Investing coming up.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Hey, Bob.
Hey, Andrew.
Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, I had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant. I Crow met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Live insights, actionable data, and market-moving analysis. Schwab Network connects the headlines to the why in real time. Watch free 24/7 at SchwabNetwork.com.
Welcome to Next Gen Investing. I'm Jody Horn, and let's check in on the markets here at the noon hour in Chicago. And we are seeing a really nice session, which is a very different tone than we've seen to start off our show, at least over the last 3 sessions. We are higher now in the S&Ps by about 1%, Dow up modestly, about 0.4%, NASDAQ out in front though, up 1.8%, and the Russell 2000 also pretty decent session here, as we are also significantly in the green, up just shy of 1%. So a lot of the driving force of these markets today has been hugely riding on Micron's more positive commentary in the AI space for the rest of this year, as well as a CPI print that came in cooler than expected. So finally, some positive inflationary data that we were able to dive in on after, of course, we saw some delays regarding economic data and the government shutdown. But joining me now to break down some of today's top movers is Sam Vadas, host here for the Schwab Network. And so Sam, wanted to get your thoughts here. As Alex and I have been saying at the top of the show for the last several days, we're like, well, we're lower, but we are still right around all-time highs. But now today, firm green session.
Yeah, we've been sort of asking all week what exactly is going to be the catalyst that gets us out of this rut. It looks like today we are seeing somewhat of a relief rally, and that comes off the back of the 2 stories that you mentioned, which is really driving the market narrative for today. It's the micro
and the macro and the micron. Obviously, we've got the macro story, which is the CPI. That came in below that 3%, which was the market was looking for. And so that seems to be easing some of the expectations now around some of the price pressures, particularly off the back of some of the commentary we've been getting from the Fed speakers as well about how some of them, like Waller, are not too concerned about inflation. They are concerned about the softening in the jobs market. So this sort of took the pressure off a little bit, but it's important to highlight, and I was talking to Liz Ann Saunders about this as well, we do need a clearer picture and a more clean picture of what is happening now with inflation, because don't forget, this has a few holes in it because of the fact that we didn't get the October numbers, so not a huge amount to work with on a month-to-month basis. So let's see if that very much is a trend that we continue to see, not just one data point, but then we also have the micron story, obviously, with some calling this the AI super cycle. Obviously, we had a lot of bullish sort of sell-side analysts who are going into this report. Everyone is very optimistic and positive on the memory prices because of the shortage. We've been talking to analysts about how the data centers are really sucking the oxygen right now, and so we saw that reflected in the numbers, and that seems to be bringing some relief to the whole AI story and the jitters that we've seen in this market recently about some of the valuations, about where these companies are actually getting their money from, tapping the debt market to fuel their AI ambitions. But suffice to say, as much as we've seen, obviously this reaction today, Liz Ann also pointed out to me that this is a market that we will continue to see in fits and starts, where obviously we get some good news, which offers some relief to the markets. We've seen stocks up, yields coming off a bit, but this still is a market that is a little bit on edge around some of the AI bubble concerns. People who I've spoken to don't believe it's going to pop anytime soon. That's not going to even be a 2026 story, but it is very much something that has been on the minds of investors, and why we've seen that rotation out of some of the high-flying names, and many do expect this to continue. But yes, two pieces of good news today, at least, Jenny, that we are seeing shared.
Okay, and I will say that also too, some of these other names that are not involved in perhaps a pure tech play. And we've also seen some decent numbers put up this week. I feel like we all focused, and the market does tend to focus more on Micron, but I mean focusing here on like Darden Restaurants, which actually saw higher profit. It shrugged off some of this beef inflation, which I was not even aware that I'm very in tune with the grocery store inflation overall, but beef inflation was not on my radar. But I mean, walk us through some of this report, because I will say that as far as some of their trends, encouraging that they mentioned already seeing some pricing pressures easing in the current quarter just in the last few weeks.
Report out of Darden, as you mentioned. Look, cattle inflation has been a big story for a lot of these in the business of food. This is obviously something that this company has been grappling with as well. We are seeing shares are higher today, and that came off the back of a beat on revenue. So what they saw was strong sales growth, and that was thanks to Olive Garden and Longhorn Steakhouse as well. So same-store sales 4.3%, so that was better than the street's estimates at 3%. So Olive Garden, which makes up nearly half of those sales, the sales growth saw 4.7% growth, and then Longhorn saw same-store sales at 5.9% growth. So very, very interesting numbers as far as where consumers are at right now. Also with some of that cattle and beef import prices, they did hike the full-year outlook as well. Net income $237.2 million. The higher costs for ingredients have been weighing on margins, and they did talk about higher beef prices as well. But they also talked about how people actually might be going to some of these restaurants because they could be actually the same price or cheaper than buying it from the grocery store. That was a really interesting takeaway. A lot of their success has also been put down to the fact that they are raising prices less than inflation and also rolling out a lot of these promotions too. So $13.99 never-ending pasta bowl. I mean, you're speaking my language right now. It's lunch o'clock here on Wall Street. Olive Garden's delivery business also has been helping things out as well. They're trying to address the value-hungry customer right now, Jenny, who isn't. But they are seeing higher income consumers trading down. So that's an interesting trend that we've been tracking this year as well. Demand from diners with lower incomes were actually lower. More customers who are 55 years and older came through the door. So that's really interesting as far as traffic trends. But Longhorn actually saw more traffic coming from consumers who made less than $50,000 a year. So very interesting as to who is coming through the doors here at some of these places as they are looking for value. But then, as far as what the analysts are saying, I saw Guggenheim analysts lowering the firm's price target recently to $230 from $235, giving a buy rating on the shares here. But you know, they have been talking about the cost pressures coming from the steak as well. So it'd be interesting to see if there's any changes off the back of what they've now said. But yes, look, just looking across some of the analyst consensus here, I mean, you do have a big cohort actually in the whole camp. 11 with a buy rating, 9 with a strong buy, none in the sell camp. So people are looking pretty positive on this, as I think, you know, what they're doing here with the promotion seems to be working for them.
Okay, and the endless possible, also, you can tell it's lunch hour here in Chicago, because that is all the visuals I have seen today. I'm like, I have to go to Olive Garden. I think it's been years, and I'm always down for, you know, the never-ending bowl of food, because that is just, you know, the best value you can get right now. But speaking of, you know, finding that value and where consumers are flocking, unfortunately, doesn't seem like it's voting quite so well for CarMax, which has been for years and years really our leader of the used car space. We've seen now competitor Carvana growing in sales each quarter. Stock is, I mean, been on a tear this year. CarMax has been a very different story. We're down about 50% this year. Plus, we've seen plunging sales, plus the departure of their CEO last month. But I will say they did beat earnings and sales expectations. They have plans to reduce margins. I mean, tell us your thoughts here, because another name that is actually has been pretty volatile. Shares did fall initially, then actually were higher. Now we're down over 4%.
Yeah, you raise an interesting point, because it really feels like a tale of two corporates here in this business, particularly when you look at Carvana, what they've managed to do this year as well. A very, very different story here. So CarMax out with earnings. We are down 4.5% off the back of that. What they saw was a drop in revenue and profits, and that was really driven by these falling prices for used vehicles and weak demand. So people just aren't buying as many used vehicles as they had been. Revenue falling 6.9%, profit 62.2 million. That was down from the 125.4 million that they'd previously seen. It is facing challenges with reselling some of these cars at higher prices than it paid for them. They are seeing they had been seeing demand very much off the back of the tariffs this year, but the rate of people buying now during this particular quarter actually fell 12% to 238,000 vehicles. Now, obviously, they've also had some challenges to do with leadership. The CEO, Bill Nash, stepping down too, so this is off the back of facing pressure with respect to what the performance has been like at the company. So they're in need of a change. That seems to be what the street is feeling about this one. Looking to cut costs also by the end of fiscal 2027, so it's cut its workforce in Q3. It's going to try to boost marketing in this quarter as well. So that was basically the main takeaways from this report, that they need to do better. They've recently faced a number of downgrades. If you just take a look at what the sell side has been saying here, Needham recently downgrading this name, previously bullish. But this thesis was based on a return to growth in units, leveraging their position in the industry as a leader in used auto. But they're now saying that it is a choppy macro recovery, and intensifying competition from digital-only players has pushed unit growth back into negative territory. So that is the reason behind their downgrade. They also have talked about a new CEO, a refreshed strategy, having the potential to drive increased investor enthusiasm. So far, we obviously haven't seen that. That remains to be seen. But they do talk about a prolonged period of uncertainty on this name as far as the near-term outcome. And then you also had RBC Capital downgrading this name, also to set to perform from outperform price target of $34 down from 59. And they also talked about the CEO guiding through Q3 comps well below consensus as well. And they do believe that a lot of things are unclear with this name as well, particularly with the announcement here of the CEO and then also the macro environment too. So they say neither is a great outcome at the moment for this name, which is perhaps why we see shares down 4.5% or so right now, Jenny.
Yeah, it used to be seen as CarMax was, I mean, like the leader, the market share dominant of the space, and I think it's been to Carvana's credit, and more that digital push, as you mentioned, where we've seen this success. I still have a hard time just comprehending fully buying a car online. Maybe that is old school of me, but that is probably the world that we're now living in, so I should probably get on board and maybe start to own a car one day. But now to look at our next name here today, not an earnings mover, but GE Vernova, which has been one of really our leaders out in front, but we've pulled back pretty substantially just over the last several sessions. And I mean, today we are actually up about 4.7%, but did hit a high on December 10th at $731 a share. So we pulled back now about 12% from those levels, Sam. But all that to be said, still some analyst commentary today that is hugely optimistic. I mean, I do feel like the street has really started to love this name, and that's just continued to gain traction.
Well, I mean, there's a lot to love about it because, I mean, the view out there is, you know, something's got to power all this AI demand. And so that's why a lot of analysts see this one as well positioned here. So let me just run you through the note, then I can talk about the stock and why it's so closely correlated with what we're seeing as far as technology. So we did see Jefferies upgrading shares to buy with an $815 price target. We're currently trading at 641 and change right now. Basically, they're positive on the outlook for power given gas pricing, services visibility, and the outlook for electrification. So this stock has been up, you know, over 85% this year. Right now, year to date, 95% higher, I should say. So this has largely been driven by the expectations that, you know, they need all this power for all of this AI demand. And so that's where obviously we've seen a strong correlation to the tech trade, the AI trade, when we've seen some of the cracks appearing, particularly in the AI trade. We have seen a little bit of a pullback in GEV here because it is so closely tied to that particular story because of the need for energy for a lot of the data centers. So that certainly seems to be some of the commentary that I'm seeing out there as to why we've seen this share performance. You know, a bit of a head scratcher given that we do very much need all of this electricity, but yes, it is making a comeback after a particularly bad day yesterday. I think it was down in double digits or something on a lot of the AI jitters that we've seen. I mean, we saw a broad pullback in technology, but yes, it is bouncing back today on sort of this broad recovery, and then obviously what we're seeing coming from Jefferies. But this week, you know, it's not Jefferies, it's not the only one. We have seen others coming out talking about, you know, raising the firm's price target here as well from the folks over at Goldman. They're looking at 840 from 735, giving a buy rating there. They say it's really basically a power sector that's at an inflection point right now, and so they say that this name is pretty well placed to capture some of that and gain some exposure from that, particularly when you look at some of the fundamentals. There's also a lot of attention, I think it's important to point out, there's been a lot of sort of reports around this as well, around the fuel cells now, Jenny, too. You know, the company has also been talking about manufacturing that. They're looking to work on this particular device. And this is like a little fuel cell that operates as basically like a generator or a little battery. It kind of looks like a big fridge, is what it's been explained to me, and I've seen pictures of. And this is something that Bloom Energy is in the business of, and we've seen Bloom Energy shares absolutely skyrocketing this year. So this is something that obviously is going to be, I suppose, the next thing that people are going to be watching as far as the commentary I'm seeing, particularly as they are now talking about timelines for commercialization with that specific fuel cell as well. So maybe something to look out to with this one.
Okay, and I'm so glad you mentioned Bloom Energy. It took the thought right out of my head, because that is something we also saw trade significantly lower alongside a GEV yesterday, as there were a lot of these nuclear energy exposed names under pressure. I saw reports that it could be linked to that Oracle story in regards to the reports that Blue Owl Capital could not be providing that $10 billion funding deal to build the next data center, but that seems like we still have gotten further details. Oracle kind of refuted that story later in the day, so did see some widespread weakness, though, that affected a lot of these more alternative energy players, which, I mean, as your point, to these stocks' credit, they've all been on a phenomenal tear this year. I mean, Bloom Energy is up now 258% this year, so big pullback, yes, but still, I mean, a huge winner. And actually, last name today is a more, I'd say, quiet winner, and that is Rivian, because it doesn't always generate the same buzz as its bigger, older peer being Tesla, but today up 7.7%. And I've seen these analysts calling this now 2026 the year of the R2, which is supposed to be that mass marketed vehicle. So I'm excited for this company to evolve and hopefully continue to, I mean, reduce right now their expense per unit and also just grow in this EV world, which right now is facing some uncertainty, especially after that EV tax credit was pulled.
Yeah, there's a lot of expectation that it's going to be a bumpy old year for some of these companies, and so I suppose that this very much is why this note out from Baird is catching a lot of attention today, and perhaps is reflected in the share price today, up at 7.5%, upgrading now to outperform from neutral, raising the price target to 25 from 14. We're currently trading it at $18 right now. The expectation is that this has more room to run as it gears up to actually roll out its AI-enabled EV next year, as you mentioned, the R2. to a more affordable electric SUV that is going to be in the middle of 2026. And so it's interesting as far as what this analyst has been saying. It says that the vehicle will expand Rivian's lineup to a lower priced product segment, estimated for around $45,000, which will materially expand the total addressable market. So what's the standout about this is that it feels like this call goes against other ratings on the street, because Mizuho's note titled Analog the other day caught a lot of attention, particularly because of what they were saying about Tesla in that note. They've actually downgraded Rivian to underperform on softer 2026 EV sales and their outlook as well, off the back of the credits ending, like you pointed out. They've crunched the numbers and they're talking about lower deliveries to 60,000 units from 68,000, which was their previous consensus. Basically, they're talking about downgrading Rivian now to underperform, lowering estimates 13% below consensus, and a price target of $10 as basically they see the demand facing headwinds. So that's an interesting point, that, you know, they do see some challenges for EV demand come next year, particularly with some of the launch delays and challenges coming from some of these EV makers. Morgan Stanley has also been talking about downgrading Rivian to underweight from equal weight, unchanged price target there of $12. But they're also talking about leaning more cautious into next year because of an electric vehicle winter, they call it, to sustain through 2026. So it's really interesting that Baird is sort of going against the grain, I suppose, in that sense, and sort of stands out as to why they're a little bit more positive than the others sound, particularly even some of the calls we've seen this week, Jenny.
Yeah, and I agree. That's probably why we're seeing actually a pretty significant move to the upside. I will say Tesla is also higher by about 4.5% today, but I mean, 7% pop here now, adding to its 40% roughly gain on the year. And so hopefully we start to see the auto market stabilize, although every bit of commentary I've heard out there is more on the opposing side of, say, Baird's note today, and that's that we could see that EV winter continue to loom a bit longer than I'm sure the bulls would like. But hey, Rivian, nice session today nonetheless, so we appreciate it. Sam Badas, host for the Schwab Network, for all of that breakdown on some of today's top movers. Coming up next, though, we will be diving into some charts and example trades of two athleisure names. Nike, of course, ahead of its earnings after the close, as well as Lululemon with some analyst and overall just activist investor interest, really igniting a pretty nice move to the upside today.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Whether you're a bull or bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Welcome back to Next Gen Investing. It's now time for Chartmaster, and joining us is our Chartmaster, of course, Rick Ducat, to help us look at two names in the athletic retail space. Two names, frankly, Rick, that have not been the strongest of performers this year, but we'll start off with Nike. Nike, to me, is always the quintessential tail end of an earnings season, although we always have names to discuss, but Nike here is actually up about 0.5%. We have seen some recovery from lows. We've climbed now about 26%, but still, I mean, down about 11.5% on the year. Actually faring quite better than the next name we'll discuss, but walk us through your thinking on the technical front.
Yes, when you think about these two together, it's kind of like, well, it could be worse at least. But, you know, when we do look at this chart more specifically, we can see that the recent price activity has been a falling wedge type shape between our two blue lines there, kind of those boundary lines, one going across the highs, one going across the lows, converging toward each other. Typically, this is regarded as more of a bullish type of setup here. And indeed, we did move beyond that upper boundary line here, and we took out those previous relative highs near the 66 level. We did get stuck there once again before breaking out to the upside. However, we never did quite crack that 70 level, that red line there that represents the relative highs from back in late October or so. So that level still stands out as potential resistance to the upside here. It is somewhat encouraging though that for now we have held down to that 66 level. That was a notable low point here. If we were to look at the more current price pattern setup here, you could draw a shorter term trend line there in white going across the recent lows. If you duplicate it, extrapolate it, put it across the highs, it happens to match up pretty well. So that could give you one other further idea for potential resistance. If we were to look at our next chart now, we can see that price remains kind of sandwiched between our yellow 21-day and orange 63-day exponential moving averages there, between about 65.50 to 66.50 roughly there. So those could be some very short-term boundaries for traders to consider. When we also look at RSI, we can see that the red downward sloping trend line has been broken, but we still remain near the 50 midline. And you know, right before earnings, momentum can do some kind of odder things here. It's a known event risk situation. Traders may be a little more cautious of putting on any new positions, so momentum can change quite rapidly as to once the earnings come out. So perhaps take some of that information with a grain of salt. If you were to move to our next and final chart for this particular symbol, we can see that the volume profile study shows several volume nodes that could come into play. For starters, 66 is another heavy trading concentration area. You can see that blue histogram on the right side of the screen. You can also see the point of control, that thick red line that represents the area of heaviest trading of all is around 62. Meanwhile, to the upside, the heavier volume concentration is between about 72 to 74 or so. So that's the upside area that kind of stands out from that perspective.
Yeah, and I mean, I will say that today, modest move to the upside, but as you said, things could always be worse. We've seen Nike in a far worse position, and I think many are trying to sort of estimate if they're staging a full flood recovery, but I think it's probably too soon to say. But as we think through now trading this stock, obviously, as you said, everything can change, momentum, price, after we get these earnings, and of course the overall market is a huge player in that. But how do you think through now trading Nike into this report, of course, considering the volatility we've seen in retail?
Right, so this would be a trade going into this earnings event today with a longer term outlook that would be a little bit more bullish. This would be a trade if perhaps you think the turnaround plan that Nike has been putting some efforts into making is going to show some results here. So the trade in question would be +1, January 16th, 62.5, 72.5, 75 strike call butterfly at a $4 debit. So buying 162.5 call, selling 2 72.5 calls, and buying 175 call, altogether for a net debit of $4 here. So why did we pick these strikes here? 62.50, that would be an in the money call that we'd be buying for our lowest call strike. That helps us get our break even around the current price levels here. And then from there, we can say, why would we do that? Well, it's pretty close to our old highs. We are near our 21-day EMA. We're near a volume node that seems like a supportive level that the bulls would want to hold on to. Next 72.5 is where the upper edge of our expected move for that month lines up with our +1 standard deviation channel representing potential resistance, as well as a volume node there. So beyond that 275, as I said, that's where the volume starts to really drop off. So the sweet spot for this trade would be that $700 mark, our max profit of $600 during the next 29 days in which it would expire here. Max profit 600, as I said, max loss, risk defined $400, the debit paid here. And if you were to hit that $75 mark, the profit would be capped at about $350. So you wouldn't have the risk of a traditional butterfly where you could go too far and wind up going back into a loss and a winner, turning into a loser. So a more bullish trade here, sacrificing the max potential profit for a lower upfront cost, Jenny.
Yeah, and I will say that it's encouraging that Lululemon, while also seeing some weakness on this year, of course, was a pretty nice mover on the back of its earnings that we got last week, I believe. So now to look at Lululemon, we are seeing this stake now from Elliott, which is hugely positive. It's been actually a huge reason we've seen a nice recovery in PepsiCo shares. But Lulu now is pacing for its best 5-day stretch in over a year. And so encouraging, I mean, that's still down over 40%, but that we're starting to see, hopefully, this uptick and this momentum shift from the sell side. So what do you think now as far as the technicals of Lulu? Because this is our great example of it is a bit worse on a year-to-date basis than Nike.
Stretch is a funny word that you chose there, not only for the pun of it being kind of a yoga-focused company, but also just because this run-up has been very sharp here. We're up 36% or so in about 3 weeks worth of trading days. So stretch is kind of the word that comes to mind so far today. We have fallen off a bit off the open here, but not really anywhere near that green line yet that represents our old highs, as well as the high point that we saw before that gap to the upside today. So that would be the first most noteworthy level of support that would perhaps stand out to many traders here. Beyond that 197.67 to be very specific, our light green line there, that was where we formed the lows before our earnings gap down the time before this previous earnings in September. And that was also where we had the low that we experienced recently after our earnings gap that we saw, last week or so. So 198 or so to 208, a 10-point range really stands out as potential support. To the upside, though, there's still quite a bit of work to do. The closing prices that we had during our high point from the summer months in July, 247.68, that would be one mark that you'd have to beat before you could even think about trying to take out the highs we saw after the very severe decline that began in June. So some short-term positivity, but the long-term picture remains somewhat difficult here. So if we were to go to our next chart, then you can see that our yellow 21-day EMA is crossing above our slower 63-day EMA. They're pretty close together between 180 to 190 or so. That would be a supportive zone to consider as well. RSI also accelerating quite rapidly here. We are almost at about the 7 or 80 mark in the RSI, which only goes up to 100. So an interesting development there to be sure. The crossover below that 70 threshold would be the bearish sign to be on the lookout for. Or if we start to approach that previous resistance level near 248 or so, and you start seeing bearish divergence on the RSI as price kind of grinds out only marginally higher close rather than a convincing breakout to the upside here, that would be a situation to perhaps take note of. If we move to our final chart here, the point of control for our volume area comes in near 168. That's our thick red line once again near the bottom of the screen. So there's a significant volume low point that's been formed. We are above that point now. We are above the next volume node that I highlighted there near about 200 or so. Now we would have to contend with the final and the smallest node closest to us from between 230 to 240 or so, roughly there. So we're approaching another potential resistance area here. And also it lines up with our long-term purple 252-day EMA. So perhaps some areas that could be speed bumps on the horizon here.
Yeah, absolutely. And I will say that while encouraging as far as price performance today, we have to see more of this to say it's an uptrend. We need more of this continuation, I guess, to progress. But now as we do think through trading Lululemon, obviously a positive catalyst today. And hey, the month of December has been quite nice for Lulu after seeing a pretty lackluster year as far as some of its trends and overall just resonation with consumers. So how do you think they're trading this in, of course, for example purposes?
Well, here's kind of my thinking. So we did a bullish trade last time on Nike, kind of in a similar situation, turnaround efforts, some new information here. Lulu, new CEO coming in, big new stakeholder, plans to expand everywhere. All that sounds great here, but kind of Lulu to me, many traders might be thinking this as well too. Kind of a classic misstep of sacrificing what made your brand unique and interesting and attractive to gain mass appeal here, and then the quality too. It seems like there's been some speculation that that's not quite what it once was either here. So a more bearish example trade here, thinking perhaps this run up is indeed stretched, as we said earlier. -1 January 16th, 230, 240 strike, call vertical at a $3 credit here. So in this case, this would be a neutral to bearish play here. We would be collecting that $300 credit. That would be our max profit in this situation. Max loss potentially would be $700, so a bit over that 1 to or 0.4 to 1 risk reward profile there. So that we would be considering that. So we can also see that our expected move 9.7% roughly during this time period here. That would capture our break-even area. Our break-even will be about 233, so about 5.5% to the upside here. So certainly not a sure thing here. But the reason we look at this strike here, the 250 two-day EMA is around 237 or so. The expected move boundary is around 243. Our old highs there that we mentioned earlier, our thick red line, that was around 248. So there's quite a bit of potential resistance right in that area here. Also, the volume starts to really fade above that point here. So if you were thinking that perhaps this run could be due for some slowing down here, that could be one area to target with this example trade here. Risk defined as always as well here. That max loss of 700 would be the most you could lose if you kept the trade intact until expiration.
Yeah, Lulu making a nice move today as we're up about 5%, so appreciate that. All of the commentary on the technicals as well as the help with the example trades are Rick Ducat, of course, our chart master today and every day. Now coming up next, it's time to discuss FOMO, and no better FOMO candidate today than Micron, which is now up almost 14%, a rally that has held throughout today's session and also really lifting the overall market sentiment in regards to AI.
For instant reactions, earnings breakdowns, and hot takes that teach you about stocks and markets, follow me on X at @NPetalides and connect with me, Nicole Petalides, on LinkedIn, Facebook, and Instagram.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Putting your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Hey, Dad. I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren, planning for their college educations. Someday it'll be their turn.
Welcome back to Next Gen Investing. It's now time for FOMO, and today FOMO is easily Micron as we are up almost 14%. Now, okay, 13.5%, but close enough. And joining us now is Marley Caden, host for the Schwab Network. And so, Marley, this was clearly the story of the day. There was a lot riding on this report, though, because we were obviously outperforming into this print, and now 200% this year. I mean, really showing that some of the jitters surrounding AI and the memory space specifically were perhaps a bit overblown.
It certainly helped the broader story. We had a guest on Trading 360 earlier, Daniel Kern, who said it's a good day to be an investor in Micron. And as you mentioned, with the move we saw to the upside, it certainly is. There's a reason for that, though. Their report was really strong. I mean, it was a blowout quarter. They had far better than expected guidance. I think that may even be a bigger part of the driver here. EPS came in at $4.78. That far exceeded expectations for $3.95, revenue of $13.64 billion, besting expectations for $12.84. But for the current quarter, they're saying they're expecting revenue of $18.7 billion. That was more than $4.5 billion higher than what the expectation was. Earnings per share coming in about $8.42, they think, for the current quarter. That blew past estimates, calling for $4.78. So some really impressive guidance. They also said they expect the total addressable market for high bandwidth memory to hit $100 billion by 2028. That would be growing at about a 40% compounded annual growth rate. Management also upped the CapEx guidance to $20 billion, up from $18 billion. So not a huge growth, not a huge amount there, but enough that it's still participating. We did get some commentary from executives saying we are more than sold out. We have a significant amount of unmet demand in our models, and this is consistent with an environment where the demand is substantially higher than supply for the foreseeable future. So they are going to maintain this higher demand where it continues to outstrip. They continue to be sold out, as they say, and they are, because of that, able to raise prices, Jenny. I mean, that's really what the big driver was here. They did these price increases because demand is so high, it's outstripping supply, and that's why they're seeing these big numbers. We're also getting a pretty strong response from sell-side analysts in regards to this report as well.
Okay, so maybe I found maybe one tone of caution from all of these, I mean, like hugely optimistic notes today. I mean, nothing but praise and nothing but really, I think, also upside that has been seen for a lot of these names that have been really struggling in the last 4 or 5 sessions. But one note I saw says that supply will remain tight, and that could be then a constraint that shows no signs of relief as we head into now calendar year 2027. So this is more of a long-term concern, but I mean, that is as negative as I've really seen, where perhaps you have so much demand that then you have to be able to continue to pace your supply. I think that's always been a bit of an undertone of a concern, though, for Micron.
I think so, and I did see, we'll call it some optimistic caution, maybe would be an appropriate term here. That was cited in a couple of the notes. Rosenblatt, definitely one of the most bullish. They have their price target to $500. So even with that 13+% move, we're seeing they're only trading at $256. It's almost double the current price right now. So their price target's at $500. They cited the strong results, their strong guidance, and with this huge move to the upside. B of A upgraded them to buy from neutral, gave them a $300 price target, so still some upside there. And they said that they see a stronger for longer memory cycle. They're changing their view about the durability of the memory cycle because of this report and the quality of Micron's balance sheets. They also raised their fiscal year guidance for 26, 27, and 28 by as much as 80%. So some pretty incredible moves to the upside. They did say that there could be some volatility around AI demand, but their high bandwidth memory is sold out again through 26. Customers are engaged in multi-year agreements, so they felt this positions Micron for a potentially more sustainable upcycle than in prior years. We saw Morgan Stanley raise theirs to $350. They called this the best revenue and net income upside in the history of the U.S. semis industry, Jenny, outside of NVIDIA.
So that, I mean, is really, I think, as far as also like the commentary, the tone, the momentum, I think that's how you do an earnings call. I mean, you give this optimism, you give this hugely, really important and also just bullish take on the AI trade, which then I think speaks to some of the fears perhaps being overblown, but there is a whole new year ahead of us where we could see obviously different trends emerge. But the memory space specifically really our standout of 2025, and today no exception is, of course, Micron, a huge leader out in front. So we appreciate it to Marley Caden for all of that insight and today's real leader, and Micron also lifting a lot of the tech trade today as well. But now coming up next, we will dive into the retail sector, as we've seen October retail sales actually show consumers are still spending and faring quite well. So we'll dive into perhaps some of the takeaways and also expectations as we head into the new year.
me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Welcome back to Next Gen Investing. It's now time to discuss some of the movement we're seeing today in Instacart, of course, parent company Maple Bear. And so joining us now is Diane King Hall, of course, host for Morning Movers. Diane, we talked about this story earlier, and I was saying I will not call it Maple Bear, and here I am being, I guess, correct as far as the market is concerned. But we are pulling back modestly, not a huge day of pressure by any means, but seeing some FTC scrutiny. So walk us through this story.
That's right. So this kicked off with a Reuters report that Maple Bear, the parent company of Instacart, is being investigated over a pricing tool that it has in play. There were some allegations around this. The agency has reportedly sent Instacart a civil investigative demand seeking information about its EverSite pricing software. So this, obviously, an investigation does not imply wrongdoing, but the fact that there is an investigation has investors kind of heading for the exits to some degree today. It's off the lows of the session, but still under some pressure, down by a little bit more than 2% right now. So EverSite is this AI pricing tool that it uses. It allows retailers on Instacart to test different prices across products. What they said in terms of what they've seen in this reporting is that a study of more than 400 shoppers across various cities saw price discrepancies, wide price discrepancies across products. So on average, there was a 7% difference in the total cost for the same grocery list item at the same, or grocery list items at the same store. So in some cases, prices were up by as much as more than 20% for certain shoppers for the exact same items at the exact same time. So that's obviously a problem when you consider what consumers are expecting to see. Instacart says that pricing tests were randomized. It was not based on personal data, shopping history, or demand surges. And they are saying that it's retailers, not Instacart, that's setting the prices. So it's a question of who's on first and what's on third, right? They're saying it's not on us, it's on the retailers who use their platform. But still, it is Maple Bear and Instacart that has the platform, hence the investigation, according to Reuters.
Okay, and this is, I think, again, we talked about this earlier, but I think it's going to be a trend we continue to see. I think that they're not the only company that's probably going to deal with some of the growing pains of AI and technology that is, I mean, of course, just fairly new to us as consumers, but also these companies. So we'll continue to watch as that story develops, and appreciate it, Diane King Hall, host of Morning Movers, for that insight. Now, to shift gears into recent retail sales, which came in fairly resilient, with e-commerce leading out in front of about 5% year over year. So here now to discuss more on broad takeaways from the recent retail trends, I'd like to welcome in Rob Dykert, Chief Operating Officer of Triple Lift. And so I really just want to get your first broad takeaways. Thank you so much for joining us. But I will say, overall, a resilient figure that I think continues to surprise maybe those skeptics of retail and the broader consumer trends.
Thanks for having me on, Jenny. No, it's totally not surprising from our perspective. We're a global platform that enables digital advertising, so a lot of these retailers use us to actually advertise and drive sales. So, just looking at our own data, we continue to see tremendous growth year over year. So strong e-commerce sales in Q3 is not a surprise by any stretch. There is questions about how the economy is doing, but we continue to see strength there.
Okay, and so I will say also, retailers have pretty broadly also avoided passing on a lot of these costs to consumers. I mean, leaning on more efficiencies as well as just inventory management. But how long can they realistically continue to do this?
So there's two other levers that they have now that they didn't really have as much in the past. So I'm sure you've spoken about retail media or commerce media. Amazon does this, Walmart does this, and then also people have memberships as well. So Costco has memberships, Walmart has memberships, Amazon has Prime. So all of these things give them extra margin to potentially keep prices down. And I think even the Walmart CEO recently spoke to that exact point.
Okay, so right now we've also, I mean, to that point about, feeling like you're getting your money's worth in this bargain hunting mentality. Is this, like structural demand, or is this discounting just now pulling sales forward and perhaps something that doesn't give us the most honest read on this appetite for spend?
Look, I think it's really interesting. I was actually looking at some, I don't know if you've ever been in Google Trends, but you can kind of look at how keyword searches have happened over the years. And the patterns look very different basically post-COVID. And now you've got like Prime Days, you have things going on in October. So I think some of the demand is being pulled forward. Just like we always used to joke that like once Thanksgiving was over, Christmas started, and now we're joking that like Christmas starts once, Halloween is over. I think a lot of the demand is being pulled forward, and that's just like a tactic.
I mean, absolutely. It's almost, I love Christmas. I will not shame any of the Christmas deals, Christmas marketing, but it's far too early now. I feel like it starts now in like September, which is ridiculous. But also, I mean, in the buy now, pay later space, that's been doing quite well. Also, credit card debt is on the rise. So does this show any cracks in this thesis? And I think this is what some of the headline numbers perhaps hone in on, is that, things might be faring better than feared right now. How, again, long will this last?
Look, I mean, I think credit card balance was the highest they've ever been since the Fed started tracking them. So there's a real question of like how much more headroom the consumer has. At the same time, we also had a Fed cut. So obviously that brings down the cost of borrowing, so you can carry more debt. So it's a fair question. I'm not sure anyone really knows the answer yet, but there's no question people are borrowing more. And then the next question is the buy now, pay later, which you see everywhere now in almost every retailer, how is that filtering the numbers? Like that was one of the questions I was trying to get to the bottom of, is like that in the credit card numbers, or is that someplace else?
I know, and I do tend to think that anytime you see, companies like Firm just surging, it's like, does that dictate then consumer health, or is that saying the consumer is just, putting off purchases or reallocating those purchases, which doesn't exactly signal strength. But last but not least, you mentioned you're into Google Trends, and I myself am also an avid follower of all of these trends. And so as far as AI, is this really playing into any of the retail environment at all? Because I do know it's more catered to a consumer-to-consumer basis, but is this starting to emerge as perhaps creating any sort of loyalty?
Look, I think there's definitely, all of the big AI companies are now talking about monetization and how do they kind of use AI from a shopping perspective. So you're hearing a lot more about agentic agents that are going to be in the space where you'll ask the your AI chatbot to go find a specific product or plan a trip. So it's going to get better and better. I'm not sure I'm willing to bet a family vacation yet on just letting a bot go for it. But it's going to get better and better over time, and people will start to trust it more. So I assume it will become more of a central part of people's shopping.
Yeah, especially if you're, an avid Googler like myself, it's one of those things that's now just sort of integrated into the platform, whether you want it to be or not. But really great insight, and I think great commentary as we do close out this year and look into next. And we so appreciate that breakdown on the recent retail picture. Rob Dykert, Chief Operating Officer of Triple Lift. Now coming up next, last but not least, it's time for Under 30. Today we are discussing Tilray, as we're seeing now actually some earlier strength erased, as we did see cannabis stocks though with momentum, especially ahead of this Trump executive order on marijuana.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, the SIBO, and beyond. From earnings to economic data, we cover what matters as it happens. Streaming 24/7, anytime, anywhere, free on SchwabNetwork.com.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Stay connected to the markets, the Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com.
And on all your favorite streaming services. Schwab Network.
Available anytime, anywhere, on any device for free.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
I'm Nicole Petalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Welcome back to Next Gen Investing. It's now time for Under 30. Today we are talking about Tilray, which has been a bit all over the place, as a lot of these hot stocks often are. So joining us now is George Tella, Senior Markets Correspondent for the network. So George, we have seen some favorability from the Trump administration, and that has led to, a recent really uptick in a lot of these names, but volatile space, still I think the federal overall just, legalization is in question, but walk us through the story.
George. Yeah, so, we talk about a lot of times these changes in laws, especially around laws regarding legalization of marijuana. Also, right now, the Trump administration is moving forth with potentially an executive order to reclassify marijuana
SPX
on a therapeutic basis versus a level 3 controlled substance basis. So this is ongoing. This certainly presents catalysts or opportunities on a short-term basis for companies like Tilray, which one of the things about the business, they're obviously in the marijuana space, but they're also in CBD oils. And in fact, they're also in the beverage space, and they're the fourth largest, I figured out, the craft brew company in the country as well. But they've done so moving into that space through acquisitions. But I think the challenge really lies in terms of legalization and even reclassification. It makes it more abundant for people to use for various reasons now in therapeutic ways. But the challenge always has been in this space is standardization. The commodity itself is not standardized.
Let's go!
Standardizations, there's manufacturing processes, there's fewer suppliers. Right now, the marijuana space is very robust, sort of like the Wild West. Lots of different
The
variations.
6800s at $3.60.
By various people and various companies. And so it's tough as a business, individual business, even a business that's been around for quite some time like Tilray, to gain traction in terms of steady revenue growth, but also earnings. And that's why.
Oh, you think so, Judge?
A news item like this hits, you do see short-term momentum pop, but then there's a diffusion of the rally because of the fact that just because you legalize something or reclassify something like marijuana. There's more demand for it right away.
How dare you?
It also means that more suppliers can freely supply the marketplace more of that product. That puts pressure on incumbent.
Anybody trading any marijuana?
Having trouble standardizing the product across the board.
Yeah, and you see this, it's not just the affecting Tilray, it's the entire industry. Like the cannabis ETF has now declined more than 85%.
I want some of this marijuana.
Enthusiasm, yes, but to your point, this is really just riding on further legislation that doesn't seem like it's going to happen anytime immediately.
Correct, and that's the thing. And this is a situation
Have some of this marijuana, please.
News comes out very positive. You see a gap higher in many cases, maybe a continuation, but not a sustainable follow through because
Jim, don't make fun of George.
To the expected profitability profile.
He's had a little bit too much of marijuana.
If Tesla, for instance, comes out with a great news and it gaps higher from its near all-time high, that news might be more sustainable than the marijuana news.
Marijuana.
So the point is if you just look at Tilray, in the last 8 or so years, it's down significantly based on reverse stock splits. And effectively, they're using equity to finance a loss-making business. Because if you look at sales last year, which are at 830 million, growing in the mid-single digits. They lost around $2 billion. That's going to continue to put pressure on equity.
Yeah, and I think that this will be a story we continue to watch and continue to see. I think overall just, excitement sort of wane and also just, be volatile. Frankly, it's been the last several years, but appreciate it. George Tellis, of course, contributor here for the Schwab Network. That'll also do it for us for Next Gen Investing for this Thursday. We have the watch list coming up next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines.
These are now $4.70.
Sharp trade ideas, minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and...
How does he do it?
I think one of the most important
What in the heck happened there?
A risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart
That was very unprofessional.
Data, veteran traders, and trusted financial journalists, streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Anywhere.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across.
I went to the Christmas party.
I think that we totally met what their wishes were.
And I received a poop book.
25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I'm back at 360.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
I need to hold the 200 up here. We're back at 360. We're at 320, yeah. Buy it up, sell it.
Good afternoon. Welcome to the watch list. I'm Nicole Petalides. It's 2 p.m. Eastern Time. We're coming to you live from the New York Stock Exchange floor on the corner of Wall and Broad, and we're so happy you are with us. We're still seeing some up arrows here on Wall Street, and we're going to go through some of the reasons why. We will dive into the mid-cap trade and take a closer look at what's in store for mid-caps for 2026. Matthew Tuttle, standing by, will join us to examine the AI trade and how the Fed may impact the market. And our panel focusing on the future of the EV market, the impact autonomous driving may have in that space going forward. Of course, it was that cooler than expected CPI print on inflation, which gave a boost to the markets in the early going. Micron also helped tech with some great earnings and moving up double digits in percentage terms, while the preview FedEx, which is due out after the bell. The S&P 500 at 67.91, gaining 1%. The Nasdaq right now is gaining 1.8%, up 446 points. The Dow Jones Industrial Average up 1/3%, 48,063, and the Russell gaining 1 full percentage point. Gold is down about $10 at 43.63 Troy ounce, sitting at 56 a barrel. 16.52 on the VIX, and the 10-year bond yield at 4.12, 86,120 on Bitcoin. Kevin Green, Senior Markets Correspondent, is here with me at the Schwab Network, and we're taking a look at a few of the data points that were really key, including that CPI print from this morning, and we were saying that 2.6% that we saw of the core was the lowest since March of 2021. How do you think people are receiving this number today?
Well, Nicole, if you're kind of looking at the equity market, it seems like it is favorable for risk assets moving to the upside. If you're looking at the 10-year Treasury market, I would say it's a little bit mixed when you're kind of looking at the reaction post the report here. But as you kind of talked about, we actually did see headline CPI coming in at 2.7%. The street was looking for 3.1%. And if you look at the Cleveland Fed, they were estimating around 3%. So better than the street's expectations here. Core CPI coming in at 2.6%. Street was looking for, once again, 3% and on that level as well. And you have seen maybe some improvement when it comes to the shelter component. Now, we know that has been a major driver for headline CPI, and it's a big contributor, around 30 to 35%. Depending on the month here, but we actually did see shelter on a year-over-year basis coming in at 3%, so it's going in the right direction, and you'd like to see that kind of compress a tad bit more, and that would be favorable for consumers. You also did see a situation where medical care also moved up only 2.9%. Now, they have stripped out long-term care insurance in that number for this report, and that's going to maintain moving forward, but that's kind of the right direction, once again, that you would like to see. And then last but not least, if you're kind of looking at used cars and trucks, that increased by 3.6% on a year-over-year basis, but if you look under the hood at the month-over-month data set, they actually did have this month-over-month data, Nicole. They actually looked at a decline on a month-over-month basis when it came to used cars and trucks, and that's going to be, once again, a big item for headline CPI and favorable for consumers. So hopefully when we get the January report, which is going to be a little bit more complete, we see the same type of trend continue, and you'll start to see maybe the market pricing in a little bit more of a rate cut regime for next year. Right now they're pricing in around 60 basis points being cut, so about 2.5 cuts for next year. But if we once again in January get a better print, maybe that's going to tip the scales and bring that to 25 basis point rate cuts being priced into the market, which once again should be favorable for equities moving forward.
It was interesting because I was having the conversation with Dryden Pence, and he was saying one more cut definitely next year at least. And I said, well, when's that, And he said, well, if it's not before June, it'll be in June when we get our new Fed chair. And so I thought, it's sort of stating the obvious, but I didn't really think about it like that because I'm always waiting for January or March or April or, some more data to come in. But I guess you can count on June at this point. What do you think about FedEx reporting after the bell? We'll get those numbers. What are some of the expectations?
Yeah, so for FedEx, this is going to be a really big report when you're looking at the freight side of the equation for the overall industry here. Now, the market is looking at revenue coming in at around $22.8 billion, looking for between 3% and 4% growth on a year-over-year basis there. And the adjusted earnings per share estimate right now sitting at around $4.10, given the analyst that you're looking at. But the market is looking for maybe some positive commentary from the company regarding the logistics and supply chain just in general and consumer demand. They've had a situation where they have been able to put prices on the consumer, but they are still seeing volumes kind of decelerate, and they want to see a turnaround story in that environment or in this type of economic environment. Now, this is going to be the holiday quarter that they're going to be talking about on the conference call, and that's where you want to see a lot of enthusiasm, especially when you're looking at stocks like a J.B. Hunt or even a stock like UPS. So this is actually going to have some other effects in the market, not only just for this company here. Market's implying around a 4% move to the upside or downside, a little bit more call size skew here. So let's see how they report. But they've been on, having some pretty decent earnings announcements, especially when it comes to their commentary, and also the fact that they have this plan in place in order to cut costs. And it seems like they've been ahead of schedule over the last couple of quarters when it comes to
We
that.
got a reversal
Let's see if that
pattern.
trend's going to continue.
What time is it? 106. So we'd have to break that resistance. 677.944. Some bitch.
Which gets talked about so much these days.
Yeah, tell me more about the mid-cap names. I mean, you just mentioned a couple. You would buy into those names?
Yeah, so in our mid-cap 30 fund, we're looking at earnings growth and valuation and stock price momentum, and it does bring us to a lot of industrial names, like Jacobs Solutions, which is an engineering and construction firm. They have their hands in a lot of the things that are very timely right now, like data centers, but also a company like Leidos Solutions, which basically is a defense contractor, a lot of government contracting and consulting for the TSA and the FAA and the Department of Defense. So names that in that case maybe more of a beneficiary, a user of AI, but these are really solid names with defensible positions, hard to replicate. A lot of these companies, a lot of tech companies, like it or not, they can and have been replicated. The competition is fierce. And I think in a lot of the mid-cap names, there's always competition, but it looks very different. There's a lot more dispersion among, companies like Jacobs. You have Floor and you have, Granite Construction. You have a lot of companies out there that are, that are doing, the engineering and construction that we all need. And, they all are able to exist quite well. It's not a scale business the way that AI is or these hyperscalers are. So I think that, mid caps, in this new year, and we've been seeing it for a while, but I think that they are very exciting.
Yeah, I mean, and look, those are some of the top holdings. We're showing those right now, MTZ and Peloton, DY and Prim. And it's interesting because you talked about the mid caps being around 16 times 2026 earnings and seeing the value there, right? So that's where you would rather put your money. You mentioned the Mag 7. You said most of the names you like. Which ones would you take out then?
Well, I mean, I think that, there is some, heterogeneity among those names. I mean, Microsoft and NVIDIA obviously are, somewhat adjacent to each other. I mean, I always think of Tesla, and it's, we don't own Tesla. It's just a personal observation that I think that,
when electric cars become ubiquitous, which
I mean, you're at an exit idea.
We're not nearly there yet, but when they are,
Especially if you got in the dip there with Bobo.
The big winner. They might be the only independent electric vehicle manufacturer, but you name the automotive company and they will be putting batteries under the hood, and a lot of people would prefer to own a Mercedes or an Audi or a BMW or a Grand Cherokee or whatever it might be, more so than a Tesla. So I don't see this incredibly beautiful runway for what is ultimately a consumer product, as opposed to a cutting edge technology.
And there are some people who think the people who wanted EVs already have an EV. How many more people are left that are dying for an EV?
I think
you
that's
talk about
right.
stable growth and also earnings projections. I mean, some of the earnings projections for next year are above 10%. Are you comfortable with some of those numbers, or do you think they're too frothy?
I mean, 10% seems. I mean, that would seem doable if you believe in this idea of a strong economy, and it seems like the economy is incredibly resilient. I think there have been recent revisions higher where we're right around 2% real GDP growth for the coming year, give or take. I think it's a margin expansion story, as I was talking about earlier, and I do buy the earnings growth story, and I think it's partly efficiencies that we're getting from the use of software and AI, but also layoffs. I mean, we've seen plenty of layoffs that likely have been enabled by things like AI and software. So yeah, I think that is a likely scenario.
How about M&A activity? Will that help the mid-cap group too?
I think so. I mean, we have an administration that certainly is supportive of most M&A. I think the very large cap M&A, they want to have a say in it, and I won't comment on that. But so much M&A flies under the radar, and in the mid-cap space, if growth is hard to come by, large cap companies will perhaps buy their growth or buy higher margins by consolidation. I would also just point out dry powder in the private equity space. They're not at record levels, but certainly not too far from record levels. So that money has to be put to work. Most private equity firms don't take a fee on uninvested capital, so certainly there's always an incentive to do deals, and I would expect that to happen. I mean, for the last, I think it's 1, 5, 10, and even 15 years, mid caps have lagged large caps. And there might be a reason for that, and surely we could talk about that, but I think that, they have been, they have been forgotten a little bit, and I think that private equity could pick up the slack a little bit.
Are we more likely to see a bull case scenario or a bear case scenario in 2026?
I think it's a bull case. I mean, this year has been a gift, to be sure. The market, has done quite well, and we've earned more than the 8 to 9% that people are always hoping for when they're in the market. That being said, I think there's room to run. I don't think we're at crazy levels here. Certainly some stocks are crazy and some sectors perhaps, but no, there's room.
And I know you picked Jacob Solutions and Leidos as your picks today. Josh Wine, Portfolio Manager, Hennessy Cornerstone Midcap 30 Fund. Josh, great to see you. Thank you. Coming up, Options Corner, and Tom White's standing by. He'll highlight the unusual options activity from the day and how investors are looking to trade on recent news of Target, Amazon, and Intel. We'll be right back.
Back at support again.
you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Right about now.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome back to the watch list. Time for Options Corner, where we analyze unusual options trades that we're seeing throughout the day. Tom White, host of Fast Market here on Schwab Network, is with me right now, and he has a few trades, real options trades you're going to share. Tomorrow, though, Tom, as we talk options, is Quad Witch. And Goldman Sachs noting it looks like $7.1 trillion in notional options are set to expire for Quad Witch. Index options, single stock options, index futures, and index futures options. The guys here are ready for Friday. They've been talking about it all
Ready
week.
now.
We could see some heavy volume tomorrow, right?
Yeah, definitely, and it's also going into the end of the quarter. Also, so you've got some maybe tax harvesting, selling some losers, maybe or something along those lines. But we expect a little bit of volatility over the next couple of weeks. Maybe we're getting that start to the Santa Claus rally, starting a little bit later than maybe people anticipated at this point. But it's now triple witch, and I don't call it quad witch anymore just because they don't have single stock futures anymore. But yeah, it's triple witch, and typically we see some swings, and that's probably par for the course. And the volatility that we've had recently, the fits and starts, the 4-session losing streak, which is going to get broken here today. It looks like it, but it's been a pretty volatile session. There's some speculation that some of the CPI data might be a muck at this point, and we'll continue to kind of parse through that. But good headline numbers on both the CPI and the core. I think that was even more important.
Oh, yeah. I mean, without a doubt, the core number today was obviously the lowest that we've seen since 2021. Yeah, I don't know. This article said index options, single stock options, index futures, and index futures options. But I take your word for it. Let's talk more about these names. I mean, how about what we're seeing with Target? And you found a neutral to bullish trade that you're going to share with us.
Yeah, who would have thought that you'd see Target on a 12-session win streak? But that's what we've got as investors have plunged into names in this rotation trade where they're maybe, taking some profits in some of those big tech names and rolling into underperforming names. Target's been on a losing streak for about 4.5 years. It's been on a downturn. Stock's still off about 25% so far this year, even with that 11% gain that we've seen so far in the month of December. But I think investors going for some bargain hunting here. And if you take a look at the recent performance, annual revenue has declined for 2 consecutive fiscal years, and then also same-store sales have declined for 3 consecutive quarters. They're cutting their guidance once again on last earnings. They are trying to fix it. They got the new CEO that's coming on board. They're planning on investing about $5 billion in 2026 alone to improve stores and their strategy. Remember, discretionary items have not been selling well at Target, and that's what's dragged down the stock as they didn't pivot to enough grocery like Walmart did. But we did see some neutral to bullish activity in here today as far as unusual option activity. And this was all the way out in the January 16th monthly option. So 29 days to expiration. Traders sold some basically at the money puts, sold 6,600 of the Jan 105 strike puts. They collected a pretty hefty option credit of about $5.25 on these. So the break even for this trader, they start to lose monies below 99.75 over the next month. That's only about just over 1% below the current share price. But I think this trader's kind of maybe drawing the line in the sand saying, hey, the stock is probably going to continue to move higher, or expected to, into January expiration. Or if the stock does continue to fall, they're willing to purchase the shares at $99.75, which would be that break even. And the stock this week, Nicole, has been traded above its 200-day moving average for the first time in 13 months. So maybe the momentum's changing here in Target, and this trader is selling some puts with the expectation it's going to at least consolidate, if not move higher.
That's notable. First time in 13 months is a big deal.
Yeah.
Let's talk and turn our attention over to Amazon. You know, Dryden Pence today had Amazon as one of his stock picks going forward. Some of your thoughts on this bullish trade that you found?
Yeah, this has been a head scratcher, I think, for a lot of investors, a lot of analysts out there, because they're all pretty high on Amazon. A lot of analysts calling for the top pick for 2026 in the Mag 7 and the tech space. Just due to the fact that they've got all these silos of revenue generation, whether it's the cloud, which started to ramp up growth again above that 20% level after falling for a few quarters. So that's a positive. Their retail sales numbers have been decent. People are, this is typically their biggest quarter in there, even though that's a lower margin part of their business. And then advertising, they're making over $50 billion a year in advertising now. And then you throw in Amazon Prime also for the subscriptions, and they're doing well. That's what I think everybody's scratching their head about, because the stock's only up about 3% so far this year, down about 3% so far this month alone. They did just announce that made some executive changes there. Somebody leading their new AI models, Peter DeSantis, taking over for Rohit Prasad, who had been with the company since 2013 and ran a lot of the Alexa portion of the business. And then that news earlier this week that they're in discussions with OpenAI to potentially invest about $10 billion and the build out of their Trainium chips. That's a positive for this company. But did see some bullish activity in here also, and these were in the money calls. This is on the February monthly cycle, so about 64 days to expiration. Trader bought 21,000 of the February 210 strike calls, paid a hefty option premium of $23.25 per call they bought. So the break even for this trader, where they start to profit above $233.25 over the next 2 months. That's only about 3% above the current share price in there. And this trader did sell out of a long existing position that they had on the 220 calls. So went deeper in the money, but kept these in the February monthly cycle. So 2 months to go 3% for Amazon, that could happen in a day. So this trader taking that bullish stance here.
Very interesting. And last but not least, we saw Micron today, and that really brought up all these names along with it here in these semis. We saw Micron, Western Digital, Seagate, NVIDIA, AMAT, also Intel, of course, all got a nice pop on the Micron news. And now you did find an Intel bullish trade to share with us here. Tell us more.
Yeah, stocks pulled back from those recent highs, but it's still up over 80% so far in 2025. And this is probably on the back of those investments, right? SoftBank, a couple $2 billion, U.S. government taking a stake in them, 9.9%. And then NVIDIA investing about $5 billion in Intel at this point. So those investments are creating that bullish buzz for this company, even though the growth hasn't been there for this stock. They did say that data center customers are interested in their long-term supply agreements, and Intel's cost-saving efforts are set to continue throughout 2026, according to management. They're going to lower expenses, and we've seen all these tech companies just blow out numbers as far as CapEx and raising CapEx spend. Intel is actually cutting costs and trying to cut that down. But we did see some bullish activity in here also, and this was out in the February monthly cycle also, so a couple months till expiration. Trader bought 10,000 of the February 37 strike calls. These are basically at the money. Paid an average debit of $3.02 on these, with a break even of just over $40 to the upside over the next 64 days. That's about 10% above the current share price in there. And now this trader also sold out of a long existing position on the February 40 strike on this pullback, so reset this position in the February 37 strike calls. That break even 10% above the current share price. But remember, Intel was just recently above the $41 level. So yeah, this trader's taking a bullish stance here in Intel into February expiration.
And you, the trader, know options so well, Tom White. Thank you for sharing all of your knowledge with us every single day here on the Watch List. Thank you, Tom White, Everyday Options Corner, where he shares 3 real options trades and shows them to you. Coming up, we'll introduce you to the newest stock to hit the space race. Okay, Rick Zvetkov of Starfighters joins us next when the Watch List returns.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the market. Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to the Watch List. I'm Nicole Petalides. We're live on the floor of the New York Stock Exchange. A few movers in the market for you right now. We're watching Micron, which is rallying today after beating first quarter earnings estimates and issuing aggressive second quarter guidance. Revenue grew 36% year over year. The memory chip maker is up more than 200% this year. We take a look at Lululemon, which is higher today, with the Wall Street Journal reporting that Elliott Management has acquired a more than $1 billion stake in the company. Elliott is reportedly proposing former Ralph Lauren executive Jane Nielsen to be Lulu's new CEO, and shares are up nearly 20% in December. Well, it's our great pleasure to bring our next guest here. Rick Zvetkov, CEO of Starfighters, is with us. Congratulations. You had your public IPO today here at the New York Stock Exchange. We see the F-Jet here, a lot of excitement. Why now for this IPO?
We're very excited. Starfighters has been around for about 30 years now, and we're currently operating out of Kennedy Space Center with NASA. And we've developed a new program that we think is going to be very exciting to the market and also very exciting to the whole world, for that matter. We're actually going to be involved with using our jet fighters, which we operate out of Kennedy, to go to altitudes where we can actually launch rockets into low Earth orbit. We're going to put the microsats into low Earth orbit, and you asked why now? And that's because the actual technology has finally reached a point to allow aircraft like ours to actually be able to put a significant amount of these nanosats into a constellation in the low Earth orbit. Previously, the satellites were much bigger and much more difficult to operate with a smaller aircraft. That's why everything was typically land-based previously. So we're kind of the first guys out there to do something like this, and we have, like I said, high-performance jets in excess of twice the speed of sound, which is what's making this possible.
So, here at the New York Stock Exchange, you've kept the traders very busy. The stock has been trading and then halted and then trading and then halted because it keeps hitting the upside circuit breakers there. So you can see there, you know, with the $10 and, you know, and it's amazing how it just continued to surge. You know, it hit the circuit breakers at 660 and then again around 990 and then 1160. So it's been a pretty exciting day. How would you describe, I see the low and the high of 599 and 1772. I don't even know if those are right. But I'll tell you, you kept the guys busy today. What do you think about when you see it keep hitting the circuit breakers to the upside? What does that tell you?
Very exciting. We're hoping that people actually get a chance to understand what we do, and obviously having people like yourself be able to put us out in the market so they will understand what we do. We're kind of the guys that are hidden behind the gate doing all these brand new technology operations, and it's sometimes hard to get your name out there when you're sitting behind a fence that nobody can get into. But we're real excited. We have the opportunity to do something that people just have not either thought of or been able to do it, primarily because of the increase in technology. 10 years ago, this probably wouldn't have been a possibility. Now with, again, the smaller nanosats that we can put into the payload portion of the rocket that we'll be launching, it's a reality. And I think that we're so far ahead of the rest of the market. It's giving us a great opportunity to do something that no one else has done yet.
Yeah, I mean, and look what you've done here too, you know, transitioning from a Regulation A Tier 2, offering 2 listing here on the New York Stock Exchange, which is a really big deal. When we think about the supersonic aircraft fleet that you have, the Mach 2, I mean, no one can fully understand the uses or how this works going forward. I mean, this is something that goes into the space category, but I mean, what do you see for a company like this one in 5 to 10 years?
We're actually set right now to operate for at least the next 10 to 15 years with the existing equipment we have right now. We were able to pick up some late model fighters through the naval sources, and now we're able to use these high performance aircraft to be able to do some of these unique operations. We're in a very, very rapidly expanding and developing industry with the technology and satellites. And having these satellites now become the size that we can effectively launch from our jets, it's given a whole new opportunity for people like ourselves to be able to do this. We started out as a training operation at the Kennedy Space Center. We've been there for almost 20 years now. We trained test pilots from the US as well as other NATO countries, and that was pretty much our primary source of business. And of course, with the new technologies of these rocket-based nanosats, we were told, hey, opportunity might be there for you guys. Do you think you can carry payload under the wings of your aircraft? And that's what we've been doing a lot of testing in the hypersonic level right now, which we've been very effective with. And the uniqueness of us is because we can reach speeds in excess of Mach 2, which is not a normal speed for even the modern day fighters. It's put us in a very unique position from a standpoint of a commercial company.
Similar but different, but have you spoken with anybody like Elon Musk or SpaceX or Jeff Bezos, Blue Origin or Richard Branson or, you know, a few others, Mark Bell with all the satellites? I mean, there's a few guys that I'm sure you know well or know of well. Would you ever do any collaborations with these people?
Possibly. I mean, I've had the opportunity to meet Elon Musk, not so much the other gentleman yet, although we work in the same realm. We don't operate, we're not competitive to them. They're the big satellite launchers, the guys that put up these big things that go into geosynchronous orbit. We're kind of the little guys that put up the smaller arrays of satellites, which puts us in, again, that unique position, the small technology, not technology, but the smaller capable payloads that we can produce, which are now becoming very effective in the world because of the fact that we now have the capability of giving the information that it took the big satellites to do previously. Again, we're not competing with those companies. We're more in the smaller business arena where people that want to have a better system that with an array of satellites for the communications or any number of different things. You can track the migration of salmon or antelope or things like that you could do from these satellites. It's put us in an arena that, again, has been pretty much not really looked at so much. And I think we're going to give a lot of the smaller companies a great opportunity.
And look at how the world changed too after COVID. I mean,
Right.
a lot of the satellite pictures changed a lot after COVID. Final quick thought, because this has the Navy pilot discipline. You have critical missions that you've been speaking of, and you said coming to the public markets in this way, it really shows how the market is maturing to have done this in the way that you did. Final thought, Rick?
Well, we're very excited about the future. We're looking at even some platforms that'll give us even more payload capability. Right now, we're one of the leaders with regards to opportunities with some of the larger companies. We're working with GE Aerospace as well as Innoviring, Lockheed, and several others that are coming on board with us. We're real helpful, we think, for the future with not just hypersonics, which is a great stepping stone to the low Earth orbit operations. And we're developing new rocket technology through our partners with these other companies. So we're excited about where we're going. I don't think anybody is in a position to really overtake us, at least in this marketplace right now. So, and certainly not for the near future. There's a lot of things on the board that look very exciting, and maybe we'll be into some of those arenas. But right now, we have a pretty much captured market with this small sat market, and using the F-104s, which we operate as the first stage of a rocket.
Yeah, well, I can see that the stock has now reopened once again. So we'll wait and see what kind of action we see. I know that right now, it just got halted again. Amazing. It was just trading. I saw it above 11 bucks and it was halted again. Rick Svetkov, you have the busiest stock on Wall Street today. CEO of Starfighters, thank you for joining us. Still ahead, we're going to take a look at the big question marks for the market, the economy, what you need to know for 2026. Matthew Tuttle stopping by will be next.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Real-time market moves, earnings breakdowns, and trade-ready insights. Follow me on X at Sam_Vardis and connect with me on LinkedIn or Instagram for more.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome back to the Watch List. I'm Nicole Petalides. We're so glad you're with us. It's time to welcome in Matthew Tuttle, CIO Tuttle Capital Management. Thank you for being with us. You have a couple of two main pillars in this market that you're focusing on. What are those?
Yeah, those are the Fed and the AI infrastructure spend. So I think a lot of what's been driving the market this year is hope for a dovish Fed and massive unlimited AI spend. What we've seen the past couple of weeks is both of those under attack somewhat. The Fed cut, but they were hawkish. And, then you've got kind of what happened last week with Oracle and Broadcom earnings, that putting a little damper on the market. But going into 2026, those are going to be the key things that we're going to be watching.
Yeah, understood. I mean, we think about the AI trade, and so much of the circular funding has been happening, and there are some debt concerns and or AI bubble concerns, but the feeling that I get from most of the guests is that that spend is still going on, that CapEx spend is important for growth in 2026, and it will in fact be there because it's needed. Are you in that camp?
I'm in that camp right now. I mean, I hear the criticisms. We keep that in the back of our mind. You know, we always counsel clients to always have hedges just in case. And, you know, then you kind of trade based on what you see, not based on what you think. So we do think that a whole area is going to continue to be bullish. I think that the sell-off we've seen in a lot of this AI infrastructure is going to end up being a great buying opportunity. And, you know, you need it. It's healthy. I mean, these stocks can't go up in a straight line, and they're going to give you another entry point. But there are some valid concerns. You got to keep your eye on that.
Yeah, I mean, look, when you look at market breadth today, I'm looking at the heat map, and it's always sort of as goes these Mag 7, so goes the market, because NVIDIA, Microsoft, Broadcom, Google, Meta, you know, these are all Palantir, all higher today. Are these the kinds of names that work in 2026?
So I think these names all continue to work. You know, the other thing that people a lot of time don't realize is that's like half of the S&P. So it would be very hard for the S&P to go up and those names not to go up. So I think all those names work. I think you see the rally broaden out. You know, we're also looking at some of the beaten down software names and going into those as well. But you know, you certainly need to continue to have exposure to all the stuff that worked this year.
Yeah, I mean, Oracle now is up about 0.5% here because we did get some of the latest news that Michigan approved Oracle OpenAI data center according to Bloomberg, and that this data center will be powered by DTE Energy. We are seeing Oracle a little higher. You said you would be buying names like Oracle and also Broadcom on dips, right?
Yeah, I mean, you know, as long as this thesis continues, then dips are a gift to people who, you know, are looking to buy them. You know, better, I would much rather enter these on a dip than, you know, buying them when they gap up big.
We just finished talking about with F-Jet a moment ago. Starfighter's the new IPO here, and you have a space theme too that you follow closely. Tell me about some of those names that you do like in that group.
Yeah, so I think space is going to be massive over the next few years. And, you know, and people aren't really looking towards it. We're going to have data centers in space. We're going to have energy generation in space. And that's going to require a massive infrastructure. You know, we're not there yet. The companies that we're buying, and I got to take a look at this F-Jet, so thank you. But the companies we're buying are more, for lack of a better way to describe them, moonshots. You know, it's IRDM, Planet Labs, ASTS, Lunar. You know, the 800-pound gorilla when they come out next year is going to be SpaceX. But this is an area where there's going to be a lot. Yeah, it's going to be a target-rich environment. It's just going to take some time.
And you also like Palantir too, right?
Well, Palantir I like. You know, that's kind of our tinfoil hat UFO disclosure theme. You know, Polymarket is now saying there's a really good chance at some point Trump announces that there are aliens here. And we've got an ETF coming out for that next year, and there are certain names, Palantir being one of them, that we think benefits if we get that disclosure.
I'm waiting. You know, I'm looking. That could be a very interesting day. Can we turn your attention over? I don't even want to leave this conversation, but how about we go to software? You have ServiceNow in there. Tell me about that.
Yeah, so ServiceNow and CRM are two of the software companies. They've lagged this year. What we're really kind of trying to look at here is who can monetize now AI. And, we think Now and CRM are two of the really good ones. Yeah, Adobe to an extent. That's a name I don't own at the moment. But we do like Now and CRM, and would not be surprised to see money start to rotate to software. 2025 was kind of the AI is going to kill software theme. We think that's going to turn around in 2026.
Yeah, understood. All right, Matthew Tuttle, it's great to see you, CEO, CIO, Tuttle Capital Management, and we're waiting for any and all big announcements. Thank you. Great to see you. Appreciate it. Coming up next, our panelists standing by will take a look at the outlook for EVs next year and beyond. Do you have an EV? We'll be right back.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions.
From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close.
Here on the floor, I bring you real-time sentiment from traders driving the action.
And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings.
Live coverage of the close every single day. This is Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Sam Vardis, live from the New York Stock Exchange. When the market moves, we're on it, getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Welcome back to the watch list. Austin Lyons, Senior Analyst, Creative Strategies, and Ivan Feinseth, Senior Partner, CIO, Tigris Financial Partners, is with me. And we're talking a little bit here about what's going on in the world of EVs. And, my first simple question, Ivan Feinseth, is, do EVs last the test of time here? Does everybody who want an EV already have one? Or are there going to be many, many more to come?
I think there are a lot of people who want them, but are not ready to take the leap to full EV until we have a better charging infrastructure. And that, I think, is the only holdback. I think that there's a lot of enthusiasm amongst consumers for EVs, and which will also be further driven by the increasing advancements in autonomous technology from level 2, where it's eyes on, hands off, to full eyes off, hands off, and eventually full autonomy. So there's a lot of factors, but I think there is a lot of enthusiasm amongst consumers for them.
All right, Austin, what are your thoughts here? I mean, what's going to drive these vehicles going forward?
Definitely, like Ivan said, I think charging infrastructure is something people think a lot about. Honestly, it's also affordability. There's also, can people who are looking for a $20,000, $30,000 vehicle, can they get an EV? And then there's also form factors. My family, we have 4 kids. Can we get an electric minivan that my wife loves, right? So I think as people get in and experience vehicles, as automakers bring prices down, as the charging infrastructure get better, I think we'll see adoption, take off. And of course, like Ivan mentioned with autonomy, I think autonomy is really coming to EV vehicles first. So for people who love the value prop of autonomy, of getting their time back and not having to pay attention when they drive, that will also help the adoption of electric vehicles.
And you had some thoughts, actually, Austin, on Rivian's autonomy and AI Day. Rivian was one of the biggest IPOs. I mean, what do you think there?
Yeah, so Rivian announced that in 2026, they're launching their Autonomy Plus, and it's essentially for their R2 vehicles, and they will be competing with Tesla and bringing autonomy to the masses. R2 is going to be a cheaper vehicle targeting the $45,000 to $55,000 range. So it will continue to bring autonomy to more people than they could today if they started with their R1T or R1S. But they did today launch hands-free driving for their Gen 2 platform R1 vehicles, which would be equivalent to Tesla's full self-driving supervised, that's eyes on and hands off. And so, in 2026, we are going to see more people start to get to experience autonomy through Rivian and through Tesla, of course.
Look, we just had a pivotal time and year for Elon Musk and Tesla, because in Austin, Texas, they had a successful robo-taxi launch, which now is expected to go in more than 30 cities next year. Someone like Dan Ives said it's going to be a monster year. He thought this was the golden goose, the autonomous and robotics chapter begins. Ivan, do you like Tesla and or any other EV names right now? I know you always pick some of the cruise lines that you were so right on. What about the EV world? Tell us which ones you think might lead the pack.
Well, as a car manufacturer, my number one pick is still General Motors. My disappointment with General Motors, I think that they tried to make too big a leap to go from ICE or gasoline engine cars to EV. They should have went to more hybrids first, but they are doing great with their full-size pickups and SUVs, and they have a lot of EVs coming, including several from Cadillac that are really popular. And I like the GM Super Cruise. It's more limited because it's only available on Super Cruise enabled highways. But I've done the Super Cruise test several times. It's pretty impressive. It's an eyes-on, hands-off level autonomy right now. But as far as pure EV, my number one pick is Rivian. And I was at the Rivian Autonomy and AI Day. It was very impressive. They are doing incredible work on their own processors and really
excuse me.
That is going to create a tremendous competitive advantage.
I was laughing there for a second.
Their own hardware, their own software
Rivian
stack, their own mapping database, which are the...
We had a little breakout here and pullback. I think this last one meant something.
Autonomy. So those are my two top picks in the auto sector.
Randy.
And I feel like we need to have some patience for Rivian, because it's been a slow process as all the other EVs are piling out. But I do see some Rivians. I mean,
6785s.
right? But then now I see this other Rivian that sort of is a combination of what looks like a Range Rover and a Bronco, sort of. And I'm seeing more and more of them around here, and I live in New York City and Long Island and all that, so they are coming. What about
6750s here?
Lyft or ride share? Austin, what are your thoughts there on that kind of autonomous driving, or what it could mean, like those names in 2026, 2027?
Yeah, robo-taxis, what a lot of people are talking about right now. When I think of robo-taxi, I think of Waymo, of course. And Waymo, it's
I don't
an
think of
awesome
it.
experience. You get in, and
I think
the car
Tesla
is concerned about taking you to your destination safely. When you step in an Uber, you may or may not always feel that way, depending on your driver, right?
Well, you're full of crap.
As a taxi driver is to just get you as fast as they can to drop you off, so they can, of course, they're thinking about safety, but they want to get that next rider, right? Whereas Waymo, you don't feel like that. You don't feel rushed. You're just taking a safe drive. Yes, it takes a little bit to get over the fact that there's no human driving it.
This is what we
I
wanted.
think that people who take rideshare will be excited to use Waymo as it continues to expand, and that will be an experience that Uber, Lyft will want to bring to their platform. Now, I think Rivian announced that they're taking a different approach, which is they want to make personal vehicles have that same level 4 experience, where you could, for example, fly home and then call your car and have your car come
SPX.
pick you up. So it would drive to you without a driver, sort of like a Waymo. And so, you know, one thinks that by doing that with your own vehicle, that gives you the best of both worlds. It's a vehicle you can drive whenever you want it, but it can also do things, come pick you up, drop your kids off at school, so on and so forth. So I do think we'll see both of those markets grow, and I'm personally very bullish about the personal vehicle autonomy.
All right, Ivan Feinstein, I have like 30 seconds left. You got anything that might blow my mind when it comes to this?
Me?
I am very excited about personal vehicle autonomy. You can create your own, you can, you know, have your car pick you up.
What you think, baby?
And then take you somewhere, drop you off at work or home, then go get your kids. So the ability to create your own autonomy service is going to be very powerful. And I'm also excited for the R2 cars coming from Rivian next year. And the level of autonomy software that's going to be and capabilities that are going to be on.
What happens to all the limo drivers? What happens to all the car service
Exactly.
drivers? I mean, you know how they make a living, they get good tips. Austin Lyons and Ivan Feinstein, great to see you both. Really appreciate it. Good chat.
That's a low blow.
I'm Nicole Petalidis. Thanks for being with me here.
Nicole
on Schwab
Petalini.
Network every single day, 9 a.m. and 2 p.m. Keep it right here. Market on Close is next.
She got the last word in.
Schwab Bank
No, I'm in
Investor
310.
The checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With investor checking, you get the award-winning features of our checking account. Plus, cash management solutions. All designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide. No overdraft fees. And enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that if they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists, streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
afternoon. It's 3 p.m. on Wall Street, and this is Market on Close. I'm Marley Caden, coming to you live from our
It is now Power Hour.
And I'm Sam Bartis, coming to you live from the floor of the New York Stock Exchange. Let's take a look at what is coming up on today's show. We've had a very busy day, so we will check in on Ethereum.
Now I'm
and
even.
we can see prices heading in 2020.
I didn't add on. I should
The
have.
investment landscape for Ethereum and digital assets broadly. Today's overlooked stock is Applied Digital, as shares are rallying after it closed a loan facility for AI data center development. And be sure to stick around after the bell. We'll have extended coverage of earnings with live reaction, reports from FedEx, KB Home, and Nike. But Marley, take us through what
Lots in store for us, Sam. But our big story today, Micron Technology shares up almost 11% still.
I see a
Reigniting
misprint.
optimism on the AI trade following its
It's a
earnings
spy.
report after the close yesterday. The company reported a significant beat on
That
both
could
the
be a
top
problem.
and the bottom lines, and issued EPS guidance that was 75% higher than expected on a revenue forecast that was 30% higher than estimates. We'll talk through those
That could
numbers
be a
in
problem.
just a moment. But Lululemon got a boost today on reports from Elliott Management taking a more than $1 billion stake in the company.
Oh.
In addition to that news, the apparel maker also announced that
Insider
it will be entering
buy-in.
6 new international markets next year. And Darden Restaurants reported earnings this morning, signaling a consumer who is still spending and choosing to dine out, particularly at Olive Garden and Longhorn Steakhouse. Darden posting a beat on revenue, saying that every segment delivered positive same-store sales. They also had their EPS come in just shy, 2 cents shy of estimates. The company hiked its full-year revenue outlook also for the second straight quarter. Before we get to that and more, though, let's see where the markets stand as we head into the close of trading today. We are still holding on to our green shoots across the board here. The S&P trading up 7/10 higher, 67.69.30. On the NASDAQ, we are a percent and a third higher at 24,981. On the Dow, we are more than 0.1% higher, 47,961. And the Russell 2000 trading up about 0.5% right now, 2506.46. Taking a look at some futures products, the dollar mostly unchanged today, 98.08.
We have the SPX, the 310s here at 68.80s. They are now at $4.30. You could proceed to take some profit off the table, or you can ride the train with Bobo. Right now, you're up $100 a contract. You can make a business decision.
November consumer prices rising 2.7% year on year, which was less than the 3.1% that economists were expecting. Core CPI, which strips out volatile food and energy prices, also increasing less than anticipated. Stocks popped and yields dropped, as you just outlined, following the release. And this is the first inflation
Francisca's paid
since the government reopened and had been slightly delayed. While it does show progress toward the 2% target, analysts say it doesn't give us the full picture just yet because we didn't get
$4.80.
print as the BLS was unable to collect the
Thank you
data
very
for the
much.
entire month and 12 days into November. So there is this view out there that we shouldn't read too much into this report because of
They're
those
now at
polls.
$5.
We should wait perhaps for a cleaner print.
You're up $190 a contract.
Even still, the benign numbers are helping stocks like discretionary names rally today. The probabilities also of a Fed cut also picking up. The markets are pricing
You're
in
up
a low chance the Fed will cut in January.
$190 a contract, Jim. Have you ever thought about selling?
Reduction to over 50% today, Marley. I'll send things back over to you and Jenny Horn in Chicago with some of today's
I have.
Thanks so much, Sam. Yes, like you mentioned,
You think
Jenny
you
Horn,
should
co-host of
sell?
Next Gen Investing. Here to break down some of our top stories. Of course, that top story
Yeah,
I highlighted
I
on
do.
the top of the show here, Micron Technology, just having a
Right now,
monster
they're
day
at
on the heels of their
510.
earnings report
So
and the
I'm up
guidance they
$200
issued.
a contract.
Yeah, I think that guidance was huge, especially I think doing a great job to reshape some of the
Make a business
pessimism that has
decision
flooded
and
this
sell them
market
right here
for
at
a lot of these big tech players.
$5.10.
I mean, names like Nvidia, Broadcom, Oracle, all got a pretty nice lift on the back of this report.
If I were you, that's what I would
including
do.
also Micron itself, which spiked as much as 14% today. We have
520.
given back some of that strength, and I will say that even with this phenomenal session, that we're still about 5.5%
Why? Because you're at the
all-time highs,
63.
which just goes to show
Last time we
weakness
hit the
that was felt by
63,
Micron, I mean,
we
going into this
didn't
report.
break it.
Revenue is up 21%
So you're up
sequentially,
$6. Oh, you're up 7.
year-over-year. GAAP net
You're up
income
oh!
did come well ahead of expectations, and gross margin also stood at around
Now you really got to make a
56.8%,
business decision.
A strong expansion from the 46% recorded last quarter. Now, DRAM revenue was up 69% year over year, 20% sequentially, and shipment volumes were flat but prices did increase about 20%. NAND revenue, on the other hand, was also up 22% year over year.
Sometimes you got to do what you got to do.
39% of their total business also rose 16% from last quarter. Core data centers also were up, 51% sequentially, with even improving margins.
Sometimes you have to do what you got to do.
We saw revenue at plus or minus 400 million, but 18.7 billion. That was well above consensus, and they also gave adjusted earnings guidance that was also better than expected, and gross margin also a percentage point above expectations.
Sometimes you just got to do it.
Beat you could possibly imagine.
Can't say no.
I do know that there has been some skepticism over their ability to navigate supply chain, frankly, but doesn't really seem like the street is paying much attention to this.
Ginny Horny up and Marley Kager's up.
Margin expansion across all segments. Favorable products mix and also tighter inventory controls. A very different Micron than we were discussing at the beginning of this year.
Certainly, and I think, the caution that you highlighted there has been noted in some of the analyst commentary afterwards, but it seems to be more of a 2027.
I wonder if Marley still has a drinking problem.
Where it's a long-term feel. So I think the short-term outlook is extremely bullish. We're seeing this near 12% move to the upside right now for Micron on the heels of that report. Now, Lulu also moving higher today. We got reports that Elliott Management has taken an interest.
Okay, well,
very hefty interest with $1 billion price tag.
Yes, a billion.
Thank you, James.
Lululemon from Elliott Management.
Well played.
They do want to help turn around the retailer, and they do have a CEO candidate in mind. We did see reports from the Wall Street Journal first yesterday, where they claimed former Ralph Lauren chief financial officer Jay Nelson could be tapped to be the
I'm glad I did.
Of course, there's a vacancy in that role. We got reports last week that their CEO Calvin McDonald will be stepping down on January 31st. But shares had their best day in months last Friday following that announcement. I think that also speaks to the appetite for new leadership.
We could see 6, 7, 7, 7, 7, 7, 7, 7, 7, 7, 7, 7, 7.
Now shares were off as much
here
as
shortly.
7.5% pre-market, so we have parsed back some of that strength, but it is interesting, of course, as we approach Nike earnings out.
I think we missed it.
Nike has experienced a much
here it comes.
decline, but also does trade at
I'll let you know. 6, 7, 7, 7, 7, 7, 7, 7, 7.
But valuation actually is encouraging. Lulu trades at 14 times its trailing earnings, 16 times its forward earnings, with right now an EBITDA margin of around 8.5 times. So Nike's trading at around 33 times its trailing earnings and over 40 times its forward-looking earnings. So you could say that there is a valuation premium on Nike, but I guess performance also would tell you that Nike has performed a bit better. So as far as expectations, though, this name is relatively cheap, and hey, maybe we'll see signs of a continual recovery into this holiday spending period.
And they also made an announcement today they're expanding into 6 new international markets, which is very interesting that you highlight Nike's earnings today, because we know the importance of the international markets in Nike's story. For both of them, a lot of the conversation has been about turning around to the North American story.
Exactly, and I think that it's been part of Lululemon's long-awaited, really drawn-out strategy where they are trying to expand internationally. They're trying to expand their menswear edition specifically, but they do compete in a very competitive, saturated market. Forget about even Nike. It's names like Alo, Viore, the list just goes on that emerge, and they have done quite a good job resonating with these younger consumers that frankly do have an appetite for new brands to come into the space.
And they're willing to pay for them.
They sure are. They're not cheap.
They're not cheap, but they are willing to pay. Let's talk about another winner on the day here. We've got a lot of winners today. Darden Restaurants came out with some very interesting commentary. We've seen sluggish restaurant sales sort of industry-wide, but that was not the scenario that was painted by Darden today.
Yeah,
I think I'll be going into the kitchen here soon and grabbing me some coffee beans and
Olive Garden and Longhorn Steakhouse as these thrifty diners are
have a
trying
cup
to
of
find
coffee.
deals. So for the second straight quarter,
God
the
darn
company
it.
hiked its full-year outlook for revenue growth, although they did reiterate projections for earnings. They have seen higher.
I just wanted to get that 7, 7, 7, 7, 7, 7, 7, but
beef, which have weighed on their overall.
might have to jump back in this trade.
But they did point out on this call that same-store sales were up.
You see what I'm saying?
That was well ahead
6, 7, 80s.
and that despite some of the sluggishness, they found success
Randy.
in raising menu prices while also seeing promotions and diners that are trying to seek this value. So they said that companies
Trying to get
saw more
420.
high-income consumers trading into their casual dining chains, although demand
6,
from
780s at 420.
50,000 a year did fall slightly. So they also got a traffic bump from consumers who are at least 55 years old, which I thought was a fun fact. And Olive Garden, I mean, that is basically this entire, it's 44% of their sales, also saw same-store sales growth of 4.7%. The continual drag, and I say drag because it's the exciting, enthusiastic same-store sales figure, is still some of their higher-end brands like Ruth's Chris, which is the hardest restaurant to say. But even they posted still a gain as far as same-store sales were concerned.
I'm at
Just didn't really
430.
compare to Olive Garden, which I think speaks to right now the appetite for a deal. But they are offering this $55 deal for meals now at Ruth's Chris. So perhaps that's resonating and reigniting some growth into that chain, which has been a bit more of a black eye for Darden restaurants.
And you brought up some really good points there, and I'm glad you brought up that they said they found success in raising prices, which is not a story that we've heard a lot, but they raised them by less than inflation, and then they offered promotions, and they said that that was successful. I was really struck by this quote from the CEO: "Weaker consumer sentiment doesn't translate into reduced spending during the quarter." And that's sort of one of the first signals we've gotten of that. So very interesting report from Darden Restaurants, and they're marginally higher today. They were about 1% higher when we started talking. Last company we'll talk about, GE Vernova. We've got this wave of analyst action heading as we head into the end of the year, and they got an upgrade today.
They did. So some positive momentum after yesterday. They were one of the S&P's worst performers. I mean, shares slid as much as 11%. And also really did a substantial job really revising down some of the uptrend that we've been seeing. This name has been also on a run. We're up 93% on the year still. So Jefferies upgraded shares to buy from hold. Price target was raised though to $8.15 from $7.36 a share. And shares again have contracted since that December 9th analyst day, though they did say they were more positive on the outlook for power given gas pricing and services visibility and overall the outlook for electrification. So gas turbine pricing continues to be a positive surprise, and they said that services provides some deeper visibility now into, like a more of a long-term outlook. But a lot of the fears yesterday that we saw across these alternative energy names really was felt by, just several names driven by various reports. I've seen some people link it to the Oracle story of pulling out of data centers, but there was some widespread weakness yesterday in energy, like Bloom Energy contracted substantially. But I think that the resiliency of GEV has been astounding. And everything we've heard from management has signaled further growth ahead, and they've been historically conservative. So many analysts saying that actually that could be a floor and we could see further upside from here.
And we know that energy needs to power those data centers. So
It sure
a
does.
lot of opportunity lies ahead. But Jenny, thank you for breaking that down. GE Vernova up about 4.5% right now following that upgrade. That's Jenny Horn, co-host of Next Gen Investing here on the network. I do want to check back in with Sam, though, and find out what we have coming up in the rest of the show.
Well, Molly, we will recap this morning's cooler than expected CPI report and what it means for the Fed heading into 2026. Market on close. We'll be right back.
Nvidia.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing,
I'd say it's a beautiful call from the bottom.
even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Nicole Pedalides, live at the New York Stock Exchange.
Not
and this
$7.
is Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time
That's right.
interviews, and insight from analysts, founders, and market voices you trust.
Nicole's right.
Watch List, 2 p.m. Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast.
Damn, look
right
at it
for
now.
you.
It's at the 200
If you're a long-term
EMA.
investor, our investing webcast series breaks down different investing styles, including growth,
$8.
value, income, and more.
Can you believe that?
Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. head over to schwab.com/coaching and start learning today.
Jim, what caused you to call that trade out? Well, it's called the megaphone ripple. You know, it takes two halves to make a full megaphone. And as we were trading the lower half of the megaphone, we decided to start building the upper half. They're now at $9.40. Straight from 310.
A rally off the back of the cooler than expected inflation print this morning for November. Of course, a delayed report, but helping ease some of the concerns out there around price pressures, it seems. And then also, of course, coupled with that, we have the reinforcement from Micron about the whole AI demand story, particularly with data centers, the need for not just knowledge and data, but the memory, where to store it as well. So this is what we're seeing as far as
it's
the
a good point.
Really charging ahead. It is our outperformer on the day as we are seeing technology once again catching a bid off the back of a few sluggish old sessions. The S&P 500 is up almost 1%. We've got the Dow up as well as the Russell 2000, of course, as we have seen very much the pricing in of further rate cuts to come. Also the chance of a March cut now being priced into the market. So we've got US futures looking like this. We've had the DXY pushing just slightly higher there at 98, but holding pretty steady off the back of this data. Crude oil is at $55 a barrel. That's been obviously a big story with the geopolitical risk premium being priced in now. Bitcoin is actually lower, initially higher on the day, but we've taken a turn, down 1%. And then we're at 85,000 and change. And then the 10-year yield, which dipped. Obviously, we saw stocks pop, yields drop. So we've seen some buying when it comes to bonds as well. So that's a quick snapshot of what we're seeing off the back of really two catalysts. But still, there's a lot of thinking in the market. Still a lot of worries about the AI cracks, perhaps with circularity of financing valuations too, but we're shrugging that off today. We've got technology at 1.8%. We've got discretionary really being powered by the benign inflation print as well. That's really helping some of those stocks in that particular sector. Communication services up 0.6%. So they're the three green bright spots right now on this board. Staples and financials are lower today. So we are seeing some of the rotation back into some of those sectors that had been working. Utilities are pushing higher today as well, because really the big story is how much energy we need to power all of this AI demand in the data centers. So industrials are catching a bid, materials are up, but we do have energy lower, down around 1.5%, and then real estate also tracking lower. Remember, we've got a lot of information out after the bell today across the entire economy with FedEx, Nike, and also KB Home. We're going to be learning a lot about where the consumer is at, where the housing market is at, and of course, this is a really good barometer of the global economy with FedEx. All right, let's bring Marley back into the conversation and welcome in our next guest. That is David Wu, founder of David Wu Unbound. So nice to see you, David. Thanks for joining us today. So how much credence are you giving into this inflation print?
Really not that much, actually, and the reason is very simple. Because of the shutdown, we saw a delay in the start of the data collection process by the Bureau of Labor Statistics. As a result, the data were collected, later in November when retailers started to offer, of course, holiday discounts. This is the reason why actually which day you start serving the data actually November matters. When you get into the second half, as you approach the Thanksgiving basically weekend, you're going to basically capture that downdraft in prices. So I think from that point of view, I think the sort of the smart money, if you like, I think today is completely ignoring, I think, this number. And this is the reason why, if you look at the pricing for the January FOMC meeting, it's about the same as yesterday, about 25%. This is the reason why the dollar actually, interestingly, is a tad stronger across the board. Gold is a little bit weaker, and Bitcoin is a lot weaker. So I think from that point of view, what's happening in the stock market, I think is more of a knee-jerk reaction to what happened yesterday. It's a bit of a dead cat bounce. I wouldn't make too much out of it, but I think the reality is that I think this inflation reading changes nothing at all. In fact, the market's starting to worry now that actually December number is going to paint a much stronger picture, especially given the fact that we do know that a lot of U.S. companies, in order to restore their profit margin, are going to be looking to actually offer fewer discounts in this holiday shopping season, which is what was found by basically Salesforce.com. So I think all in all, there's a lot of uncertainty here, but one thing is very clear to me, that it's going to be very difficult for the market to increase the pricing of the January cuts. I think, until everything settles down, and this is going to be a problem for the stock market.
All right, David, in the notes that you sent over, you highlighted that a key assumption behind some of the forecasts for the Fed is the AI boom. And then you say that your biggest call for 2026 is that the AI bubble will burst, and maybe as early as Q1. Walk us through that thesis and what's signaling that to you?
Right. So let's think about this for a second, right? I mean, you look at the biggest consensus on Wall Street, at the Federal Reserve right now, is about AI, right? This is the reason why every single year-ahead reports, including the Fed's own 2026 projection, is based on the assumption that AI boom is set to continue. That's why they just revised up the GDP growth forecast. And they're also assuming that we're going to see a broadening of AI adoption, and that's going to basically provide a boost to productivity and keep inflation basically under control. This is the reason why they revised down the inflation forecast. So what I'm saying to you is that that is the single biggest assumption, which is AI set to continue. I think that is wrong. And I think, my thesis in general is very simple. My thesis is that the market is pricing AI as though it has a winner-takes-all outcome. I think this is not going to be the case. We're already starting to see intensifying competition among large language models, also among chip basically manufacturers. That's going to ultimately essentially raise questions about future profitability and, of course, return on investment. We saw this last week with Broadcom. And I have to tell you, Broadcom, the numbers are great, but their margin went down, and they warned that their margin might go down further because of growing demand for low cost and basically low margin, cheaper AI chips. That's one example. If you look at within the large language models, Gemini 3.0 is a huge problem for basically ChatGPT. As you know, like Gemini 3.0 actually outperforms, ChatGPT 5.1 by at least 20% across all metrics, and is now leading basically, ChatGPT. But it's not just Gemini 3.0. It's also the Chinese models. In the last 2 weeks, we've seen at least 2 Chinese models, one of which by a company I've even never heard of until basically a month ago, called basically Moonshot. Moonshot, this little company, has launched a model called Kimi Thinking 2 that outperforms, that at least matches the performance of ChatGPT 5.1. And guess what? It cost them only $4 million to train up this model. What I'm saying, this is going to call into question about how basically Sam Altman is going to invest $1.4 trillion in CapEx in the next few years, with his revenue basically stuck at $12 billion. So I think this is the things that are sort of coming. This is why it's very interesting to me if you actually look at the price action today, right? I mean, Oracle is unchanged on basically from the slump yesterday. So is basically Broadcom, so is CoreWeave. So people are starting to express their concerns about these companies, about the AI trade by selling these companies. So today you get a bit of balance, the Magnificent Seven, so on and so forth. But I think, the question now is when this concern about these second-tier guys start to basically filter up to the bigger guys. And I think that's going to be a question. And by the way, I think the Micron story is generally bearish for AI. What's good for Micron is because there's a shortage of high bandwidth memory chips. And that's driving up prices. That's why Micron's doing well. But anybody else has to buy these chips now have to basically spend more. And this is one of the reasons why Oracle has decided to actually to delay the completion of their construction for the data centers.
Yeah, it's obviously why you see some of the hardwares, the Dells and the HPs down as well today because of the follow-through as far as that pass-through on memory prices. But, David, isn't that the point? The fact that we have seen a pullback in some of these high-flying names over the last couple of weeks. We've seen, obviously a bit of rotation out of what has been working into other parts of the market on this thinking that, there are some concerns around AI valuations and bubble concerns around, tapping debt markets and the circularity of financing. Doesn't that just go to show that investors do care. They are worried, and the exuberance that we are seeing in the market is not irrational, because I'm just wondering, how confident you can be in the bubble popping as soon as Q1, because, I was speaking to Liz Ann Saunders today, and she said, comparatively, if you want to talk about this in years, she thinks it's more like 97 than 99 right now. And I had another guest on earlier who sort of kind of backed that up. He doesn't believe it's going to be a bubble bursting in 2026. He says it might be beyond that, but certainly not next year.
I think the way I think about this is that, generally speaking, if you look at semiconductor cycles, even during the dot-com bubble, when we had a particularly long semiconductor cycle, it lasted about 24 months. We're currently 20 months into this, by the way. If you look at actually spending on information equipment as a share of GDP, we're currently at 4.6%, which is exactly what we were at the height of the dot-com bubble. So there are many similarities that would suggest we're almost.
It's not funny.
The reason why, when I'm talking about bursting, by the way, I'm not saying that we're going to go down like 50% and whatever. I'm thinking like we're going to go down 20 to 25%. Okay, and we haven't seen that pullback. And I think from that point of view, the market has been making up stories and so on and so forth. So I think from that point of view, I think, only time will tell, but I do think that there's no doubt that the Fed is going to play a very important part in this. Because I don't tell you, only 2 weeks ago, tech looked like it was about to roll over until, John Williams threw basically a bone to the market by essentially suggesting that the Fed could actually be cutting rates. So I think it's almost as though that, right now tech is not trading on tech, it's trading on what the Fed is going to do to save tech. And I think that to me is actually very interesting. And this is also the reason why, and I do think that this is where the retail investor comes in to play a very important role. I think there's no doubt, and I don't tell you, you guys obviously, a lot of retail investors are probably watching this show. There is no doubt that retail has become the single most important force in the tech market, right? To the extent that, they've already saved the tech bubble like 3 or 4 times this year. They've been stepping in on dip, and Schwab, I've seen the latest numbers.
That's horrible. Retail traders.
Spiking. They were saying that institutional investors were all selling, but retail guys stepping in. Now the question is, do the retail guys have any insight that the institutional guys don't? And I find it difficult to believe that's the case. I think it's a very complex thing that we're talking about. And so from that point of view, the question is, will the retail guys come in and again to save this market? And I think, it's just to be seen. Maybe, as you said, the animal spirit or whatever will take over and then the bubble gets bigger. But I think right now, I would say that we would have had this correction already if it hadn't been for the sort of the buy to dip crowd, which is primarily driven by retail buying.
So with all that said, David, what's your outlook for the bond market if this thesis plays out?
I think for me, there's no doubt. If the AI bubble were to burst, and again, we're not talking
she got a gotcha question.
A total collapse. I'm just talking about like a 25% correction in NASDAQ, right? That would be enough to get the Fed to cut more aggressively. And I don't care who's going to be the next chairman of the Federal Reserve, whether it's going to be Kevin Hassett or Kevin Warsh or anybody else for that matter. I'm telling you that because there's no doubt that the primary driver of the U.S. economy has been AI, both through the CapEx angle as well as through the wealth effect channel. There is no doubt in my mind that if all of a sudden we see a pullback in CapEx, in basically AI, I think the Fed will be cutting rates. And so from that point of view, I actually like the sort of the 530 steepener. I know it's a bit of a sort of like esoteric thing for basically professional, hedge fund investors, but the idea is to buy 5-year bonds and sell 30-year bonds and looking for that spread to basically widen out. And the reason is because the 5-year rate is going to be much more correlated to what the Fed is going to do.
She got him.
Whereas the 30-year rate is going to reflect the sort of the long-term fiscal issue. And there's no doubt, given basically U.S. personal income tax receipt these days is driven primarily by capital gains tax. I can tell you that much. If NASDAQ were to burst, we're going to see a sharp drop-off of tax revenue, and then the budget deficit is probably going to get much bigger as a result.
Gotcha.
Deep in a trade. Thank you so much for that, David Wu. Really appreciate your insights today. Founder of David Wu Unbound. Appreciate your time. Coming up next, we'll turn our attention to digital assets and where we could see Ethereum in 2026. Smartphone Pros will be right back.
That's Marley. Oh, look at here. Dow Jones up 145 points. NASDAQ 104.17. Whoa. We're above the VWAP on the /ES. This means a lot, folks. As the calls move down to $7.70, $7.77. I tried to grab a couple because today's number is all about the 77777. And did you notice it sneaked right by us and I didn't even see it? We are now above the 200 SMA on the 1 minute time frame, the SPX. What's that mean? You're right. You are 100% right. We're bullish. And that means I put the stop loss behind the 200 SMA moves. Yep. That or you keep it above the 9. Marley's up.
And D.R. Horton sort of at the unchanged line right now, but a mixed day for the home builder sector. But we will have KB Homes right when the market closes for you. Sam and I will have that with Kevin Green. I do want to shift our focus now to digital assets and bring Sam back into the conversation. Welcome our next guest. Joining us now, Andrew Gibb, the CEO of TwinStake. Now, Andrew, you have called 2025 an inflection year for digital assets. What changed the conversation this year to make it so significant for the space?
Good question.
Called it an inflection year as well as a transformational year. So I think
it was a real good question, wasn't it?
Price. As you mentioned earlier, Bitcoin's down a little bit today. It's down year to date as well. So it's down around 8%. Ethereum is down 15% year to date. So if you just look at it at the surface level, you start to question my thesis. Or if you look a little bit beyond that, there's been some real foundational blocks that have been put in place that really serve us well going into 2026 from an institutional perspective. The first one is on the regulation side. It's particularly in the US. I think it's more advanced than it is here in Europe. But in the US, we've seen some real strides forward.
Calls are now worth $10.50.
Post-Trump administration coming in, now really the regulators are kind of on side and really looking.
I don't know how you do this, Jim.
Forward, particularly again from that institutional perspective. The second building block, or foundational block that we have in place going into 2026 is institutional entry points. So we've seen the rise of ETFs. Again, we've got plenty of ETFs being issued in Europe, but more and more so in the US as well. Great entry point for institutions, great entry point for institutional allocators. We've seen the rise this year also of corporate treasuries and digital asset treasuries as well, which again should serve us well going into 2026 and serve as an institutional entry point as well. And the third is really around utility. Everyone, when they talk about crypto, talks about the real world use cases. What we're seeing through 2025 is some real mega trends that are coming through. think sort of tokenized funds, tokenization of real world assets, and stable coins really disrupting sort of the traditional.
New high, 1260.
Foundational building blocks have happened in 2025. But if you look beyond the kind of short-term price action that we've seen, going into 2026, we should be able to build off that and see some nice growth.
They're now at $13.50.
Tailwinds in the space. That's obviously what has driven the price this year. It's been volatile, but you have seen some outperformance, certainly in Ethereum, particularly over the summer. There's some nice price action there. I mean, you say that these tailwinds are likely to continue to propel things into 2026. What do you believe is going to be the biggest driver?
So I think when we think about crypto, the first thing I do is split out the asset class, and I look at Bitcoin and the narrative that Bitcoin has, and then I look at other assets, including Ethereum and Solana and many other kind of proof of stake world. That's the world generally that I live in and the Twin State lives in. Bitcoin has an amazing narrative. Everyone knows the narrative. It's a store of value. It's a hedge and defense against
Santa Claus.
What's lacked on the other side, on the Ethereum and beyond side, is really
that
narrative. What I think is that narrative is shifting somewhat. I think
I'm quite glad about what I got, but oh gosh, you're talking about leaving some money on the table. This is going to cause me to go into the kitchen.
So yes, we've had some tailwinds this year, but I do believe that there's going to be a shift in narrative. I think that Ethereum is absolutely mispriced where it currently is, and I think there's real upside potential once people start to recognize that this will be the fuel that drives the digital economy.
So you mentioned the upside potential for Ethereum. Standard Charter has floated an idea that Ethereum hits 25,000 by 2028. Can you strip away some of the hype for us? What actually has to happen for Ethereum to hit a price like that?
I'd have to strip away your clothes first.
So it's an aggressive price, no doubt, but I think it has, real potential. So for that to happen, we need institutional demand at scale. We've seen the institutional growth in crypto, but I truly believe that 2025 has placed those foundational blocks in place. The pipes are in place, the foundations are in place, and now all we have to do is build it out brick by brick and build out that momentum.
There you go.
To have that narrative
That'll
shift,
do it.
people have to realize the absolute power of Ethereum and Solana for real-world utility. Some of these mega trends will continue through 2026, and once that starts to take off, you'll start to see some exponential action. The pipes and the foundations are the hardest things to put in place, and they're there from an institutional perspective. Now we have to see credibility in the industry, we have to see time and maturity come through, and once we see that, we can really start to uptick on the upside. I think from an institutional perspective, they're obviously key and they need to come in and scale. The way that institutions in crypto think about things is very similar to the way that they think about things in the traditional space. They risk manage their portfolio, they risk manage their mandate in the same way. They think about things in terms of credit risk, market risk, liquidity risk, regulatory risk, etc. So crypto is still a very nascent asset class, and it takes a little while for institutions to come in. 2025 has seen much more institutional focus around allocation into crypto portfolios. So all of the conversations that I'm having with large and sophisticated institutions is we want access into crypto. We'll do it at a reasonably slow pace at the start, 1 to 2% allocation, predominantly in Bitcoin, and then we move down and stack into Ethereum and Solana and beyond. But those entry points are there. The regulation is in place. The risk analysis and the risk appetite of institutions is starting to develop. And then if we think about things like real world utility and yield that you can achieve off Ethereum and Solana and other proof of stake assets, really has that upside potential. And so, yes, the price action of Standard Chartered's number is aggressive, but it has a lot of promise.
Andrew, are you surprised by the price action that we've seen? I mean, given some of the tailwinds that you've described,
Nope.
I mean, some of the legislative
I'm not surprised.
wins, obviously the corporate and sort of more mainstream adoption, institutional appetite as well. That, post October 10th, prices, of cryptocurrencies, Bitcoin has really just been stuck and haven't sort of gained the same momentum as
Tell her
stocks
about
have.
NVIDIA.
And then we saw this big pullback and sort of this rethink about year-end targets. I mean, we had people talking about levels of 150,000 come year-end. We just can't even get up to that 90,000 level right now on BTC. Have you been surprised by that?
Nope.
somewhat surprised. I think if you think about crypto prices in general and what they're correlated to, they've often been treated as a risk asset, and so highly correlated and can't really get away from macroeconomic conditions, and so they've been reasonably soft globally. So we're not immune to those that reality. However, I do believe that the assets are fundamentally mispriced, and we really do need to shift that narrative away from valuing something like Ethereum in the way that we would a tech stock, and really think about it in terms of, this could disrupt, this could be the settlement layer for global finance. This could be digital oil that can fuel the global digital economy. And then when we think about it in those terms, in the same way that Bitcoin continues to hold its narrative, that will give us a nice floor. And then once we continue to increase the mega trends that we see in real world utility, then we should be seeing a lot of upside. So I am somewhat surprised at the price, but I believe that that's going to decouple from macroeconomic trends in 2026, and we'll find a way to fundamentally reprice the assets.
Andrew, we really appreciate you taking the time and for the insight today. Fascinating conversation. Andrew Gibbs, CEO of Twin Stake. Coming up next, it's Options Corner. Rick Ducat will join us to take a look at FedEx ahead of its earnings after the bell. That's next on Market on Close.
Whether you're an experienced investor or just getting started,
well, I'm saying it's priced in.
That's right for you. Do you like using charts when analyzing your stocks?
Yep.
Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages,
Chart patterns,
oscillators, and
moving averages, being in the now.
You can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Welcome back to Market on Close. We'll be watching FedEx after the bell today as it will report its earnings for the fiscal second quarter. Estimates are for adjusted EPS of $4.07 on revenue of $22.88 billion. Investors will be looking for updates on cost reductions
Symmetrical
to help
flag
the U.S.
today.
consumer and any impact of tariffs to the business. Shares are just slightly higher on the year, but have gained more than 45% from their April lows. And now it is time for Options Corner, where, of course, we will be focused on FedEx today ahead of those earnings. Joining us to help us do that, Rick Ducat, our lead market technician here. Rick, as we take a look at FedEx, I did just highlight some of their performance through the year, but if we look at them more broadly against the market and some of the competitors in this space, how are they stacking up?
So it's been an interesting period here. FDX, FedEx, part of the industrial sector here. If you look at our first chart, you can see that the industrial sector and the S&P 500 are pretty close. They track fairly closely together. Meanwhile, our green line down there, FDX, quite different, quite a different trajectory for the recent few months, especially here, pretty much just straight up here. So an interesting situation to consider here. XLI, not the greatest comparison for FDX to. It's kind of one of these broad sectors where there's a lot of different companies. So if you were to look at the next chart, then you can see FDX stacked up against its arch rival UPS, as well as some of the other important names in the freight space here, JB Hunt, Expeditors International, and C.H. Robinson here. So by this measure, you can see a very similar sharp upward trajectory for all these names recently here around the end of October, mid-October. So that's when things started to turn around here. I am really curious when we hear earnings, of course, always signals about holiday demand season. It's obviously the busiest time of the year, but also to hear how the spinoff of their less than truckload freight business has played out so far, potential cost reductions from AI in terms of logistics management or anything else, as well as anything about autonomous driving for freight. That seems like such a notable thing to consider as well. So that would be the things that I would be most curious about here as we head into this earnings event.
I think you mentioned a few of the big ones there, particularly the setup for the holiday season. That seems to be one that keeps getting flagged in the notes that I'm reading. But as far as notes and any sort of notable analyst action that you saw coming into this event, was there anything that stuck out to you?
Everything looked pretty positive during the past couple of weeks here. Just a quick glance showed that Deutsche Bank, Barclays, Stifel, Jefferies, and Goldman Sachs, all since December 11th here, raised their price targets on this name. They all kept their buy ratings as well. Price targets kind of ranged in a wide area here. They went anywhere from 301 for Goldman Sachs, all the way up to 360 from Barclays here. So analysts seem mostly pretty positive here as we look toward this important barometer for this holiday shopping season.
And Rick, when we have these earnings reports, especially of any kind of company where we're using a term like barometer in the lead up to their event, are we seeing outsized options trading today?
Yes. What we see today so far, about 48,000 or so options trading hands here. The sizzle is 3.0, so 3 times the 5-day moving average of options volume here. 47% calls or so. And the most active series today is our December 19th expiration that will capture earnings. So both in terms of volume, it was 61% of the day's volume. It's also the biggest in terms of open interest, about 27% or so. So it's about 40,000 contracts
it's a big
of open
deal.
interest for that particular expiration month versus 146K total. Not really many notable trades specifically that we saw today.
6796.30.
There was a very heavy activity on the call and put sides between 270 to 290. That was the notable area for both of these particular option series.
And 270 to 290, interesting range. Right now we're trading at 286 in advance of their earnings, which we'll have here in just about 15 minutes. But Rick, I want to thank you for being with us to take a closer look at FedEx for Options Corner today. And I do want to send it back to Sam in New York to find out who we'll be talking about for overlooked stocks.
Well, Marley, today, George Phillips has his eye on AMAT heading into the close. We'll break down that news and what you need to know about Applied Digital heading into the close on Market on Close. We'll be back.
How's it going?
First day, so
sometimes you know.
Boom, boom.
Try it again.
You could have done better.
Please.
Same goes for where you invest. Level up and invest smarter with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills.
How many sevens does it take to make an 8?
I've seen something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing
Technical difficulties.
Carl,
you're still on air.
Schwab, a modern approach to wealth management.
They're laughing at you, Carl.
Into the markets with Schwab Network. Tune in
bull
24
crap.
hours a day, 7 days a week on SchwabNetwork.com.
And on all your favorite streaming services. Schwab Network.
I was trying to tell him about this here the other
On
day.
any device for free.
They didn't take
Believe
me
me, when
serious.
it comes to investing, you'll love Carl's way. Take a left here, please.
It's the best way.
Carl's way is the best way.
Is it?
Yes.
At Schwab, how I choose to invest is up to me.
Exactly.
Oh, God.
I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out there.
Where are you going?
Schwab.
You cold turkey.
Schwab, a modern approach to
How
wealth
dare you treat Carl like that?
Welcome back to Market on Close. I'm Sam Bartis, live from the floor of the New York Stock Exchange. It's time now for overlooked stocks. We are watching shares of Applied Digital today after runway is coming off the back of the company closing a loan facility for AI data center development. So George Phillips is with us, senior markets correspondent, to help get us across what the details are here. And obviously this is why we're seeing a nice 10% pop here. George, talk us through this report.
Yeah, I mean, we talked about Applied Digital, Sam, in this program, but, you know, this is a very unique story for a company that's really come out of nowhere. I mean, the stock is higher tremendously over the last 5 years, and traditionally it was a Bitcoin mining company, and it's moving, and we talked about this, into high-performance computing as well as data center hosting. So they're yielding more economics out of their existing infrastructure, and they're actually building quite a bit more infrastructure and lease agreements with major partners like CoreWeave. In fact, they have about a $7 billion lease agreement. That's their primary tenant for their operations, primarily in North Dakota. This is a data center that they're developing that they're expecting to bring to the market. It's a $3 billion data center in 2026. And of course, the story behind Applied Digital is now a dual technology stack, Bitcoin mining, but also now morphing into the aspects of data hosting and high performance computing, and also leasing these technologies out to major institutional and infrastructure-based companies like CoreWeave and so forth. Now, the news today, if you look at it, it's not very meaningful. I think the stock itself is actually moving quite a bit to the upside in sympathy with the overall market, considering there's some retracement opportunities in areas of technology like the semiconductors. Companies like CoreWeave are moving back higher, Bitcoin as well. But Macquarie is actually another partner of Applied Digital. And so they basically entered in a new loan facility agreement with Applied Digital and basically enhancing their abilities to generate credit for operating expenses. So this is an ongoing partnership that the company has with Macquarie, and it's especially tied to the opening of their data center, their primary one in North Dakota, coming up in 2026. But I think Macquarie, if you look at them from a legacy capital asset and financing firm, they've got deep pockets, they know market trends, and I think this speaks to some of the substantive aspects behind Applied Digital's prospects going forward. The stock is down if you look at it from the highs, just going back a couple months at $40, but nonetheless, Applied Digital has been a remarkable story, up over 250% in the last year-to-date basis.
Yeah, I mean, it's an amazing performance year to date, as you say, up over 200%. I'm looking at some of the analyst consensus as well. I mean, you've got 10 ratings here. I mean, the majority of the cohort is in the buy camp, and a strong buy as well, a couple there. So they like what they're hearing here. There seems to be a lot of conviction, but an interesting time, you would say, though, to be talking about, credit lines and loans for data centers, given all this talk in the market around, how these companies are getting their hands on the capital to do all this. We've heard about delays as well. What do you make of that?
Yeah. Well, I think the overarching issue right now is we may be running into an overinvestment cycle. Even interest rates, if you think about them, interest rates really, we look at from a consumption standpoint, but what it tells us from an investment standpoint is as interest rates are falling, the demand for investment just isn't there. So I think there are some issues we have to be aware of contextually or a larger picture from a larger picture standpoint. Companies like Oracle, I'm using that as a proxy because the stock since the September gap higher has been a tremendous, very bad stock, for lack of a better word, in terms of performance. The expectations for Oracle were very high, and maybe that's again, being passed through to the other periphery names in the data center as a service technology stack like Applied Digital and CoreWeave. So you have to be mindful of that. But there's no doubt, if you just look at the growth rates for this business, the estimated sales for Applied Digital are $300 million fiscal year 26, $550 million fiscal year 2027. They aren't expecting any adjusted profits this year or next, so again, keep that in mind. Short interest is quite high still, 28%. And then, of course, if you look at the losses on a trailing basis for the company, they generated around $175 million last year, but they lost $220 million. But, in the context of large growth in sales, that may not necessarily matter. But the moral story is there's a little bit of concern right now of overinvestment. Applied Digital is locked into this ecosystem and infrastructure space. But right now the trend is still higher, and looking at the trends, at least on a weekly basis, still holding its 20-week moving average for what it's worth. That might speak to some potential continuation of the upside, but there's also that structural challenge that I talked about earlier that may push it lower.
Yeah, I think the highest price target right now is at $56. We're at $24 right now. So, certainly some room for further upside according to the sell side. Thanks so much for getting us across that name and that story as well for us today, George. I'll send things back over to Marley in Chicago for now.
Thanks so much to Sam and George. We are nearing the end of our market session. Kevin Green will be joining us to break down the levels. He's watching on the S&P 500, and we'll have earnings from FedEx, KB Home, and Nike on Market on Close. That's coming up next.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
That could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Sometimes, you could have done better. The same goes for where you invest. Level up and invest smarter with Schwab.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network. Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
We're back here at Market on Close. I'm Sam Vardas on the floor of the New York Stock Exchange alongside Marley Caden in our Chicago headquarters. We've just got a few minutes left to close out the session, so let's welcome in Kevin Green, Senior Markets Correspondent, to help just do that. We're off the mid-morning highs now, KG, but still holding up pretty perky here across the major averages. What are you watching as far as the levels into the close?
We've been consolidating here after the open. We had this gap to the upside for the S&P 500. It looked like on an intraday basis we were going to test that gap, and we did for a tad bit here, but we were able to recover. Now going into the close, obviously we want to be able to hold these levels, but we have seen the 6,800 area as an area of resistance. We talked about that earlier this morning. You did actually get a little bit of optimism on an intraday basis, where the market really tried to push it to 6,820 or so. That was the next area where a lot of call flow was going into, but we did see that obviously fade throughout the day, and you want to be able to just kind of hold this up and try to consolidate maybe a little bit more until tomorrow, especially the overnight session. And then tomorrow we have the quarterly expiration, which I think is going to be very key for these markets. So kind of looking at the close here, if you can close above 67.60, I think that's going to be a positive sign. And if we look at that 5-day or that 5-minute chart for today, you can see this asymmetric triangle that has been taking place, basically making lower highs, but also making higher lows. And we won't see the full apex here because we just don't have enough time, but you want to be able to kind of stay and remain within this range. And then tomorrow, once again, getting some buying activity to take place, you will see some rebalancing from a lot of institutional traders that are out there, the rolling of these options for the January expiration as well as for the March quarterlies is going to be very key for this market. And I would not be surprised actually if you do see a spike in volatility as we open the market tomorrow. Usually we do see a spike in vol, and then that crushes over time, and then hopefully you can actually have a rally into the close. That's really the setup that you're looking for if you're a bull right now.
And KG, we have a triple witching coming tomorrow with that quarterly expiration. As far as what your expectations there, what are you keeping an eye on? Are you looking at volatility? What do you foresee happening with that?
Yeah, so if you're looking at the volatility index or the VIX right now, it's sitting at around 16.6. And so what you are actually expecting is at the opening of tomorrow's session, the equity session, you are going to see the expiration of the AM SPX options, the NDX options, as well as the Russell. You also will see the expiration of the futures contracts for December. Now, if you're looking at the contracts right now, or if you're looking at charts, you're already looking at the March contract, so not a big deal. But that's going to be the start of that day, and then we will see volume obviously spike at the open. And then going into the close, we will have the PM expiration taking place. And then typically, we actually do see a pretty aggressive trading range for mid-cap stocks as well as small-cap stocks. So if you're kind of looking at where the action or the alpha is going to be tomorrow, usually on the quarterly expiration, that's where we see a lot of that concentration. And so a lot going on. We also have SPY going in ex-dividend tomorrow, QQQ going into ex-dividend as well. So a lot happening mechanically behind the scenes here. And hopefully the news flow actually does kind of support us for us to continue to try to move a little bit higher from these levels and try to recapture the 20-day moving average and try to move higher.
Selling into close. Selling into close. You know, today I didn't take that many trades. But I did do good. So that's what matters. And we'll see you tomorrow.